Look out for that. A lot of factors there up in the air, about 50 points down, nothing major after the kind of run-up that we've had. But let's take you through the global cues very quickly. It was a muted day of trade on Wall Street as major indices closed marginally down. The Dow was down about 155 points, S&P 500 also mildly in the red, as was NASDAQ. I think the big story, though, was what happened after market hours in the US when NVIDIA said it will bear a cost of $5.5 billion for exporting equipment to China per quarter, and that took the stock down about 6%. The 10-year in the US, the 10-year Treasury slipped marginally to 4.32%, and the Brent neared the $65 range after another set of demand cut forecast, this time from the International Energy Agency. Asian markets have opened mixed, but the China GDP figure is important. In fact, that has come in at a better clip than expected. China has come in, the GDP for Q1 has come in at 5.4 versus an expectation of 5.1. So you would see Asian markets doing okay. But if China is able to sort of hold off economically, despite what's happening with the US, I don't know what it means for India and the world. Some of those assessments there is that China could be hit, the GDP could be hit as much as 2% because of the trade war with the US.
Very interesting. Before I start, I was having a conversation yesterday, guys, with people from the mutual fund industry, and one individual very clearly said, I don't know why you guys look at the flows data on a daily basis. And my point was, okay, it's not like we...
the FID
data. And my point was, look, we're not suggesting anything by it to say, oh, look. We're saying, okay, over a course of maybe a month, 2 months, you see a trend, right? And so to that end, I think what we saw yesterday is quite significant to say that foreign institutions bought to the extent of 6,065 odd crore rupees, and you had domestic institutions sell about 1,951, quite a few blocks taking place through the day, and big trades. So also look at the delivery data. I'll come to that in just a bit. But Indian equities playing catch up, one can argue, because of the breaks that we had in trading, and bulls very clearly in the driver's seat. 48 out of 50 Nifty 50 stocks gained in trade yesterday, and the benchmark added 500 points. Private banks led by HDFC Bank contributed the most, but you also had other heavyweights also contributing to the action. Take a look at the delivery percentages here. Bharti Airtel 74.5%, HDFC Bank nearly 74%, Axis Bank as well, ICICI Bank all above 70%. And in fact, I look down the list, there are too many to add, but quite a few above 70%. And that is quite telling at this juncture. Now, it has, in fact, the Nifty 50 moved above April 1 levels. And in fact, it's the highest in this year, 2025. It's at 23,328. It has moved above its 50 DMA as well, but it remains below its 100 and 200 day moving average. What was important in trade yesterday was a move in the Nifty Bank. And quite a significant move at that, because it moved up 2.7%. We already spoke about HDFC Bank, but it is at its highest level in 2025. And in fact, it has moved above its 200-day moving average as well. In fact, it is at the level, incidentally, that it was on the 26th of September 2024. And just a day later is when the Nifty 50 made an all-time high. It has seen selling since that point. The broader markets, in fact, kept pace with the benchmark indices and registered strong gains. And you had 10 stocks that gained for every stock that declined on the National Stock Exchange. The Nifty Midcap Index gained about 3%. In fact, you have the Small Cap Index that gained more than that, ended higher by 3% or thereabouts. Realty defense stocks were at the forefront of this rally. You also saw auto that contributed quite meaningfully, and you had Tata Motors that gained quite significantly, bouncing back on some of that trade tariff relief. VIX, and this is the last point that I will make, it's very important to note, we were looking at a number that was above 20, it cooled off very dramatically yesterday to about 16.13, and that bodes well, I think, for the bulls, Neeraj.
Yeah, I mean, so again, I think I kind of concur with what Taman was saying, that somehow it's just becoming so difficult to call anything as a trend, either on the downside or on the upside. So we've got a good actually the day was very strong yesterday because we started off positive and it ended with strength.
Yeah.
So usually for the follow-up days, that augurs well. The fact that Asia is doing largely okay also probably ties in with that theory. But a lot of derivative experts are suggesting that that zone which we open in with is the zone of large supply. So do we actually start to see some supply coming in despite the fact that the momentum is positive? Thankfully, we will not have any other holiday. I mean, we love holidays, but it's good to not have a holiday when the global markets are so volatile. So now we are really in line with the global markets per se until the May 1st.
No, it's Friday.
Friday is a holiday for world markets as well.
Oh, right, Good Friday.
So I'm saying we're not going to be a holiday while other markets
we're not missing a day.
Right. Okay, that's a point.
So therefore, that also helps per se, which is a positive. And I think all eyes out on, for whatever it's worth, what Wipro has to say as well. I mean, TCS, while the stock didn't react as much, but it did seem that there's a lot of issues with what they have said or not said. And I think what Wipro might add to that might just imply so much for IT. Because the one last point I'll make, a clutch of these mutual fund CIOs put out their newsletters, right? And almost all of them unanimously are underweight IT. So it's a very under-owned sector.
And the portfolios also describe that.
Precisely, right? So it's now a very under-owned sector which has already seen some pain. Can a whiff of positivity, as unlikely as it is, from mid-sized companies help? But for now, Wipro unlikely to echo something which is materially different or materially positively different from what TCS has said. So one reckons that that will continue as it is. So 3-4 results, including Wipro to watch out for, Angel One, etc., should all be fun.
Yeah. I think the big ones to watch would continue to be what's happening with banks. Because they have been, banking stocks have been sizzling, for lack of a better word. And then you have, those numbers coming in over the weekend as well for HDFC, deposit rates looking good. One of a banking stock on my watch list as well before I come to that. So I'd watch out for financials. I'd watch out to see if auto is showing a continued momentum. I'd also watch out for pharma. Pharma might see a bit of trouble today. So I want to add that in because overnight, the Trump administration has announced a probe into pharmaceutical companies and pharmaceutical imports. Now, they've laid off tariffs on pharma for now. And he's said before that I'm going to bring in some tariffs, but this probe might sour the mood when it comes to pharma. So watch out for pharma stocks today. But what else? A few factors to watch out for before we open out and we get the F&O set up from Puneet as well. Nifty is continuing to display strength after 2 consecutive gap-up sessions. And India is the first major market to fully recover from the tariff-induced downturn. We've actually wiped out all of the April 2nd onward losses with the kind of gain that we saw yesterday. Resistance, of course, at the 200-day EMA at 23,360. A breakout from 23,360 could push it towards 23,650 and 23,900 moving on. So we'll have to wait to see if that strength comes in. Remember, no one likes to trade in large volumes before a truncated week. But nevertheless, that didn't stop people yesterday. Below the 200-day EMA index may consolidate. Key support at 23,050. The Nifty Bank, of course, closed at 52,380. Resistance at 52,481 and support at 52,005. So those are some of the key levels to watch out for. And Puneet, is that what you're seeing echoing in the derivative space as well?
Well, definitely, really strong session yesterday. Now the support is currently at 23,300, as you rightly mentioned, and that's one of the key levels to watch out for in this uncertain time going forward. Apart from that, we saw a really interesting trend in the broader market yesterday as well. FI is buying roughly 6,000 crores in equities, and that's important because my colleague Chinmay has highlighted there's no bulk deal essentially that's happened in the trade yesterday. So this is all positions that's built up, especially in the banking stock. So before we get to the delivery data, let's also look at the OI gainers as well as the losers side as well. We saw a very interesting session yesterday across, stocks such as the auto pack specifically, which was down in trade over the last few days. Currently, we are seeing long build up in a bunch of these stocks, Irida, Hindustan Zinc, Chola Finance, as well as Infosys before the results come in tomorrow. Some short build up seen in PNB Housing Finance as well. While on the losers side, we are seeing some, short coverings in stocks such as Bharat Forge and Sona BLW. And we spoke about the auto pack specifically today. That's one of the key watch outs. So HCL Tech also before the results come in, and ICICI Bank is one more stock which has seen a lot of short coverings. The Nifty has regained roughly 1,600 points since the lows of April 7th, so that's another key positive. And we can pull up the delivery data table as well. That is a very interesting one because we see the FII money essentially go in the banking stock yesterday. Almost over 70% delivery in stocks such as HDFC as well as ICICI Bank. And another one, interesting one is Bharti Airtel. A lot of EPS upgrades seen in the next 2 years for Bharti Airtel, and essentially the FI money coming in there as well. So overall, the session build up today before the trading session is very interesting, and the 23,300 level is something to watch out for, at least from the support side, while 23,600 will be the immediate near-term resistance to watch out for in trade today.
Okay, let's look at what's on our watch list. I'm starting off with details that actually have blown my mind. You just want to keep a reminder here, and guys, all of you know this. 10th of March, we did a KYC, a Know Your Company show that runs every day at 11:30 a.m. on NDTV Profit on Gensol Engineering. And we laid threadbare. Also go back and see my colleague Sajid Mangad's piece where he's asking where is the cash on Gensol. Nevertheless, even though we did warn people that there was some trouble with this company, what SEBI has said is truly shocking. So Gensol, first stock on my watch list. No brainer that it's a thumbs down. SEBI has barred Gensol promoters because of fund diversion, falsification of records. They received a complaint in June 2024 about share price manipulation and fund diversion. Their probe found fake documents, fund misuse, fraudulent disclosure. Company has defaulted on loans from IREDA and PFC starting December 2024. Now, here's the shocker. Despite defaults, the company gave false no default statements to credit rating agencies. They shared forged letters from IREDA and PFC to support their false claims. Money that they took on loan from these companies went to buy electric vehicles was routed through a vendor, Go Auto, and then diverted to buy luxury properties for themselves in DLF Camellias. So SEBI has now, of course, also put Gensol Engineering stock split on hold as a result. But this level of misuse of public funds is truly shocking. Just to go through the watch list very quickly, IREDA is the next one. So yes, I know that there is about a 460-500 crore maybe hole in the balance sheet, which they may not have accounted for in this quarter, but their numbers came out yesterday and overall the Q4 numbers are strong, which is why IREDA is a thumbs up. But they have not made any provisions in Q4 for the exposure to Gensol Engineering, which SEBI has observed, saw funds being diverted for personal expense. The exposure stands around 570 to 600 crores, which accounts for 0.8% of its loan book, will be potentially written off in the next quarter. That's the first quarter of FY26. PFC also has a very small exposure, but the total numbers as far as IREDA is concerned are good. The Gensol Engineering hit may be a little bit of a pain. IndusInd is actually a thumbs up, not a thumbs down. IndusInd is a thumbs down. There's a report of an external agency has now come in. The post-tax impact is quantified at about 2.27% of the bank's net worth. The negative impact is 1,979 crores as of 30th June. The estimate that the bank had put in was about 2,100 crores, so slightly below that. But why am I saying it's a thumbs up? Because this overhang is sort of behind them, right? The report is now out. Buzz since yesterday that there's going to be a new MD and the selection process has started. Look at what Morgan Stanley is saying. They're saying they're maintaining an equal weight with the target price of 755. The external agency has confirmed a derivative discrepancy loss. Amount is largely in line with management estimates, and they will closely track findings from the comprehensive audit report that will shed more light on the discrepancy. They'll probably account for all of this in Q4. But Macquarie is quite positive. They maintain an outperform, and they've set a target price of 1,210 for IndusInd Bank. They say the derivative discrepancies impact has now been seen. It's limited to 2.27% of net worth, marginally lower than what the bank had internally estimated. And they say this is incrementally positive in the near term, and impact of discrepancy will be limited to what was earlier penciled in. Even Citi has a buy call on IndusInd. So it's interesting. I mean, fundamentally, that issue, of course, continues to be there. But maybe now that you know exactly what the extent of the rot is or the pain point is, then that gets accounted for in the books this quarter, and then the bank moves on.
Absolutely. On the point of Gensol, I remember last evening while we were talking about it, when the news broke, that I vaguely remember seeing an episode. I went back and watched it, and really I would encourage everybody who's tracking the company and who wants to know about this to watch that episode. It's available. Of
Know Your Company.
Of Know Your Company, because even at that time, of course, there was certain information that sounded fishy, but my colleagues, we've got Harsh as well as Vishwanath Nair, who's a banking head here, banking, and Sajit Mangat, all three of them really going through the details of that and looking at what has happened. But let me take you through what's on my list. And MGL and IGL, I've put them together, clubbed them together. It's a thumbs up broadly. The news on the administered price mechanism allocation cut is old. But what is new is the fact that replacement gas is likely cheaper than the other options. And the government has cut APM gas, as you know, allocation for both IGL and MGL by 18% and 20% respectively. The reduction in the APM allocation is likely to be replaced by new well gas. And this new well gas is likely to be costlier by $1.3 per unit. And in fact, it is cheaper than the other sources by between $1 and $7 per MMBTU. Depending on the extent of the replacement, of course, with new well gas, the margins could in fact improve. So it is certainly something that is a positive. Oil India, now we're talking about an exploration company. It's an update that has come through from the OALP, which is the Open Acreage Licensing Policy Round 9. And remember, this policy gives more flexibility to investors to choose blocks. Oil India exploration portfolio is set to expand by over 51,000 square kilometers as a result of the latest round of the OALP. And certainly it's a positive. Of course, bear in mind that crude oil prices have fallen quite dramatically, and to that extent, that context is important to bear in mind as well. The last stock on my list, Sanofi India. It's a thumbs up because the company has very firmly, categorically come in and said that it has no plans to divest, sell or license its Lantus brand, which is an insulin brand. A report had claimed that the company is looking to sell Lantus for 2,000 crore rupees, and that report had actually said that they were cutting the asking price from 3,000 crore to 2,000 crore in order to find takers. Lantus, if you're unfamiliar, is an insulin drug which is prescribed, of course, for the treatment of diabetes, and it has been a market leader for 2 decades. So sentimentally, I think that it would be a positive, with the company very clearly saying that it has no intention to sell.
Yeah, so interesting list of stocks. I have just 2 more to add to those, and one of them is Axis Bank. Enthused whenever a large financial institution wants to raise money via equity, helps the book value, so on and so forth. So 24th April is the date, 8 days away from now. And maybe this will just be the enabling provision, then the final thing happens later. But since banks are sizzling, add to that list Axis Bank, so watch out for that one. And from amongst the other results that have come out, ICICI Prudential kind of stood out. VNB growth as well as margins were above expectations. The net premium income about 10.7% higher. More importantly, what they've said in the con call is interesting, because the company said that it expects about 15% growth in FY26, led by enhanced ULIPs and guaranteed products. And the company is saying that the VNB will outpace AP with margin gains. So margin gains is something that most people like. So interesting one from ICICI Prudential as well. ICICI Lombard has kind of said that Mediclaim business is not quite hitting the right notes, but ICICI Prudential, decent numbers. So these two, Axis Bank and ICICI Prudential, from amongst the many. A few stocks that help.
Yeah. All right, let's, the other big story, of course, is retail inflation numbers, which came in, eased to 3.34% in March, the lowest since August 2019. What has helped ease off the CPI numbers? Pallavi is joining in with the details.
Right, Tamanna, like you pointed out, this print is the lowest since August 2019, so the lowest since the pandemic. Now, the headline inflation, like you said, came in at 3.34%. That's compared to a print of 3.61% that we had seen in February. And this was, in fact, even lower than was being estimated. A Bloomberg poll of economists had pegged the median inflation rate at about 3.5%. Food and beverage inflation eased to 2.88%. This is from about 3.8% we had seen in the preceding month. And within that, the decline was primarily led by vegetable prices, which contracted by about 7%. That was compared to a contraction of about 1.1% in the previous month. Now, core inflation, that excludes the volatile food and fuel components, did see a minor uptick coming in at 4.2% in March. That was compared to about 4.1% in February. Now, what do these figures essentially mean? The softer than expected print does provide immense comfort to the central bank. We've already seen the central bank, the MPC, cut rates by 50 basis points, and on the basis of what we've spoken to numerous economists over the course of yesterday and today, there are expectations that we will see at least 50 basis points more in terms of rate cuts over the next few months. The outlook for inflation also is decisively positive. That's something RBI Governor Sanjay Malhotra too had said at the last policy meet. The RBI projects inflation for FY26 at 4% and Q1 at 3.6%.
Thanks so much for lining that up for us, Pallavi, and that sets the context perfectly for our next chat. And joining us today is Lakshmi Iyer, who's the Chief Executive Officer Investment and Strategy at Kotak Alternate Asset Managers. Thanks so much as always, Lakshmi, for taking the time. And I'm looking forward to your Bollywood analogies on this one, because just a couple of months back, we were talking about a shallow rate cut cycle, 50 basis points. And now, with 50 basis points already done, we're pricing in 50 basis points more. So, and do you agree with that, first of all? And when does this come through, in your opinion?
Yeah, hi, good morning. So no, definitely, when the mercury is rising, we actually are seeing, inflation downsizing. So that definitely is very, very positive news. And, in some sense, if you can envision the movie Lagan, where, the villagers are actually looking up the skies, the land is parched and they're actually looking out for some coolant in the form of rain. That is the much needed respite that we've seen. And mind you, this is despite the fact that there are heat waves in certain pockets of the country. So, I think it's great news. We are seeing the pre-pandemic levels on inflation. Of course, core inflation is still, edging just right there. But I think, we need to take it as per the headline numbers, which is what the central banker tracks in our country, and seems to be great news at this point in time.
Lakshmi, morning, Tamanna here, and we always love that you bring the parallel of Bollywood or a movie, and I think the Lagan one is completely apt right now. The question is that the hope is not just for rain, it's also for interest rate cuts. What is the kind of space these CPI numbers give, especially considering that because of the heat, you might see food inflation coming back up? It's been a couple of good months, but there's no guarantee that this will sustain.
Absolutely, Tamanna, I agree with you. But the thing is that the elbow room for the central banker definitely is getting better. And we need to keep in mind that every 10 percentage point reduction in crude oil prices adds favorably to the CPI by almost 30 basis points. So even if we were to see some kind of an upswing in food prices, which is not entirely ruled out, the space that we have, or the margin of safety that we have is pretty high. And also, if you have, just to allude to the central banker's press conference after the policy, he did allude to the fact that real rates of 150 basis points or 1.5% seems to be okay. So if I kind of join those dots together, and the fact that if inflation anchors around 4% region, then are we looking at an additional additional 50 basis points of easing this year? Probably yes. It's data driven, and of course, at this point in time, RBI, who is, as I call the Sikandar, that's the latest movie which is, come to my mind, and that's the last movie which I watched. Being the defender or the warrior will definitely keep its glance on every cues before taking the next action.
Good morning and good to have you. We loved having you on the monetary policy conversations, but even this is welcome. Just one quick follow-up. If indeed vegetable prices lead to inflation perking up slightly, but there has been a change in stance and the GDP might demand it, so you reckon that slight upticks in vegetable prices and maybe consequent slight upticks in CPI may not deter the RBI from a downtick. So my question to you is this: the base case is that inflation will stay low and rates go down further. But even if CPI were to pick up a little bit, you still reckon that the chances or the probability of a rate cuts are higher because now it's no longer just an inflation targeting central bank?
Absolutely, Neeraj. I would say that the third factor which we should not ignore here is that a globe is melting. So, it's that time of the year where, all of these things are coupled with the fact that global slowdown is for real, and assuming that the world grows at 3% and even India grows at 6%. I know our forecast is at 6.5, but even if we do 6%, we're doing 100% growth more than the rest of the world. And given that, the chances of imported inflation is that much lower. So all of that put together, despite the fact that there is a small, or I would say a toss of a coin probability that food prices may inch up, and that's the seasonality part of it, I would still say that at this juncture, looking at all the data points alluding to rate cuts, looking at these, and see, the central banker has to be forward looking, and they've mentioned that in the past two policies. So looks like so we had a forecast of base case of 6%, but that was pre the Trump tariff trauma and the Thrive world. But now I think it's a very different new world order, and the data points are leading to different outcomes.
Lakshmi, last quick point. We don't speak about bonds enough, perhaps, but long bonds look attractive considering 50 basis points still to take place, and also in the context of global money moving out perhaps of treasury. And where does it go? Foreign institution interest in India bonds? Do you think that will take place? What are the implications of that increased demand then?
Definitely, with a reasonably stable rupee that we have in terms of outlook, and the fact that the rate cut cycle is still not over. And more importantly, that our fiscal deficit is not funded by foreign banks or foreign central banks, I would say, gives us reasonable elbow room to say that the time to bond continues.
Okay, thank you so much, Lakshmi. Always a pleasure to have you on, and we hope to see you on the next monetary policy as well. Lakshmi Iyer there, talking about how this is giving the Reserve Bank enough elbow room. But let's get to the big story that we're tracking this morning, and frankly it's a shocking one at all levels. So here's what's happened. SEBI has issued an interim order in the case of Gensol Engineering, where they've prohibited its promoters from involvement due to allegations of fund diversion, falsification of records as well, and a whole slew of misdemeanors. Giving us details now on that are Charu and Mihika. Charu, let's start off with understanding what SEBI is saying, what the allegations are, and then of course Mihika coming in with what implication this has for investors.
So the market regulator, Securities and Exchange Board of India, has come out with an order against three entities here: Gensol, Anmol Singh Jaggi and Puneet Singh Jaggi, who are the key managerial position holders in the company. Now what has happened is that the regulator found that some false documents were submitted and some false disclosures were made by the company, both on the stock exchanges and as well as in the disclosures made to the credit rating agencies. It all started in the month of June last year when some manipulation complaints were made to the regulator, and then again this year in the month month of March, the agencies found that the company was delaying its loan repayments. Now what happened here was that when called upon to answer on these questions, the company submitted some false and fabricated documents, some documents called conduct letters from companies like PFC and IREDA, saying that there is nothing wrong in the loan repayment system and the mechanics that they are using. However, these companies themselves in an email conversation reported to the credit rating agencies that they have not issued any such letters and they are forged and fabricated. Upon understanding the entire situation and knowing that the company has been making fake disclosures, lying about the contracts that it is receiving and lying about the subsidiaries, the US-based subsidiaries that company is talking about, all of this is false. In fact, the shareholding of the company has also reduced from over 70% to 30% while it is going through, it was going through an exponential rise in its shares and its market capex, and it also moved from SME listing to main board listing. However, it was all based on fabricated disclosures and documents, and the amount raised from all this was used to, fulfill personal expenses, buy luxury apartments in areas like Gurgaon.
Okay. Let's also talk about the implications for shareholders now, because you've seen a considerable drop in the share price as well. Mika is joining in to tell you about some of that. Mika?
So we've seen Gensol be in focus in 2025, especially. The stock is down 85%, and in terms of their market cap erosion, it's seen a market cap erosion of around 6,890 crores. The peak market cap was around 7,300 odd crores in Q2 FY24, and the latest stock split that was announced in the 1:10 ratio has also been now put on hold by SEBI. Now, what alerted the markets majorly was CareEdge and ICRA downgrading the ratings of the companies early in March. The ratings downgrade was on account of ongoing delays in servicing the term loan obligations, and the no default statements that were shared with ICRA on the debts servicing track record were apparently falsified as per the rating agencies, and there were then concerns on corporate governance practices, including its liquidity position. Now, just to give you a quick debt to liquidity picture, the total debt of the company stood around 1,146 crores versus the last 12-month EBITDA of around just 330 crores. Leverage was at 3.5 times, and the company had stated that it had liquidity of 250 crores in its Q3 FY25 con call, but we don't know why the debt repayments were not coming through if it had this said liquidity. Even in terms of their divestment scheme, which was aiming to raise around over 650 crores, is now not on track. Claim one was to sell 2,997 EVs to Reflex for around 300 crores, but the update is that Reflex, after doing its due diligence, has decided to not go with this transaction. So this entire transaction will not be coming into place. And the second claim is the company is going to sell its US subsidiary for a total of 350 crores. The transaction is expected to come by March 2026, subject to approvals, and we wait for an update for the same. And lastly, when you talk about the fund infusion, the company has received 25% of its warrant subscription, which was issued in the first half of FY25, which has been paid back, but is yet to raise 404 crores from promoters and investors. 100 crores of this is from promoters, the balance from around over 100 investors. But the promoter did infuse 30 crores of the 100 crores needed in March when he sold 2.37% stake coming in. Lastly, we also have IRIDA in focus on the back of this, because it has a total exposure of 600 crores to Gensol, debt of 280 crores, and a working capital loan of 320 crores, and this is 0.8% of IRIDA's loan book.
The details actually tell you the extent of fraud and manipulation here. If you go through the SEBI copy, about 6 crores was diverted to the mother of Anmol Jaggi, wow. About 3 crores to the wife. There was about 26 lakhs spent on golf sets. That's an expensive. There was about 17 lakhs spent on a Titan company, so I don't know if jewelry, watches, or whatever. And there was about 10 lakhs spent on something appears for personal use on Camco Chew Food, which imports confectionery. So I don't know. That seems another expensive habit that has come in. It's just mind-boggling.
It is
the extent of the fraud. There's also, another thing that I just want to talk about for a second. The SEBI notification also talks about an exchange filing that the company put out, claiming that they had got orders for 30,000 electrical vehicles, 30,000 crores worth of electric vehicles. 30,000 crores from Bharat Mobility. the 2025 big auto fair that happened. When they went and investigated, they found that these were MOUs. So that's fine. The official went to their plant to see what was happening there. Yeah. They pulled out the electricity bill and they saw that there was nothing happening there with the 3 or 4 laborers at this manufacturing capacity, and the electricity bill showed that there was pretty much nothing happening there for the last 12 months.
Wow.
So this is solid groundwork and an investigation by the authorities, which I think we should give credit for.
Most certainly.
That they actually went out and did it. But anyway, more on Gensol ahead on the channel as well. But let me get Chakri Lokpriya in, his Chief Investment Officer, Equities LGT Wealth. Very good morning, Chakri. I think the most interesting read this morning is the SEBI chart sheet on Gensol and all the details coming in there. But apart from that, let's start with an overview on the markets right now from you.
Yeah, good morning. It's a good thing that inflation in India is also falling at the same time as the Trump tariff pause. And, the number of goods that India, various categories of goods that India has that exports to the US is also much limited in range versus China or the EU. And so that gives India the ability to quickly come to an agreement over the next 2-3 months. All this valuations are on India's side. So, but yes, of course, volatility will continue because as news flow keeps coming in, sometimes up, sometimes down. But I think the overall direction is up.
Chakri, over the last couple of days, particularly yesterday, there's been quite a considerable interest in banks. And I'm just wondering whether that's, of course, one can make a strong argument to say that the relative valuation comfort for banks was there, and so deploying in banks would have been comfortable yesterday. But do you think that there's more at play, that there is, in fact, the expectation that while Q4 may be a bit of a damp squib for quite a few of these entities, things will look up in the first quarter?
Morning, I think more than the expectation of inflation or inflation is a very important point, that the fact it is coming down. And with the rate cuts, the expectation is the growth would pick up, therefore. And loan growth for companies, for banks, that is, through companies, consumers, corporates, is far more a potent force driver, catalyst for the valuations and the growth of the companies. So as companies grow, banks grow faster, I think the valuations also are anyway good. So I think, therefore, financial services look good.
Picking, Chakri, yesterday we saw quite a considerable interest and seemingly from foreign institutions in a few of the very large banks. HDFC Bank gaining over 3% in trade yesterday. What would be your picks and selections in the banking space?
FI is returning is exactly for the same reason, that one word called growth. As the expectation of growth revives with interest rates cuts, all the various other factors that we just discussed. And then these are big banks. HDFC Bank has like a 13-14% weight in the Nifty, has like a 10% weight in the MSCI India index. And the company has gone through lots of so its cost of funds for HDFC Bank will also come down in this whole process because of the RBI cuts. And many of them are underweight HDFC. And so I think that catalyst is playing out for HDFC Bank.
Chakri, here's the deal. I mean, banks have started inching up. Good morning to you, of course, and thanks for joining in. And some of the suspect sectors which are going to come out with weak numbers have already corrected. Are you baking in a surprise, or in this globally fluid times, it's currently pointless trying to figure out where the price or the valuation might head, because what this quarter throws up might be materially different from what the next quarter throws up?
You're absolutely right. At this point in time, we don't expect companies to actually revise up their earnings expectations. Things are very fluid, both for importers and exporters. And of course, if you remove all the sectors like defense, electronics, pharmaceuticals, IT, that's a big chunk of the index. But all these are susceptible to what's happening in the global scenario, and therefore all these sectors are unlikely to increase their guidance. So the other sectors, if you add metals to it, they will also probably decrease their guidance. So net, I think overall there would be, as a result, if anything, a cut. And then as far as outlook is concerned, domestic facing company could probably sound a little bit more cheerful because of rate cuts, but any company which has, and most companies are. So I think guidance will be cautious.
Okay. So guidance will be cautious, and within that cautious guidance, watch out for companies which are actually giving out slightly more positive outcomes as well, because most industries would largely be cautious. Yeah, on Chakri, so much more to talk about. IndusInd Bank has given some data, and a financial hit of close to 1979 crore rupees from derivative accounting discrepancies against the estimate that the company had given, which is about 2100 crores. This is as per the report by PwC. Let's go to Harsh for the details of that report, because Harsh, as I read the brokerage notes this morning, it seemed that everybody was taking this number and the report a bit more constructively, in that there are no new skeletons that have emerged.
Absolutely, Neeraj. That is the key takeaway from this. There is some amount of comfort now that at least there is no downside risk at this point to everything that's played out. The derivative losses capped at around 2000 crore, or rather slightly shy of that number, 1979 crore, and the hit on the profit after tax will in fact be sub 1500 crore. The estimated number was 1580 crore. It's sub 1500 crore, and therefore likely in the sense that there's no negative per se, at least at this point, of coming out from that number. 2.35% was the hit on the net worth earlier estimated, currently at 2.27%. Most brokerages looking at this more favorably, as you correctly mentioned, from a perspective that at least there's no negative impact or there is no negative surprise, if I can call it, versus what has already been baked in or what has already been stated by management. Of course, now focus shifts with regard to leadership and how that possible transition, if at all, will happen, and when it will happen, and what's really the glide path on that count. But for at least the moment, it seems that we've put a lid on this one. Q4 earnings, as well as what the commentary comes out from there, will also be important. Stock flew away in trade yesterday. Will be interesting to see what happens today.
Yeah, 7% up yesterday, IndusInd Bank, but I was looking at the 52-week high. It stands at 1,550. So the erosion from that point is it's more than half, and quite a considerable drop. There you go. So the 12-month picture gives you that indication exactly. So we will get you a sense of what to do if you are still holding on to IndusInd Bank. But in the meanwhile, let's take you through the watch list this morning, and some of the stocks we've already spoken about, but they bear repeating before the start of trade. REDA, Tamanna spoke about this. Is earnings looked good actually. Profit rose as much as 49%. She did point out to you, of course, that the implications of the Gensol expose, if you can call it that, have not been factored in. They will likely be factored in the first quarter. Vedanta and Oil India both have gotten new blocks acquired in the latest OALP round. IndusInd Bank, the one-off impact estimate is revised lower to 1,979 crore rupees. We just spoke about that. ICICI Pru, the value of new business growth has beaten estimates for the fourth quarter, and that should be seen as positive. Landmark Cars as well, vehicle sales are up as much as 21% in the fourth quarter, and that bodes well for the company.
All right, some other stocks that are on our radar. Axis Bank is definitely one we're looking at. They will be considering a fundraise. Stock was up yesterday as well after they followed suit to other banks and cut their deposit rates. So we've already seen an uptick there. IGL, MGL though are on the negative side this morning because APM allocation has been cut further. Pharma companies, watch out for some pain there. US has said it will investigate pharma imports. And of course, Gensol Engineering, SEBI has barred promoters over fund diversion and has stalled their plans for a stock split as well.
Just a small point on IGL, MGL. I know that we've tagged it as negative, but then the update that I saw, of course, that updation on the cut in administered price was known. What I have highlighted when we talked about our stocks was the fact that it's going to replace it with new well gas, which might be low in cost, and so that might actually be looked at positively.
But largely, despite that, Alex, I think the initial impact will be negative because there is a more
So
negative than positive.
yeah.
So very likely the stocks will start off lower, but because it was discovered, maybe it bounces
That is the
back.
point that I'm making also.
Yeah, the other point is also to watch out for ONGC. Let's see if there is a positive for this.
Okay,
So it could be interesting.
Definitely, definitely. So all of those on your radar. Sudeep is with us this morning. Sudeep Shah, SBI, CAP Securities. Sudeep, very good morning to you. Are you seeing the Nifty take on and continue that strength today after a fantastic showing yesterday?
Good morning, Tamanna. Tamanna, I feel, yesterday 500 points, it's on the back of the global markets also turning positive, and largely the reasons were quite known to us, which is global now because of the Trump tariffs and everything being now delayed by 90 days. But now what I feel is that post this rally in the last 3-4 days from lows, now markets should ideally consolidate in this range between 23,000 on the downside, 22,950 and 23,550, 23,600 on the upside. This could be that 500-point range now in which markets could bide its time, see some consolidation. Although the mood will be positive, buy on dips would be suggested, but at a dip, not at a higher level post opening. So yesterday also, if we saw Nifty, it opened for 450, 470 points positive and largely did nothing for the entire day. The real action was there in the cash markets. So that is what we feel, that now the focus could shift to the cash markets, and we could see some kind of momentum being driven into the cash stocks.
So that's the index. Tell us about what you think about the Bank Nifty as well, Sudeep, because that's been in focus, and what I saw is that several key moving averages, it's trading above that at this juncture. And so does it hold is the question. It moved above 200-day, if I'm not mistaken, yesterday. So what are the key levels to watch here as well, and what are your picks this morning?
Morning, Alex.
Morning.
Alex, what I feel is here, Bank Nifty could be that shining star. And largely, we all know that whenever Bank Nifty performs well or underperforms, the market struggles by and large. And this time, in the last 2 to 3 days, Bank Nifty has outperformed. And yesterday, the reasons were not just global. It was the cut of the savings interest rate by HDFC Bank. And that propelled Bank Nifty to a newer high, at least on a 2-month basis. So what we feel is from here on also Bank Nifty could continue its pattern on the upside, and 53,300, 53,500 could be the levels which Bank Nifty could be eyeing at in the next couple of weeks. And on the downside, the support zone would be 51,700 now. So we feel 51,700, 750 now could become a decent base for Bank Nifty, and on the upside 53,300, 53,500 are the levels to watch out for.
And your picks, what are you looking at that is looking attractive this morning, Sudeep?
There are a couple of stocks now. The first one is from the defense stable, that is Mazgaon Dock. The stock was outperforming since March 2024, right from 1,000 levels to it moved to almost 3,000 levels. But thereafter, while the mid-caps were correcting, there was not a substantial correction that was visible in Mazgaon Dock. And with the first attempt, we have seen Mazgaon Dock now back to just 4-5% away from its all-time high. So yesterday also there was a decent move here, and we feel a breakout here on a long-term chart is quite visible. So from the current levels, Mazgaon Dock should be bought with 2580 as a stop loss, and the targets would be 2850, 2900 on the upside. The second stock that we like is 361 Wealth Asset Management. Now here, from the lower levels, we have seen a decent buying happening. And what we feel is the weekly charts also suggest a reversal from the current price junction. And this could be bought with a stop loss at 915 and a target of 999 on the upside.
Interesting. Sudeep, I was looking at the key movers in trade yesterday, and these two stood out as some of the strongest performers. Mazgaon moving up by as much as 9%. As well as 361 WAM, which has been moving up quite considerably over the course of the last week or so, if I'm not mistaken. There you go. It's up about 8.5% over the last month or so, and just 8% yesterday. There's a significant update coming through in the pharmaceutical space with the US Commerce Department now starting an investigation of pharma imports as part of a national security measure. What are the implications for Indian companies and the sector as a whole? Varsha is joining in to talk about some of that. Varsha, lay this out for us.
Thank you for that. So as you rightly said, Trump administration has started a formal investigation, when it comes to importing medicines and drug ingredients from other countries, just to see how much US is dependent when it comes to pharmaceutical and other ingredient imports. Now we all know that Trump have talked about when it comes to putting tariffs on drugs made outside the US. He wants drug companies to open factories in US, but experts say that this might not work. Moving drug factories back to the US would cost a lot of money and would also take a lot of time, like 4 to 5 years. Now it's not clear how long the investigation would last or when the planned tariff might go into effect, but he has started the inquiry under legal section 232 that he has used for other industries like cars and lumber. Now, if I were to talk about the India pharma exposure, the value of US drug imports was around $170 billion in 23, and India exports pharmaceuticals worth $10 billion to US, which contributes almost 6% of US pharma imports. Also, PII data also shows that US imports almost $2 billion of pharmaceutical products from China in 23 as well. Top pharma products exporting countries to US include Ireland, Germany, Switzerland, other Europe and India. While the key stocks which would be in focus on the back of this news would be Glenmark Pharma, Aurobindo Pharma, Dr. Reddy's, because they have the highest exposure to US, starting from 45% to 50%, and the Torrent Pharma has the least exposure of around 9% that may not be impacted as well.
Okay, all right. Thanks so much for that update, Varsha. Let's get Chakri's view on the pharmaceutical space. Chakri, I think a lot of people, there is a consensus that even for the companies that have exposure to the US, any tariffs or any action to increase the tariffs would be passed on eventually, and so they would be relatively secure. But what specifically would you be looking at when you talk about the pharmaceutical space? And here you can talk about APIs as well.
Sure. If you look at the companies we just mentioned, like Dr. Reddy's, who all have a 50% plus exposure. Now that's 50%. On that 50%, even if there is a tariff imposed, reciprocal tariff imposed on India, the hit translates to another 10% of that 50%. So if you translate all of that for the industry, Indian pharmaceutical exporters, the hit would be about 4-5% on their earnings. Now, so of that 4-5% hit, how much can they increase their prices by? Let's say 1% or 2%. So which means the net, the earnings would be down. The growth rate of earnings would be cut for only one time, about 2-3%. So taking all this into account, stocks have already kind of corrected. So even in the worst case scenario, I think that would be the impact.
Okay. Sudeep, a few big movers, not necessarily only pharmaceutical companies, but when this whole conversation on China plus one was being made, a few of the API companies as well started moving very sharply. Do you see any case for getting in at these levels, or do you think that if you had on the flip side, do you take money off the table?
See, I feel it's better now at these levels if we are getting say Cipla closer to 1530, 1550. Much better to book profits and wait on the sidelines and wait for a dip, because from lower levels, say a stock like Cipla has rebounded back from 1380, 1385, and right now what we feel is 1530 could be that resistance that the stock could be eyeing at. So we feel closer to 1530, 1550. One should look to take some profits off the table, book some partial profits, and wait for a dip to re-enter them.
Got it. Okay. Sudeep, Chakri, stay on. Much more to talk. We'll take a quick break. We'll be back and talk about some of the interesting potential movers of the session today. Stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Right, back with India market open and the implied open suggesting a start which is marginally lower. So you can live with that, I think. If it open about 100 points higher, right in the supply zone. In fact, speaking of supply zones, and Sudeep referred to some of that in his conversation. Let's get in Chandan Taparia. He's head of technical and derivatives research at Motilal Oswal Financial Services Johnson as well. Chandan, great having you as well. And let's start off with whether you believe that if we were to go higher, is that hitting a supply zone pocket and will we see selling at higher levels, or are you building a constructive stance currently?
Good morning. Thanks for having me. So the good part is that market managed to recover from lower levels by more than, I can say, 21,750 to 23,300 zone, roughly 1,500 points from lower levels. At the same time, India VIX, which was heading to 23 marks, cooled down to 16 level. So decline in the volatility with higher market base indicate that some sort of bullish bias could be there. However, we have seen a gap up opening in last 2 days and some supply could happen at higher zone. But I believe the higher base could continue to keep the market afloat at higher level. So I believe any small decline towards 23,000 could be bought. One can use the trailing support of 23,000 for an upside target towards 23,500 to 23,750. So after the price formation of last couple of days, I believe that buy on decline could continue as market managed to hold key moving averages. Support-based buying is happening in the selective financial name, and India VIX is cooling down apart from buying interest in the global indices.
Do you, Chandan, either on the Nifty or the Bank Nifty, do you buy today's very shallow dip, or do you wait for some more downside?
I'll buy the shallow dip, and I'll prefer more on the Bank Nifty with the view that Bank Nifty has potential to outperform the broader market and it can hit the new lifetime high earlier than the Nifty index. If I look at the price behavior, technically we have given a breakout from a bullish pole and flake patterns, which has the bullish implication. And if it manages to hold 52,000 for the day, even if it declines by 100, 200 points, then I think managing to hold above 52,000 can open the upside towards 53,000 to 53,500. So more bullish stance in Nifty Bank. And I believe till Nifty holds about 23,000, I can continue to use the buy on decline stance in the market as of now.
And what about your ideas for the morning, Chandan?
Yeah, so in last 2 weeks, we were quite positive on the banking, financial and consumption theme, including hotel and airlines, and most of the stocks have really done well. Now I'll shift my focus towards defense and selective agri, or I think monsoon related name. So in that we have positive on the Chambal fertilizer, positive on the UPL in the chemical space. So first is buy on UPL. Major trend of the counter is positive. It has given a consolidation breakout of last 45 trading session. It remained resilient even after the market decline, which also indicate the fresh leg of rally. So one can buy with support of 640 and UPL can head to a 685 level. Second trading area, there is buy on BDL, Bharat Dynamics, a positive price pattern. I think consolidation breakout of last 32 weeks invites the fresh leg of rally. So one can buy with support of 1370 and this counter can head towards 1460. So UPL and BDL from two name will be the preferred, which can rally by 3 to 6%.
Chandan, very good morning. Sometimes your implied open can be misleading and we may not see too much of an opportunity of buy and dips, but nevertheless, specifically, let me get your view on an IndusInd Bank. So some fundamental news today on what the auditors report, etc. says, but sharp move up on the stock yesterday. Do you see, some profit booking coming in today, or how do you see it on the charts?
So in Bank Nifty, I have more positive view on the SDFC Bank, ICICI, and Axis. IndusInd Bank has seen a consolidation breakout, but major trend is negative because in the last month the stock fell down sharply from 1,000 to 600, and those shorts are still intact. However, we witnessed some recovery on the last trading day, but again the hurdles are seen. So I think it would be tricky and risky to trade IndusInd Bank rather than picking other name like ICICI Bank and all. But yes, level concern 700 could act as an immediate level. So if manages to hold 700, then fire. Otherwise, hold below 700 could open the further downside of 8 to 10% in the counter in IndusInd Bank.
The sharp move up also you could see is in IREDA. Like we said, great numbers there. Some exposure to Gensol, which might not have been, counted in or provided for in this quarter, unless, the account is already turned NPA. But nevertheless, the numbers were robust. So you're seeing IREDA having a very smart move this morning. Chakri, would you buy an IREDA right now?
That space, whole space, IREDA, including Power Finance, REC, they all belong to the same sector. They all do infrastructure and power finance lending. As far as Gensol, I think it's like a very, very minuscule percent of the overall book, so hardly matters. Provisions are already made. It's fairly strong. But that as a power financing as a space looks exceedingly strong. So I'd buy, in fact, all the three companies, IREDA, Power Finance, REC.
Okay, so you'll avoid all three. Sudeep, IREDA on charts?
I would buy all three.
Oh, you'll buy all three.
Buy all three.
Okay, excellent. On charts, Sudeep, IREDA?
It's rebounding from an important support zone, which is around 150, 155 levels. And major part of 2024, April to June, it was consolidating in this zone before making that move to 300 kind of levels. And once again, from these levels, the risk-reward ratio is quite favorable. The downside seems limited. So yes, I guess with a positional perspective, with a slightly deeper stop loss of 152, I guess the stock looks good for 195, 200 levels in the next couple of months.
All right, so IREDA looks good. I just want to come to you, Chakri, on what Chandan said. He's shifted focus, as he said, to some of the monsoon plays, and he mentioned UPL and chemical names in focus once again, I guess. But do you think that there's enough information for you to go out there and say, finally now, it's time for you to deploy meaningfully long-term fundamental basis into some of these names, and which would they be?
UPL is a very inexpensive stock. Valuations are very attractive. This is a global company, and that has been the reason why the stock also corrected fairly significantly, because of the overall softness around the globe. Now, so the UPL looks fine. Now, as a sector, I think it's still early days, so I'd still stick to the easier ones like financial services, banks, NBFCs, defense. Those are far more cleaner, straighter plays than some of the agri or pesticide related companies.
Okay.
Or chemical for that.
Understood. Okay. All right, and we've already spoken to you about that. Let's talk about a financial name, in fact, and this is the big brokerage call of the day. Bernstein has come out with a note on Kotak Mahindra Bank. It has maintained its market perform rating. The target price that it is placed on the stock is 1,950. Harsh joining you to tell you why that is. Harsh, downside is being looked at by Bernstein.
Well, yes, 8% downside, in fact. So, sizable. What the concern that Bernstein seems to be pointing out and what they seem to have really picked up is that incremental cost of funds is the highest among peers, where the cost of funds for peers have gone up by less than 20 basis points, which is 0.2%. For Kotak, it's gone up by over 30 basis points. And while Kotak is garnering decent market share in that sense and therefore growth is strong, but they believe that this particular element will keep margins in check and will keep margins under pressure. In fact, they believe that the gap could widen, which could lead to margin compression for Kotak disproportionately higher than other private banks. Upsides also is what they highlight. Possible upsides, something of a downside of sort to whatever they are penciling in. Sharp rebound in consumer credit demand, a prolonged tight liquidity environment, structural shift to permanently lower CASA ratios across the sector. Any of these three or all of these three could well aid Kotak Mahindra Bank because it will outperform in these scenarios. But outside of that, slightly tepid note coming on a day otherwise where banks have done well yesterday at least. So, and hence this one is relevant.
Kotak Mahindra Bank on watch. ICICI approved, doing okay in the pre-open session. Watch out for reaction to results as well. ICICI Pro and IREDA, both in that space. In fact, let me come to Chandan on that. ICICI Pro, IREDA, if you have a view, and Trent as well, Chandan.
So I'll start with IREDA. The stock is really bottomed out, technically speaking, rounding bottom and double bottom kind of formation on the weekly chart. It surpasses falling supply trend line and surpassing its 50-day exponential moving average after 62 long trading session. We have seen a surge in the trading volume, which also indicate the positive momentum. So I believe positive bias could be there. Stock is bottomed out and Nifty CPSE index is also doing well. So with support of 163, I believe 185 to 190 kind of target could be there in IREDA.
There is a fundamental and a technical consonance on IREDA, PFC, REC per se, IREDA in particular, but I think Chakri mentioned that he likes PFC, REC too. So bear those stocks in mind. The other set of stocks that we need to watch out for are the IGL, MGLs of the world and ONGC in that regard. And just want to pull up, it's about 7 minutes done, so we're very close to the pre-open rates getting settled down. Likely that IGL, MGL start off lower, MGL in particular about 5% lower. I wonder if ONGC is actually doing the opposite. Interesting note. I think these will change, but okay, flattish start, nothing too dramatic in such a scenario. Now, Chakri, I don't know if we spoke about this or no, but I'm presuming we haven't, and which is why my question to you, now that the price action is visible here, this APM gas allocation being cut, so on and so forth, some bit of damage in prices has already happened beforehand, now further damage. Is it baking in the negatives of such a move, or increased regulatory action would keep you away from this bucket?
Absolutely right. The regulatory action will keep us away because prices, volumes, everything is subject to regulatory oversight. And in such an environment, it becomes difficult to forecast what the earnings would be. And in such a volatile environment, there's enough other stocks and other sectors that's available, so we'd stay away.
Okay, let's try and let's bring in Somit, of course, to try and understand fundamentally what is the earnings impact on this. And Somit, I don't know if you have it handy, but I'm still going to ask this to you in case you can tell us. The valuation multiples for these businesses, have they contracted over the last 1 year meaningfully enough?
Yes, I don't have the numbers handy, but yes, the valuations for the city gas distribution companies have contracted right from October, when the first APM gas allocation cut had started, because the profitability scenario changes for all the city gas distribution companies, given the fact that now the cheaper gas is getting replaced by somewhat expensive gas. So yes, the valuation multiples have contracted, and this recent allocation cut was already indicated by us on Friday, April 11th, and that is what has come in pretty much in line, 20% cut in the APM gas allocation. But this time the positive announcement that has come in is that the notification clearly says that this reduction in the APM gas allocation will be fulfilled or will be replaced by new well gas. Unlike last time when the APM gas allocations were cut, city gas distribution companies had to rely on more expensive spot or Henry Hub or oil linked gas contracts, because of which the margins had taken a hit. But this time they will be getting the new well gas, which is just $1.3 per MMBTU expensive as compared to the APM gas price, but way cheaper when compared to other gas like Henry Hub, oil linked gas, difficult field gas or spot LNG gas. In fact, when you compare it with the spot LNG gas, new well gas is cheaper by nearly $7 per MMBTU, and analysts believe that if IGL and MGL are able to fully replace this shortfall in APM gas by new well gas, then their margins could improve sizably. Another positive point that has come in for IGL is the fact that IGL in their notification has clearly stated that the new well gas allocation will be 125% of the APM gas. So this will help them to replace the APM shortfall much quickly as compared to other players.
Okay, that positive perhaps will take some time to bake in, because right now the immediate impact will be seen as a negative, and you could be seeing that just as the markets open today. Just very quickly, your pre-open rates have settled. You're looking at perhaps a flat start if you look at this as an indication, if at all, but maybe not in the negative. I'm wondering, Chandan, would you still buy an HDFC Bank after the run-up? It's already seen. Are you seeing more upside there? Because you said you like the Bank Nifty, you said you like ICICI, but specifically on HDFC Bank, because that was, in a sense, the start of the day yesterday.
Yeah, so I'll continue to stay bullish on HDFC Bank, and I believe a small decline could be bought here. Looking at the data setup, 1900 call unwinding started to witness, and I believe this time this stock can outperform and head to the new lifetime high. And I believe the lifetime high is 1880 and is already hitting to those zones. So very positive setup and sentiment. And I think because of the positive momentum in HDFC Bank, Bank Nifty has all potential to rally towards lifetime high of 54,000. I'm talking about 1500 points, that is 3% movement in Bank Nifty itself. So positive on the HDFC Bank with support of 1830. One can continue to drive the move towards 1920, 1940 levels.
Okay. Chakri, I'm not sure you got this update from Sanofi. It's only up about 1% or so, but there was this buzz about the sale of its insulin drug, and the fact that it's not coming through. It's made a clarification saying that it's not selling it. Are you positive on Sanofi India?
Sanofi, if this information is true, then it's kind of positive because it keeps the earnings trajectory intact. And as a disease category, it's a very important category in India, diabetes, that is. And given that its growth vectors for the company are fewer, diabetes is an important segment. So therefore, I think net the information is neutral.
Okay. What about some of the pharma counters, Chakri? I want to come to you. Let's look at a Sun Pharma. Let's look at a Dr. Reddy's. Our colleague Varsha did a detailed piece on, if we have an impact and what kind of an impact we might have because of the latest comments coming in from the United States. Would you say that this is a space which continues to be a little risky with all the uncertainty around us?
Indeed, in terms of, there is an uncertainty. We do not know the numbers, as in we don't know the tariffs that will be imposed on the Indian pharmaceutical companies and all the pharmaceutical companies around the world. But there'll be very tiered pricing because, big cap pharma, that is in the Merck, Eli Lilly's of the world, will have very different tariff rates than generic. But net, it's probably a 2, 3, 4%, not more than that. But given the uncertainty, I don't think it'll be a very volatile trade, but not much downside either.
Okay, let's get quick last calls. Chandan, I'm going to start with you. One stock call after the pre-open session has settled.
So I think I'll continue to stay bullish on name where I mentioned, and here I can pick counter like BDL, Bharat Dynamic Limited. I think fresh breakout could be there if small follow-up happens. So one can continue to stay bullish on the BDL with support of 1370, looking for a 5% move in the counter towards 1460.
1460, Bharat Dynamics out there. Chandan, I'm sorry if I missed the stop loss. Do you want to give a stop loss for that as well?
Yeah, 1370.
1370.
Yeah.
Okay, perfect. Well noted. Thank you. Sudeep, I don't know if I missed your top idea, but if I have one top idea, very quickly.
So that I've mentioned, I feel within the banking space, Axis Bank looks good and could be bought with a stop loss of 1100 and a target of 1150, 1155.
Okay. Well noted. And remember, on Axis, viewers, there is a fundamental reason, if you will, as well, a fundraising meet on the 24th, if I'm not wrong, of this month. Typically, fundraising augurs well. A successful fundraise augurs really well for the stock price of financials, brings down the book value accordingly, or takes the book value up accordingly, and therefore helps the price to book multiple. But here's how markets are starting off. Flat as flat can be, but banks, again, doing much better than the rest. Nifty IT still down nearly 1% really. Quite a strong start, reaction on open itself for the IT on a flat day for the markets otherwise. Mid caps flat, small caps flat. Let's get the heat map up on the screen and see which IT stock is dragging it lower. Infosys it is, 1.5% lower for that one. We see HCL Tech being down about 1.5% as well. Maruti, Tech Mahindra, Eternal, well, for the first time that I'm spotting the name Eternal on the heat map here instead of Zomato. But yeah, finally done on that front, but down effectively. Tata Consumer, Tech Mahindra, Wipro are amongst the others. So essentially IT is down, Reliance is down from amongst the large caps, and which is, and a lot of red, little green. HDFC Bank is thwarting Reliance's downtick with about 0.5% uptake, which helps and which explains the strength in the Bank Nifty now, 0.75%. ICICI Bank and Axis following suit. iShares is the top gainer. Watch out for Shriram Finance and Apollo Hospitals amongst the others. But on a very flat day, there's a fair degree of red, I must say. Had it not been for HDFC Bank's strength, the Nifty might have been a lot lower.
It's looking like a bit of a tough morning, a bit of a pullback there. Remember that the triggers of positive news from the tariff pause, etc., have all been baked into yesterday's trade. So nothing fresh to go on for. The CPI data was good. China GDP also not as bad as expected. But if you look at the broader markets, India VIX also just about 3.5% down. So nothing alarming or noteworthy. But if you look at the broader markets are relatively okay. The Midcap 150 at least in the green at this point. Though mildly so, small cap 250 also in the green. Let's pull up the sectoral heat map just for a second and show you what's happening there. It's the interest rate sensitives that are moving once again for a second day in a row, although much tapered down. Nifty Realty was the top performer in yesterday's trade, continues to be today as well. Nifty PSU Bank, Nifty Private Banks, Nifty Banks, the whole BFSI. The whole top row is all about BFSI and Realty. Small cap 250 not doing too badly, but the rest is a sea of red. Nifty IT continues to be a pain point and nothing really to save it there. Wipro numbers will be out today after market hours, so expect some pain there as well. Nifty Auto continues to sulk, as does Pharma. Pharma joins the pity party after the Trump administration has said they will probe whether imports which are exempt from tariffs right now really need to be or not. That's the long and short of it. So you have the Nifty Pharma also in pain, as are oil and gas stocks. But let's look at specific stocks. And I want to pull up the impact of results that we've seen this morning. IREDA, ICICI Pru, both of them we'll look at right now and just see what's happening there. IREDA, remember, stellar numbers. The quarter has been fantastic for IREDA. Yes, they have a bit of a hit on their books from Gensol. Has that been baked in or not is a question that we would love to ask the management when we get a chance to speak with them. But the stock about 5.5% up. There's a thumbs up on our list this morning. ICICI Pru about 3.5% up as well. Gensol is really stock of the day for all the wrong reasons. It's on a 5% lower circuit. It would be even lower if there was an opportunity for traders to dump this and for investors to dump this. A whole litany, laundry list of frauds that SEBI has found. IGL, MGL will feel the pain because of APM allocation. Not that bad for IGL, actually, about 1.5% down. MGL about 4.5% down. IndusInd Bank, on the other hand, auditor has submitted its report. Is that a headwind behind them because the amount of hit from the derivatives accounting issue is actually slightly less than what the management had provisioned for, and that will show up in this quarterly number. Stock is pretty much flat actually. ABB, I wanted to pull up. They've revealed an annual plan which is not half bad. It talks about their focus on high growth areas. The stock about 1% up, but it's a bit of a tepid day, I would say. Alex, nothing much happening this morning except banks holding it all together.
Certainly, and I was actually looking at one stock that you highlighted, which is ICICI Pru reacting to earnings, and on the other end, ICICI Lombard from the general insurance space losing ground. So pull up those two if you can, possibly one after the other. ICICI Lombard about 4% down at this point on the back of earnings. ICICI Pru on the other hand, on the back of better than expected value of new business and expansion in the margins as well on a sequential basis in the fourth quarter, looking reasonably good. I want to come to you, Chandan, on both of these entities, right? So if you haven't gotten into ICICI Pru yet, do you see an opportunity, and what would you do with something like a Lombard?
No, ICICI Pru has bottomed out after the corrective move of last almost 7 months. It has seen a corrective move from 800 to 525, and now after the multiple attempts, it has bottomed out on the daily and the weekly chart. In fact, it surpasses falling supply trend line and some risk reward ratio favors for the bullish resistance in the counter. It formed a higher base on the mechanical indicator, which also indicates some recovery in the counter. So I believe it's support of 570. One can go for buy on decline stance, and this counter can attempt to 610, 615 levels.
Okay, Chandan, thanks so much for that view, and in fact for all of the information and views that you shared today. Pleasure having you as always. All right, I'm wondering, Chakri, what you made of the numbers for ICICI Pru. Lombard also came through and it's reacting very negatively, understandably so, because it's not the best quarter. But ICICI Pru, while the fourth quarter looked good to a lot of people, FY25 as a whole, perhaps it was a bit of a miss, which is something that brokerages have pointed to as well. But the street looking at it positively. What would you focus on here?
You know, the new business grew, but I think whether it's sustainable or not remains to be seen. And there is a slowdown in the ULIP business. Now, the ULIP business, again, the margins are very iffy. So, you know, with all that, the growth, the new business growth going into next year might actually kind of taper down. Against that backdrop, or rather slightly very muted. So against that backdrop, I think, you know, we stay away from ICICI Pru.
Okay, just a couple of more stocks we want to highlight. JBM Auto is one of them. Delhi is going to look at full fleet electrification. That stock up 8%. In fact, I don't know if it's too early to pull up the intraday, but that stock has definitely seen a spike. JBM Auto in focus. So is Max India. They will be fixing a record date for a rights issue. Yeah, JBM Auto having a good morning. So is Max India. So that stock now 7% up. So both in focus. Sudeep, any of these that you're tracking? Let's start with JBM Auto.
If you see JBM Auto and even Olectra, now both these stocks from the lower levels have seen some kind of base building activity happening over the last couple of months. 550 for 600 zone. JBM Auto specifically has this zone in the past also acted as a breakout point, and once again this has acted as a support this time around. But given the fact that the trend in these stocks over the last 3 to 4 quarters have been quite steep on the downside, I feel this is just a pullback from the current levels, and this pullback could continue probably up to 730, 770 levels on the upside, and then there could be some resistance. So yes, from the current levels, if someone is holding it, this can be held with a stop loss at 635 on the downside, and the stock could continue its rebound rally up to 730, 750 on the upside.
Okay. Pull up the PSU banking index. It's up about 0.8% in an otherwise tepid session, and a few of the smaller banks are moving smartly, if you can call it that, today. Bank of Maharashtra up about 2.5% or so at the high point of the day. You have UCO Bank, you have Central Bank, Bank of India. So while the Bank Nifty as a whole is up only, 0.4% or so, You have a few of these public sector banks that are moving pretty sharply. Sudeep, some catch up at play right now?
Yes, see, if you see the PSU bank index itself, there is some catch up which is happening, and within the PSU banks, I feel while we are talking about these smaller banks, maybe UCO, Bank of Maharashtra, and those names, but my sense is that while the pullback is underway and we're seeing Bank Nifty outperforming, stocks such as say Bank of Baroda, PNB, or for that matter Union Bank, they should be preferred ahead of all these names because these are the stocks that have delivered results. Now, case in point, Bank of Baroda, Union Bank, they both have had good quarters. Last couple of quarters, the numbers have been good. And in the first attempt, if you see the pullback also in case of Bank of Baroda from the lows is quite sharp. So that means that the first money which is pouring into the PSU bank index, these stocks stand as beneficiaries. So what I feel is Bank of Baroda, Union Bank, in that order, pecking order, can be added on dips from a medium term perspective.
So, Chakri, do you like, for example, something like a Bank of Maharashtra, which is the leader of the pack today, and I think a lot of other fundamental watchers have also pointed to Bank of Maharashtra because of the quality of its book as well, and the fact that it is reasonably fast growing as well. Do you like the bank, and do you like anything, in fact, in the PSU banking pack?
We do like PSU Bank, and as Sudeep just mentioned that, the earnings results for the last couple of quarters have actually been improving. So that places the banks well in terms of, as the interest rates get cut, the economy revives. These are the first banks which will benefit from that. Canara Bank, Bank of Maharashtra. These companies are trading at valuations aside, which is very, very favorable. The growth, these guys will see the first benefit of growth coming to them because, when corporate capex comes up, government capex kicks in, these are the first beneficiaries of that move. So Canara Bank and Bank of Maharashtra.
Okay. All right. Let's just get a quick call on IT. And we've already seen the meltdown happening, Chakri, ahead of Wipro today. Are you seeing any kind of redemption here for the IT pack? What would you advise people who are sitting with IT stocks in their portfolio? It has recovered, by the way. The Nifty IT has recovered in the last few minutes compared to where it started. So the intraday is not looking half bad. But nevertheless, ahead of Wipro, is there a position that you would take it all?
And I think Wipro's number are expected to be kind of soft. Not showing much growth. So I think that's a dampener for the stock in terms of its outlook, and margins at best at around that 17% are likely to remain flat to down. So given all this, wouldn't really buy a Wipro. And IT in general, I think given that the overall uncertainty on discretionary spending remains, we would still be underweight that sector, whether it's TCS, HCLT, all the frontline, and we would be underweight.
So, I'm seeing recovery markets overall. We just talked about Nifty IT. Look at TCS. Pull up the intraday chart of TCS. That's what's lifting up the IT pack as well as the Nifty. I assume sharp up move. They're about 0.5% up now. Let's also get the Nifty intraday up as well as Nifty contributors. So some improvement there after the sharp dip after when we just opened shop for trade today. Bank Nifty continues to be, I won't say sizzling, very definitely not, but star of the show in relative terms is the Bank Nifty and HDFC Bank today. So some strength coming in from there. Apart from banks and financials, so what is the one top call that you're seeing after about, we've seen about 10 minutes odd of markets being open?
See, if you see within the cash space, while the markets are recovering, but within the cash space, we already discussed on JBM Auto, and this one stock, Keynes Tech. Now, Keynes Tech also, if you see the last several days, we have seen a strong pullback from lower levels. And we feel that here the trend is returning back on the bullish side. Although the stock had a sharp cut from 7,500 to almost 4,000 and below that zone. But the way stock has pulled back, we feel that now from a positional perspective, we could see some kind of a strengthening of trend here. and the stock could head towards 6100, 6200 in the next couple of months. And the support for the same would be 5500 on the downside.
Okay, and do you want to give a revised Nifty call? We're in the green now on the Nifty as we speak. We might see some strength coming in the next couple of hours.
Absolutely. See, while early morning also, while we were discussing about Nifty, we had recommended that dips should be used to go long and not to chase the rally. And we got a decent dip closer to 23,290, 23,300 zone. And we feel with 23,250 as a support, this rally could extend up to 23,400, 23,430 for the day. And largely it could consolidate here and plus minus 50 points.
Okay. So Nifty was an opportunity to buy the dip. Thank you so much. Sudeep and Chakri, have a great day. And thank you for joining us on the show. We turn our attention to our corporate conversations, and India is all set to come out with a fresh target of 30% for ethanol blending by 2030. We're going to be catching up with the management of Shree Renuka where we discuss this and more. But let's first go across to Mahima, who had that conversation, to set it up.
Right, so it's not official yet, but reports suggest that India is set to raise the 2030 ethanol blending target to 30% from 20%. Now, in terms of as of where FY25 stands, India has already achieved 20% blending in March 2025. So far, how ethanol blending has taken place, where average blending stood at around 12.06% in FY23, which went up to 14.6% in FY24, and average blending as of February 2025 reached around 19.6 and then crossed that 19.6 mark to around 20% mark soon after in March. Now, in terms of financial year 2023 to 2024, total ethanol blended reached around 7.07 billion liters. So this is the overall context of the conversation, and of course the entire sugar industry has, in fact, even Shree Renuka's management has indicated that they have the capacity to do this, but raw material remains a big constraint right now. So this is the overall view as to how ethanol blending target of 30% 2030 may pan out.
Okay, thank you for that, Mahima. And in fact, that's part of the conversation that she had with Atul Chaturvedi, Executive Chairman of Shree Renuka Sugars. Listen in.
In fact, my take was that, or rather our understanding was that Niti Aayog was actually working on 25% blending roadmap. But now what we are seeing in the press reports is that the government is targeting 30% blending with petrol by 2030. I'm sure it is definitely a challenging target, because if you really look at it, even Brazil, which has been blending for a very long time, they've achieved only about 27% as of today. But if you look at Brazil, they've already introduced flex fuel cars and 100% ethanol cars running on ethanol. So that, I think, India will have to probably spell out the roadmap for that. And as it is, there's no reason why India should not be in a position to achieve this. But having said that, the sugar sector can possibly only give about 7 odd billion liters of ethanol. And at 30% blending, our back of the envelope calculation tell us that the requirement for the country could be closer to about 15 billion or 16 billion liters of ethanol. These are only ballpark numbers. And to achieve that, you need a massive supply from the maize or the grain sector. And our back of the envelope calculation tells us that the grain sector, or maize in particular, will have to chip in with closer to about something like 25 to 30 million tons of maize needs to be diverted. But that's a tall challenge.
All right.
And having said this, using maize for ethanol brings with it its own challenges. Like, for example, one of the byproducts of maize distillation is DDGS. And DDGS is actually dampening the demand for soya meal in the country big time. So soybean crushing can get affected, and with the farmers getting better returns from maize compared to soya. So I think the oilseed sector, in particular the soybeans, could be in serious trouble going forward.
Okay.
Yep.
Okay. Interesting. Mr. Chaturvedi, I also wanted to understand with respect to the sugar industry specifically, capacity. I knew that a lot of players in the sugar space had already ramped up with respect to their capacities to achieve that 20% blending mark. But now that we have achieved the 20% blending mark, I want to understand as to where the capacity utilization stand at. Do you think we have enough capacity right now to accommodate that 30% as well? Or do you think that we will have to make more capex infusion in order to achieve that 30% blended mark?
Now, you must understand that the sugar industry possibly at this point of time can only supply a maximum of about 7 billion liters. But having said that, it requires a massive amount of feedstock, and that kind of feedstock I don't think is available as of today. So willy-nilly India will have to use both cane juice and B-heavy supply from the sugar sector as well as from the grain sector. So I think both will have to go in tandem, and expanding the capacity from sugar distilleries is possibly not the right answer. What possibly the sugar industry would be doing, and they've already started doing, is to convert these units into dual feed. So when the season is there, you use cane, and when the off-season approaches, you use maize, because the same distillery can actually handle both. So you would possibly see capex in the form of having dual feedstock. So that is a distinct possibility, but not in ramping up the capacity as it is. So I think adequate capacity is already available in the system.
Got it.
What is now required is the feedstock.
Understood. Yeah. Understood. And Mr. Chaturvedi, we have been talking about achieving certain amount of blending capacity by 2025. Now we are saying that we'll achieve 30% capacity by 2030. But do you think that the demand for blended ethanol is present in Indian markets? Because we are seeing that the EVs, the CNG cars are also growing at similar pace. So do you think that the 30% blended once achieved will have equivalent demand?
No, I don't see any problems as far as demand is concerned, because oil marketing companies, it's a very regulated sector. So what is available at the petrol pump is what is going to be filled in your car. So I don't see any problem on that front. But definitely in remote areas like Northeast and all, it's a bit of a challenge in terms of logistics. But I think India has the requisite capacity to take care of that. So I don't visualize any problems in terms of demand. Demand is definitely very strong. But the only thing is that with Mr. Donald Trump in the hot seat in White House, and with his motto of drill baby drill, if the petrol prices keep plummeting and start moving southwards, so maybe that might affect ethanol play going forward.
Okay, understood. And Mr. Chaturvedi, once that sugar companies start blending ethanol and try to achieve that 30% mark, how does product mix change for something like a Shree Renuka Sugar? And then how does that impact your overall margins?
No, surprisingly this year, with the lower crop, in fact, the returns from sugar have been marginally better than the returns from ethanol. And the sugar industry was anticipating that the government would revise the price of cane juice and B-heavy ethanol upwards. And we were quite hopeful, but that did not happen. So the gap between maize ethanol, which is closer to about 72 rupees a liter, vis-a-vis cane juice ethanol at 65, or B-heavy at about 60. So that is actually discouraging the sugar industry to divert more and more cane juice towards ethanol. I'm sure this aberration would get corrected in due course. And once that happens and ethanol from cane starts giving you better returns compared to sugar, so you would have more diversion happening. This year, if you really look at it, we were initially anticipating 4 million tons of sugar getting diverted towards ethanol, but now our back of the envelope calculation tells us that only about 3.5 million tons might actually get diverted. And that is also largely on account of a lower crop this year, because the crop this year actually was almost 20% lower than what it was last year. So hopefully next year, with the good monsoon being predicted, the crop numbers should bounce back, and the sugar sector should be in a position to offer much more ethanol next year.
Right. All right. And, one last question, Mr. Chaturvedi. Where do you see Shree Renuka playing its role in terms of this ethanol blending, and what are your forward plans with respect to where ethanol blending is concerned?
As far as ethanol blending is concerned, Renuka is at the forefront, and our capacity utilization as far as the ethanol is concerned is absolutely spot on. In fact, during the season time, we've been running at about 125% capacity as far as ethanol is concerned. And we are seriously evaluating a dual feedstock capacity expansion. So that is definitely something which is being evaluated very, very seriously, because Karnataka, where most of our distilleries are located, is also growing a lot of maize. So we are seriously evaluating that as well. So I think going forward, there's no reason why ethanol should not continue to be playing a major role as far as our overall revenue mix is concerned.
All right, so that was Shree Renuka Sugar. Let's talk about real estate and commercial real estate for a second. The real estate index, the realty index, is the highest gainer for second trading session in a day. And according to a Collier's Office Leasing Trends report, these leasing trends have improved in 2025 so far. Will this change the scenario in India soon? We're having that conversation with Office in just a sec, but Anushi joining us first to give us details of the report.
Right. So if you look at the office leasing trends in the first quarter of this 2025 that we've seen about a 15% of a growth at 15.9 million square feet. This is the trend that we've seen across the top 7 cities which are there. Bangalore and Delhi NCR together driving about half of the total leasing demand that is there. Also vacancy levels were down about 120 basis points to 16.2%. And this demand that overall we are seeing is led by the technology firms, with them contributing about 32% of the conventional leasing share in sync, followed by BFSI as well. If you look at the gross absorption levels versus supply share, Bangalore and Pune are some of the key markets wherein we are seeing at high levels of supply share compared to the other cities as well. In terms of where the leasing trends are concerned, conventional spaces contribute about 86% of the mix, while flex spaces contribute about 14% of the space. What is interesting is also in the size of deals. We're looking at 1 lakh square feet, more than that, contributing to about 58% of the volume share which is there. So interesting data set. Office trend, something that we've seen a pickup in the last few quarters or so. What's the outlook forward is something important to watch out for.
Okay, so these are trends as of Q1 2025. So a lot has happened, of course, since then. Amit Ramani joining in, Chairman and MD of Office Space Solutions. Mr. Ramani, thank you so much for your time with us this morning. Let me start off with saying that I'm just wondering that the kind of, I won't call it slowdown, but lack of expansion that we're seeing in the IT hub of Bengaluru, because I know it's a key market. What is the impact that you are seeing right now? And are you seeing the outlook for commercial leasing improving as we go along?
So, Tamanna, last year was one of the best years in our history, right? We did gross leasing of almost 80 million square feet, out of which almost 20% of it was flex. So clearly, I think the outlook for the overall real estate market is extremely positive. in my view, we are one of the least commercialized markets in the world. And I think the commercial real estate market, in my view, will continue to grow. You can clearly see that, 120 basis points reduction in vacancy. Places like Mumbai are down to about 12.5%. Vacancy rates is probably the lowest. Some markets are today running at almost negligible vacancy availability. So I think overall, as the urbanization of India continues, as the GCC market continues to bloom, as multinationals continue to expand into India for their global capability, IT outsourcing, India facing IT as well, I think the sector will see very, very positive trends.
That's all true, and I would say that's as true as it's ever been 3 months ago. I don't know if it continues to be that true right now, Mr. Ramani. That's the sense I'm trying to get. With everything happening around the world, what is the trend you're seeing? A lot of these MNCs, maybe American companies that want to set up shop or, open outposts in India to start off with, that may be potential clients. Are you seeing a bit of wavering there?
So, Tamanna, we are not seeing any wavering. I think last year, in a single year, we sold close to about 54,000 seats in a single year. The trend continues. The first quarter has been very, very strong for us. And, we continue to see the expansion of all the multinationals. As you saw, almost 60% were 1 lakh plus deals in the market, right? Which tells you that people are looking for a long-term commitment to the India market. Rentals are up at $105 per square feet, 7.5% up. So all of this is showing very, very positive signs. Again, in the short term, I completely agree with you. There is a bit of uncertainty. I don't know where all of this tariff situation will lay out in the next 60 to 90 days. But clearly, I think on the ground, we are not seeing any changes. In fact, companies are continuing to expand as we see it today.
Mr. Ramani, good morning. Neeraj here. The fears of AI eating into the growth rate of global capability centers, do you sense murmurings, rumbles, conversations around that with your clientele, if you will?
So, we do a lot of business with ITITS clients, right? And I think almost 66% of our business is with large corporates, out of which about almost, I would say, half of it is with ITITS companies. And I think today, both in what I would say is complicated IT tasks, which would be, AI tasks being done in India. I think India, after the US and China, is the third largest market for AI expansion happening in terms of work being offshored here. We, out of the last, 45 odd GCCs that came to India, we have partnered with almost 8 or 9 of them today. All our ITITS clients, even the ones which are purely in the voice business, the BPO voice business, are continuing to expand. In fact, are growing their footprint. So I think, again, AI has a place. I think it has an impact. I think it has a positive impact. But just like the internet, which came about 25 years ago, and kind of people said that the jobs will go away. I think people have coexisted with internet and humans working together. I think similar things will happen with AI. Human beings and AI will work together to create a better world, to create a more productive world, to create a better outcomes for human beings in general. So I don't think it's going to take away jobs, but I think it's only going to expand the opportunities in India.
Okay, so one was the GCC one, but your answer gives me an outlet into the next question as well. TCS hirings were arguably, when they came out the results, and were the lowest in a really long time, if I'm not wrong. Are ITES space outsourcing, or if I can use that term, space sourcing from you, is that pace slowing down? It may be all good in the long term, Mr. Ramani. I don't think anybody has an answer, to be honest. It may well be completely how it's been in the past. In the short term, is there stress?
So, Neeraj, I will talk from a commercial real estate and flex, because I am a biased party, right? And clearly from that standpoint, right? So if you look at the whole return to office, It's only in the last 6 months that companies have come out with clear strategies to say that we want to come back to work, or you have to come back 3 days a week, or whatever is the strategy that they've adopted. But now it's clear, either it's 3 days or it's 5 days, right? And to that end, companies gave up large amounts of real estate. Almost 30 to 40% of their real estate was given up by large ITs companies. So even when they want to come back, they want to bring back people even 3 days or 5 days a week, they're taking up space from us, right?
Okay.
Because now they don't have enough space that they're given up during the last 4 years. So overall, that's the reason that you see commercial real estate not getting impacted, even though ITs companies might be seeing a bit of a slowdown.
Interesting. Well, I understand you would be in a silent period, so won't probe you on a lot of numbers. Maybe we'll get a chance to do that once your numbers are out. But this short conversation, Mr. Mani, was very helpful, because maybe it just says that a lot of fears are in the minds of the people. In reality, after a 3 to 6 month hiatus, things might improve. So thank you so much for these insights.
Thank you, Neeraj.
Well, that's the view from office, and well, some good insights there, really. But obviously, we can't ask him too many numbers because they will be in a silent period. What we can ask numbers to is ICICI Lombard reported a 39% YOY increase in net profits. We caught up with the company's CFO, Gopal Balachandran, about what led to these numbers. Listen into a slice of that conversation.
Let me put this in context. I think we have always spoken about ICICI Lombard's growth in the context of where the market is. And there, which is where if you would see on a full year basis, the industry growth was roughly about 6.2%. And against that, ICICI Lombard's growth, I think we had an outperformance of almost about 210 basis points at 8.3%. And this is a beat across segments, whether you take motor, whether you take health, whether you take commercial lines. So again, pretty much all the areas of focus that we have spoken about, even in our past earnings call, I think we have had a clear outperformance vis-a-vis the market. So that's where we are in terms of growth. To your point on loss ratios, I think the way we always have looked at is end of the day, what does it translate to? Because different businesses exhibits outcomes in terms of claims and cost of acquisition. So hence, a better metric that we have kind of largely focused on is both the combined ratios as well as the return on equity that we're able to exhibit to stakeholders. Again, if you look at the combined ratio on a full year basis, last year full year combined ratio was roughly about 103.3%. This year, if you would have seen, our combined ratios are actually down to about 102.8. And even on the ROE front, I think last year we kind of roughly delivered an ROE of close to about 17%. And this year our ROEs are slightly in excess of 19%. So all in all, I think we had a great year in terms of how things have played out. And this has largely been consequent to our brand, service, technology. And the sense that we get is, I think, obviously we're kind of heading into the next year with a lot of positive optimism.
Point taken. Let me talk a little bit about vehicle first, motor, because that's been your mainstay for a very long period of time. What's happening there, both in terms of pricing as well as in terms of rural? There seems to be concerns on both those fronts.
So again, let's put this in context. I think if you look at motor, it's not that it's been a bad year. I think clearly if you look at the vehicle sales volumes that have happened for the full year, whether you look at private car, whether you look at two-wheeler, and even if you look at it in the context of commercial vehicles, I think we had a decent year that had kind of gone by. And in that context, when you look at the beginning of this year, obviously from an insurance context standpoint, what we had expected was obviously a lot more semblance to play out in terms of competitive intensity. But when you look at the 9 months reported industry numbers on the motor combined ratios for the market, that has actually seen an adverse development from almost about 118% to 123%. So obviously in times when we see the market getting a lot more competitive, whether it is in terms of pricing or whether it is in terms of cost of acquisition, then from an ICICI Lombard standpoint, we start to take a bit cautious approach. And that is why if you would have seen, particularly in Q4 of this year, I think our growth in motor relative to the industry numbers have been, in that sense, slightly muted. But if you look at the full year, I think we again had an outperformance on motor because clearly in the initial few quarters, we had a great outcome. But in terms of how do we see things playing out, I think two aspects. We will obviously watch for in FY26 one of the key developments which the regulator has kind of laid down, which is to make sure that companies which are in exceedance on the expense of management thresholds, they will have to make sure that they come within the limits on the guidelines that has been laid out. So that will be a key deliverable. And as and when that starts to happen, then clearly the market will get far more sensible. And therefore, to that extent, the competitive intensity on pricing, specifically in the context of motor, should also get a lot more getting eased. So that's what we would kind of wait for. In terms of how things could play out in terms of volumes, again, if you look at, I think, both the regulator as well as the governments, I think they've done a great job. For example, the budgets this year clearly have helped a lot many more individuals to have a higher disposable income consequent to some of the tax cuts that was done. And two, RBI in their very recent policy decisions have clearly shown signs of a lot more easing insofar as interest rates are concerned. And therefore, to that extent, there could be a lot of demand that could start getting created on ground. So on balance, I think we believe there's a lot more potential that motor policies can get exhibited at.
Point taken. Mr. Balachandran, I want to understand what's happened first half of the year versus second half. That's left a little to be desired from a pricing standpoint on motor especially. You spoke about that. Tell us what has changed, because consistently the thought process was that, okay, things are getting better. Now Q4, your commentary seems to suggest that maybe not. Maybe again you all are going backwards to more caution. So what has changed therefore in your view?
Yeah, so let me put this in context. I think when you look at the approach that ICICI Lombard kind of largely operates at, we have always driven profitable growth as a core underwriting philosophy. And that's something that we kind of largely subscribe for as an institution. And that's the reason whenever we see signs of market getting reasonably sensible, then obviously, as I said, because of our brand, service and technology capabilities, we are able to kind of gain incremental market share. But at the same time, we would also watch for the direction that the market takes, which is what I kind of talked about, where wherever we did see signs of the industry getting a little more competitive in terms of pricing, which is reflected in the combined ratios for the industry that I said has gone adverse from 118 to 123, specifically in the context of motor for the 9 months. Obviously, in those times, we obviously kind of take a slightly more guarded stance and wait for the cycles to get corrected as what we had seen even in the past. And therefore, to that extent, I think in terms of how we are positioned for, very, very positive is the way how we are heading to insofar as the next year is concerned. Because, as I said, the ability of players to continue to remain competitive on pricing, we don't think is something that could kind of sustain for a very long period of time. And more so, as I said, FY25-26 will be the year when the regulator will actually has kind of laid down the guidelines for compliance to expense of management limits, which many of the companies in the markets at this point of time clearly are exhibiting an exceedance. So from an ICICI Lombard standpoint, I think we are very, very positively placed because our expense of management thresholds are less than the 30% limit that is laid down. So all in all, when we put this together, and that's fundamentally the approach that we have always taken. I think we have to kind of wait for the right cycles to emerge and kind of then leverage on the brand, service and technology to be able to kind of deep mine the market share opportunity that one has.
And how is health playing out? So I'll shift tack. How is health playing out? Your corporate health loss ratio was roughly 88.1%. Retail, in fact, stood at 64.5%. Is there going to be a larger focus there? What's the outlook like? And what's aiding these numbers?
So again, health has always been a preferred line of opportunity for us. Again, that's been an area where we have been kind of, particularly in the context of retail health, is what we have been speaking through to even to the markets. To say that that's an area where there's a lot of investments on distribution, products, and use of service experience. So that's an area where we have been actively investing a lot over the last several quarters. The good news is, clearly, if you see from a market share outcome, we used to kind of largely operate on retail health at a market share of roughly at about 3%. If you look at on a full year basis, that market share increase has moved up to 3.3%. And for the quarter gone by, if you look at quarter 4 of last year, that market share was roughly at about 3. The current year quarter 4 market share stands at about 3.4%. So clearly on an incremental basis, when you look at even in terms of growth, the industry on retail health would have grown at roughly about 12%. Our growth has been close to about 25%. So hence, I think that particular segment is pretty much playing out in line with our expectations on the investments that we are doing on the areas that I spoke about. And continuing with the loss experience on that segment, I think if you recollect, broadly what we have spoken about on retail health is to try and run the book at a loss ratio range between 65 to 70%. And if you look at the outcome that one has exhibited on a full year basis, again, the loss ratio of the portfolio is well within that range of 65 to 70. So all in all, I think both on top line and even in terms of the underwriting outcome that one sees on retail health, things have pretty much played out in line with our expectations. And again, that's an area where we will actively continue to stay invested on service, product and distribution. On the corporate health, the point that you made, again, it's more an opportunistic play because there we are kind of dealing more with B2B relationships. And therefore, to that extent, the pricing tends to be a little bit more competitive. And it's pretty much similar to the point that I made in the context of motor, where things will be largely tactical. But inherently, the portfolio will run at a very relatively higher loss ratio. As I've said even in the past, the large corporates tend to run at a loss ratio of mid-90s. The relatively small and mid corporates tend to run at a loss ratio of anywhere between 90 to 95. So on balance, you will see the corporate health loss ratios in that range of 94, 95, around those thresholds. But the relative cost of acquisition for ICICI Lombard is a low single-digit number because we tend to work directly with the corporates concerned. So, and there again, I think the way we have run the book has been a mixed bag, as in to say that whenever we saw the market sensible in terms of pricing, we had a huge outperformance. But at the same time, when the market gets a bit competitive, we tend to obviously be a bit more selective and again wait for the right time cycles to come through before we're able to leverage on the opportunity.
Point taken. I stand corrected on one number. So the corporate loss ratio stood at around 97.5%. That's for viewer context, obviously. And so you've obviously contextualized that as well as to why it's in that range in the 90s somewhere. But thank you for that. So, sir, last piece, therefore, what's the outlook like for FY26 across businesses? Motor seems to have some headwind, but you believe that headwind will recede and growth will come back. Health, you believe, will continue to grow well. And therefore, what's the combined going to appear like in FY26? I know, difficult question, but how do you see it playing out, at least as we speak? How do you see it coming off?
Yeah, so let's look at so that's a great, it's a great crystal ball gazing question. So, but having said that, let's look at the emerging trends in terms of how do we see things playing out. I think, as I said, some of the announcements which both government regulators clearly are kind of indicating is to kind of make sure that there is a lot more demand that gets created on ground. And therefore, to that extent, that's a great positive insofar as the start to the next year is concerned. And within that, I think let me just put this also again in context. For example, in the current year, as you would recollect, effective October 1, particularly for the policies that we issue on a long-term basis, the regulator had come back to say that you can recognize the premium only to the extent of the premium attributable to a 1 year period. Anything in excess of 1 year, wherever we would have issued a long-term policy, those premiums can get accrued only in the subsequent period. Now, this impact, while it had for 2 quarters in the current financial year 24-25, in 25-26 it will sustain for 2 more quarters. So hence, to that extent, that's something that one has to keep in mind insofar as the impact of the change of the 1/n prescription is concerned. So that's one. But having said that, if you look at health inherently, forget about how things could play out in terms of how the future would be. Look at how things have played out in the last 6-7 years. Consistently, it has been a double-digit growth driver, and we don't see any reason as to why the continued expectations of growth on that particular segment should not kind of subsist, even as we head into, let's say, FY26. Let's take commercial lines. Now, commercial lines as a practice, as we keep saying, significantly mirrors economic activity. And there, clearly, the governmental push to kind of put a lot of thrust on infrastructure and capex investments augurs very well insofar as the growth in the commercial lines segment is concerned. And within that, one other factor, if you recollect, for 24-25 that played out was the market got a bit more competitive on pricing.
Yes.
But clearly, this could not sustain for a long time. And that's the reason why effective Q4, which we called out even in the January earning call, and even as we speak in the current earnings call as we spoke, clearly we have seen signs of that price coming back. And the early signs of the April 1 renewals that have happened on the corporate policies has again been very, very positive. So overall, I think we should definitely see the market starting to exhibit maybe a double-digit growth number. And within that, ICICI Lombard's obviously expectations is to kind of continue to have that outperformance of 100 to 200 basis points insofar as the top line is concerned. On the combined ratio point that you made, I think we will keep making the point that we are obviously kind of here for driving profitable opportunities, and therefore consistently, if you would have seen, I think we have seen an improvement in our combined directionally, very, very positive. And obviously we will also keep a watch in terms of where the industry movements are. But assuming the industry starts to exhibit signs of semblance, there is no reason why we should not continue to see a downward trajectory on the combined ratio, which effectively will start translating into a return on equity range of roughly about 18 to 20% insofar as stakeholders are concerned.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching India Market Open, and quick check of the markets before we get to some of the buzzing stocks this morning. So flat, but in positive territory at least. Some of the buzzers today, I want to mark out JBM Auto, Electra, Greentech. This because the Delhi government has talked about expansion of electrification of its EV bus fleet. So positive for both of these counters, 11% up on JBM Auto now. Electra also about 7% up. Ireda is the other one. Blockbuster results, not too much of a pinch so far, despite the hit from Gensol Engineering. But let's talk a bit about Indigo as well. Indigo in focus after China has halted deliveries of Boeing aircraft from the US amidst trade tensions between the two countries. Somit joining us for more on this. Somit, why would this be a potential benefit to Indigo?
Well, it won't actually benefit Indigo. It could work as a negative thing for the company, given the fact that in the past the company has continuously benefited because of more deliveries coming in from Airbus to Indigo. In fact, if you look at it in FY25, Indigo got a delivery of nearly 58 aircraft from Airbus as against 45 in FY24. While on the other hand, Air India, which relies more on Boeing, got deliveries of just 29 aircraft in FY25 as against 42 that they had seen in FY24. Now, this higher delivery that Indigo was so far getting from Airbus, while the lower deliveries that Air India was getting from Boeing, was benefiting Indigo in terms of market share gains and pricing power. However, this could change given the fact that China has now said that they will be halting Boeing deliveries, and this could lead in fact Boeing to deliver or to reallocate these deliveries towards India. Now in India, Air India and Akasa have placed the major aircraft order from Boeing. Air India has placed order of nearly 220 Boeing jets in 2023, while Akasa had placed orders for nearly 150 aircraft from Boeing in 2024. So if deliveries for Akasa and Air India increase going forward because of this China news, then this could help both these companies to regain some market share and also lead to higher growth. So far their growth was constrained because of the supply issues, but this could get resolved for Air India and Akasa and be a potential negative for Indigo going forward. Also, this could impact the pricing, this ticket pricing in the sector, given the fact that there would be more supply that could come in from other peers, and this could lead to a bit of impact on the pricing side also. So keep an eye out for Indigo. Their market share and pricing power that they had so far could be at risk if China continues to delay delivery of aircraft from Boeing, because the same could get reallocated towards India going forward.
You know, it's an interesting way to look at it, but we'll have to wait and see how long this standoff continues, because believe you me, Boeing officials must be knocking at the White House right now and saying, you know, reverse this and fix this and don't let China block the incoming of Boeing. So this may be a bit of a stretch with immediate impact, that because China is not taking Boeing, then Air India Akasa gets more and will impact Indigo's market share. I mean, they've been through more turbulent times than those.
Yeah, most certainly. And probably, and maybe there is an immediate benefit to this, but longer term, who knows? But it's a fascinating story about what trade wars can do, right? Yeah. Just imagine I mean, it's unthinkable to think of large global airlines and they not being Airbus or Boeing planes per se. We've been used to that so much. So it'll be interesting to see for everybody traveling to China at least. Yeah. But okay, more stories. Sanofi Consumer is in focus after private equity player Clayton, Dubilier and Rice or CDNR made an open offer to buy stake in the pharma major. Mahima gets more. Mahima.
Right. So, as you rightly mentioned, shareholders of Opal Bidco as well as Clayton, Dubilier and Rice are making an open offer for Sanofi Consumer. The open offer is to acquire shares of Sanofi Consumer, and this comprises of 26% of total voting share capital. Now, just a few details with regards to where open offer is concerned. It's at a cash price of 4982, and overall total number of shares that they'll be buying stands at 59.87 lakh shares. The cash offer is slightly at a premium, that is around 0.5% as compared to its yesterday's closing price. How did the open offer get triggered? Well, in October 2024, CDNR had acquired controlling stake in Opella. Opella basically holds 60.4% stake in Sanofi Consumer. So post acquisition, CDNR has acquired around 60.4% voting rights in Sanofi Consumer, and the open offer was triggered because the acquisition was more than 50% of a controlling stake. So this is the overall view of the open offer getting triggered, and of course CDNR acquiring more than 60% stake in Sanofi Consumer.
Okay, thanks. Not too much of a moment here, of course, but good to get this perspective. Mahima, thanks for that. Okay, time for a very special guest. Rajiv Batra, Chief India Equity Strategist, Head of Asia and Co-Head of EM Equity Strategy at JP Morgan, joins us right now on the show, all the way from Singapore, I presume. Rajiv, great having you. Thanks for taking the time out. Good afternoon to you.
Good morning, Neeraj, and thanks for having me back on your show.
The pleasure is entirely ours. So, Rajiv, at the outset, actually, just wanted to ask you, when a situation is as fluid as it is right now, does it make conversations around valuations, stock prices, and buying decisions a lot less material?
I agree. valuations at this juncture are not material enough, because if you look at broad-based valuation for S&P, which is close to still near 19x, or even for our emerging market, which is close to 12x around its average level, we are not at a capitulation mark yet, which we have seen, you can say, in a previous trough or even a previous downturn. There was some bit of it came on Monday last week, where emerging markets or Asia equities valuation at the lowest point of the day went to -1 standard deviation mark. But that was also not enough. A kind of a risk market is seeing coming over the forthcoming next 4 to 6 months. So if the risk premium keeps on going higher, neither investor nor researcher can decide what is a fair valuation. It is a market which will dictate the fair valuation should be.
So Rajiv, just wondering, to your mind, is the worst of the tariff uncertainty behind us? Because a lot of activity happens at the start of a quote-unquote tariff war, or is it yet to come, or is it difficult to say that right now?
Neeraj, so tariff and non-tariff barriers are now the most hotly contested words which are being used everywhere. But I'll back to defer to say that either of this uncertainty are fully over. Remember, even if there is a pause on reciprocal tariff for a 90-day, but when we look at a weighted average tariff from the US, it is still meaningfully higher what it was back in January. From 2.8%, we are still sitting somewhere in the territory of 23, 25% weighted average tariff, despite reciprocal tariff on a pause, which means uncertainty still are there. And remember, it's a pause. It is not something finally concluded. Negotiations are on. And universal tariff 10% still applies. Sectoral tariffs are still there in place for steel, aluminium, auto. We don't know what's going to happen to the pharma and the semiconductor space in coming times. So too difficult or too not possible to have a visibility right now whether we are done with the worst of the tariff yet.
Rajiv, hi, good morning, and glad to speak with you again. Tamanna here. I quite agree with you that the uncertainty still is very much there. May I add to it and ask your view on one aspect which is perhaps not entirely factored in, that if the US-China tariff war continues to escalate, if both sides continue to be at loggerheads and no one blinks, then the impact globally, including on emerging markets like India, is something we haven't quite understood yet?
Thanks, Tamanna, for talking to me. And where I will try to give you a lens over here is that we all are trying to do the same kind of a mistake, saying that it is just US versus China, or we are trying to take leap out of book from Trade War 1.0. Where the difference compared to the last time trade war over here is that tariffs are not just on China. We still have 10% universal tariff across the board. We also have sectoral tariff in place. So in the previous trade war, entire emerging market benefited because of a supply chain shift, FDI coming, and when exports getting rerouted, or you can say coming from EM side. This time around, we have barrage, or you can say menu of tariff across, not just on China, but other countries also, which means it is easier said and done to say any particular emerging market will benefit or any particular big developed market will benefit over here, because everyone somehow come into that tariff bucket. So taking that into account, there will be only relative winners, countries which have very less exposure to trade, or countries which have very low exposure to US demand. And that's where India sits well, along with some other domestic economies of EM or of the world, who will tend to relatively do well in an environment because of a huge domestic demand and constructive domestic factors.
From the Indian perspective, Rajiv, the working theory right now, and that's reflective in how markets have behaved, equity has behaved here last 3 trading sessions. And I know 3 trading sessions is a very short period of time, but when the news cycle is shortened this much, then that's something that you look at as an indicator. The working theory seems to be that India is relatively resilient, India is going to be okay, and the fact that we're not that export dependent as an economy is going to be a saving grace. Do you concur with any of that?
Relatively, I totally agree with you. And this is the reason why we are quite sturdy and doing well in this turbulent time, because of constructive domestic factor, low exposure to the US and demand, which is only 9% of MSCI India total revenue exposure to US versus some of the North Asia countries, which have exposure close to 40 to 25% US demand. And then lastly, a potential alternative for supply chain shift in case if the deal happens between or negotiation constructifies between US and India overall. Where the issues will still come for India is that if the global trade goes for a slowdown, knowing that last 4 years, if you look at a compounded annual GDP growth, the big boost to GDP came from exports or exports-led capex overall. So if global trade slows down, it is unfair to say that India will not get impacted. Sectors like IT, pharma, auto, textile, gems and jewelry, all these are exposed to external demand. So it will be a nuanced view, and hence this is the reason why we are seeing downgrades coming in second quarter, third quarter, or even a fourth quarter estimate from Street, even from JP Morgan side on GDP terms, because this is a quarter where most pain will be felt of global demand slowdown. Relatively, yes, but absolute term, there will be no directional decoupling.
Okay, no directional decoupling. But could it bring downsides, or is some of that baked in, and at best it'll probably cap upsides? I'm just trying to think about that, Rajiv.
Domestic
market.
demand.
What I mean is, would a GDP downgrade or a set of downgrades coming up in the future will they bring about downsides to equity markets, or will they at best cap upsides?
It will be much more nuanced, Neeraj. So sectors which are exports heavy will now see further downgrades on EPS. So we ran this exercise seeing that if taking into account US demand slowdown, plus taking into account some amount of a bit of tariff impact, plus you can see the peak earnings being in place, sectors like IT, sector like pharma, we can have a huge downside in terms of an earnings over there. But at the same point of time, lower oil prices, lower inflation, plus monetary policy turning positive, that will have a positive impact on earnings for financials, for consumer staples, some of the discretionary ex-auto spaces, even for power and cement also. So taking that into account broadly on an index level, earnings could go down further from here. Consensus for CY25 is baking in close to 16% earning growth estimate. If we shave off exporters' earning growth and make it flat, 0%, entire MSCI India earning growth can come down to 10 to 11%. With that being the case, market at best can be plateau at this level itself, but if re-rating keeps on happening, what you saw over the last 3 to 4 days, then there could be a downside also from this level.
Wow. Yeah, think of exporters, viewers, as you think of earnings, and 16% very likely seems to be an inflated expectation. Rajiv, one question on flows per se. I mean, the belief is that DXY weakens, and DXY weakens leads to outflows from US into emerging markets, and India is probably well placed to receive that because geopolitically as well, India is well placed. What's the merit or demerit to this argument?
So emerging markets, ETF particularly last 10 weeks prior to the last week, have seen close to $14 to $15 billion of inflows. And that also coincide with emerging market outperformance to developed market in the first quarter, which was last seen back in 2018, that finally arrived in first quarter, happened on the back of three things. Number one, weaker dollar. Number two, strong commodity prices. And third, strong global trade. Global trade because of preempting tariff concern and pre-ordering stuff. Now we are in an environment where, yes, we are having a weaker dollar. But at the same point of time, we are also seeing tariffs raises uncertainty on the global trade demand. With that being in place and EM being the trade haven, they have started seeing outflows. So last week, we have seen a bit of an outflows in India also, but there was a record outflows in some of the Southeast Asia markets and even in the North Asia part. So emerging markets can do well if dollar is weaker and tariffs are not punitive. But if dollar is weaker and tariff uncertainty prevail or becomes punitive overall, then it will be difficult to see emerging markets equities doing well, because even if money comes out from US or global equities, it will try to find a refuge in treasury or bond market rather than coming to EM equities or EM bonds.
So, that's the tricky bit about Indian equity and where it sits in that basket of emerging markets. And very cogent point that you make there, that if dollar weakens, bond deals become more attractive, that's where the flow will go. But having said that, Rajiv, from an Indian equity perspective, if investors, viewers watching this right now want to Trump-proof themselves or make themselves safer from global tariff headwinds, does it make sense right now to focus on domestic plays, avoid export-oriented businesses or businesses which have more exposure, auto, pharma and the like, and focus, say, perhaps on financials or more domestic stories?
So that has been the one of the themes which we are recommending to investors, that coming 2, 3 or 4 years perspective, if global demand does not pick up materially or slow down is a reality which we are entering into, then in that scenario, domestics will tend to do well over exporters. We have seen since COVID, exporters have been outperforming domestic demand, which clear being evidence where financials and consumers were sufferer over the last 3 to 4 year perspective. But now table is turning, where you are having a global trade uncertainty. On the same point of time, the policymaker in India are trying to revive the domestic demand, which most of the heavy burden being shared by monetary policy or the regulatory policy easing happening from RBI. With that being the case, the only way to safeguard your portfolio is don't buy anything in terms of an equity exposure which has 10% or more revenue exposure to US. That means you will totally be avoiding any kind of an export exposure over here. And what you can actually buy is having 90% or more exposure to domestic demand. That's where your financials, consumer staples, discretionary ex auto, power, cement, and hospital, along with defense, fits the bill.
Interesting and very, very, insightful take there. I mean, conversely, IT, pharma, all of those become more and more risky apart from other export-oriented businesses, especially with US exposure is a point that is being made. Thank you so much, Rajiv, for speaking with us. Always a pleasure to have you on NDTV Profit.
Thanks, Amanda.
Right. With that, it's a wrap on India Markets Open. We're leaving the markets in even keel. Nothing really changing in that picture. Bank Nifty doing better than most, and a trend that continues there. So the Bank Nifty only sort of sigh of relief. The Nifty IT sees its woes deepening. I'm just going to pull up the advanced decline ratio before I wrap up on the show. The Nifty IT, like you can see, seeing some pain point. Remember, Wipro results later today. The advanced decline ratio is not that bad. You have the advances higher than the declines right now, but even Steven as of now. So it is on an even keel. We'll take a very short break, but if your queries are specific to your stocks, your investments, and your particular counter, stay tuned, because up next is Ask Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the out
You're watching Ask Profit. I'm Mahima Vachajani and with me is Alex Matthew. Well, before we move on to the show, let's take a quick look at how the markets are panning out to be right now. Well, Nifty 50 is trading within a tight range. It's down by about 0.12%. The range, the fall from high is roughly 76 odd points and the gain is also hardly anything. In terms of the broader markets, they're doing a tad bit better than the benchmarks. The Midcap 150 is up by about 0.26%. The small cap 250 is up by about 0.18%. Let's also pull up the advanced decline ratio and see what the breadth of the market looks like. Well, there you go. There are around 1450 odd advances versus 700 odd declines. So the ratio is 2:1 roughly. Let's also pull up the Nifty heat map and see what counters are actually doing well and keeping the Nifty in check. There you go. The exact heat map is divided into 2/3 of ratio, and there you go. Some counters doing well and a lot of those counters in red. There's Infosys, which is down by about 1.8% ahead of its results. There's Hindalco, Maruti, Eternal, that is Zomato, not doing very well in trade today, but some counters that are doing well is IndusInd up by 4%, of course following the news. Trent up by 2.3%, Axis Bank doing well in trade today about 2%. Let's also pull up the sectoral heat map and see what sectors are doing well. There you go. There's Nifty PSU Bank, which is up by about 1.5%. Nifty Private bank up about 0.76 odd %. Something that's not doing well is Nifty IT under pressure. Earnings one by one are coming. Wipro is expected to post its results today. Infosys to come tomorrow, and TCS we've already seen. Nifty Metal down by about 0.7 odd %. Nifty Auto also under pressure, down by about 0.5 odd %. Let's also pull up the BSE 500 and see what counters are buzzing in trade today. There you go. There's JBM Auto, which is up by 10 odd %. Hikal Limited is up by about 6 odd %. Century Textiles is doing well comparatively. Something that's not doing well is MGL, Coromandel International, IGL down by about 2.7 odd %. And there's Rainbow Medical Hospital, which is also down by about 2.6 odd %. IndusInd, of course, a Nifty 50 stock. You can see that in BSE 500 topping the chart as well. There's TCI Express also doing well, up by about 4.2 odd %. So these counters doing well in trade today. With that, let's also welcome in our guests, Vaishali Parekh, VP Technical Research at Prabhudas Leeladhar, joining us, and with that, Rajesh Agrawal, Head of Research at AUM Capital, also joining us now. Welcome to both of you. Before I move on to stock specific action, Vaishali, anything specific that you're observing on the charts for the Nifty as well as the Bank Nifty levels today?
Very good morning, both of you. I think, yes, so market is in a good uptrend. We may see, as far as major index Nifty, a little bit of a consolidation. We saw good run up in the last few days. I mean, it has been a very good, strong run. So as far as Nifty is concerned, 23,300 is a resistance. Above that, we would be looking at 23,500 and so on. But Bank Nifty continues to outperform, and I would go rather stock specific. As you said, PSU banks should be the ones which should be focused on. And in the private sector, I think Axis and IndusInd, they are showing good strength. So I would be, as far as trading strategy is concerned, these are the stocks that we would be looking at.
Okay. All right. And good morning to you, Vaishali, and Rajesh, to you as well. The first question we're taking today is from Raghu, who's writing in from Nellore, and he's asking about Swiggy. And interestingly, quite a few investors did deploy funds into this platform company, and Raghu has deployed quite a considerable amount. So as much as 3,600 shares were bought at a price of 347.5, which is not the worst buy price because the stock is currently at 336. So he hasn't lost a lot of value. Of course, because of the size of his acquisition, he has lost about 41,000 rupees. But other people, Rajesh, have lost more, because the kind of erosion that you've seen in this particular stock is quite significant. What should he do with this, and what should the expectations be?
Good morning, Alex. Good morning, Mahima, Vaishali. I concur to your idea that a lot of people have lost a lot of money in this platform stock, be it Zomato, that's Eternal, or Swiggy. But the fact remains that these companies are good for a long term. By long term, I mean at least 5-6 years down the line, they might turn around and give strong numbers because of the kind of penetration they are having, the kind of demographic change, the kind of change in mindset of people by ordering food, and not only food, but even groceries and other things online. Even yesterday, we saw a news that Airtel SIM card would be there on Blinkit. So these are something that's happening, but these things to go into numbers would take some amount of time. In the short term, there would be pressure because we have seen Q3 numbers being very bad for both these companies, Swiggy as well as Eternal. And I don't think that anything miraculous would be happening in the next 2-3 quarters or so. The numbers would be in pressure, margins would be in pressure, competition is heating up. New players like Zepto and other players are coming into the fray. So in the short term, there might be some amount of pressure. And if you're looking for a short-term period, maybe 6 to 9 months, it's better you try to get out on every rise. And if you're looking for long-term, you can carry on with your position, but still your position is very high. What I would say is on every rise, book partial profit and carry on with the rest.
Right, so that's the view with regards to where platform companies are concerned, especially Swiggy as well as Eternal. The next question is on IndusInd Bank. Lots have been happening with this counter. Upendra from Jaipur has been holding 170 odd shares, bought at 1450 a piece. And he's sitting on a significant loss of 1 lakh rupees right now, and he's been holding this for more than a year now. He's a long-term investor. He wants to know whether he should book a loss and invest in a separate banking stock. Rajesh, I'll stick with you for this query. we've been covering the entire IndusInd saga in a very detailed manner. But since he's sitting on a significant loss, do you think that he should book losses now? Currently, the stock is up 4%. And should he invest in some other banking counter is what he wants to know.
See, it's a very difficult question because IndusInd Bank as such is not a bad bank. It's only because of the kind of news flow that came in, and that's why it crashed. And yesterday, with some amount of positive news flow about the figures not being that great, it's reacting to that. If I talk of valuation at this point of time, it's almost 1 times price to book, even less than that. So trading at a very attractive valuation, I would say. But you never know, if something more creeps up, then it can go. It can take another blow. But unless there are no negative news in the recent past, which I concur that there won't be because of RBI vigilance and all, one can continue along with this with a target of maybe 875, 880 or levels in the next few months. As far as deploying new money in banking sector is concerned, we are very bullish on Axis or a Kotak, which have not done anything in the recent past. Not to forget HDFC, which is the market leader. In the PSU side, you have a large cap name like SBI or a Bank of Maharashtra in the mid cap size.
All right. So Axis Bank, you said ICICI Bank as well, right, Rajesh?
Axis and Kotak.
Kotak, okay. Kotak and of course HDFC Bank. In fact, a lot of FI buying was seen in HDFC Bank yesterday, and interesting numbers panning out there. All right, we've got a first caller for the day. Amit is calling in all the way from Dubai. Amit, a very good morning to you. How can we help you?
Good morning, everybody. Yeah.
Good morning. Go ahead with your query.
No, the reason I bought Praj Industry was because it's the biggest player in ethanol, right? But we know that, it's simply not moving forward. So I have a significant allocation, more than 10%. I have 500 shares, roughly I bought it at upwards of 600 rupees, 620 actually. And I'm just thinking whether it's a good time to buy more and keep this for another 2 to 3 years, assuming that the ethanol story will play out. So I just want to get your views whether this is a good time to buy. I think the stock has corrected maybe 20% odd.
Right, got your query, Amit. I'll take this up with Rajesh. Rajesh, yesterday reports were suggesting that the ethanol blending target by 2030 is expected to be 30% now, which was 20% earlier, because we've already achieved that 20% blending mark by March 2025 or so. What's the view with regards to where Praj Industries is concerned? Should he add more at the current levels? He's holding 500 shares, bought at 620 apiece.
See, it's right that the news of 30% blending of ethanol in the 2030 onwards, but we should not forget that crude is trading at almost $60 odd, even below that. And OPEC has clearly said that they foresee a demand glut going ahead. So unless and until crude moves up, which would be a bad news for the entire country as such, because we are an importing country of food, but still, unless crude moves up, I don't think this ethanol story is going to be any big story in the near future, of course. So adding at this point of time won't be suggested. You can continue with your holding for a long period, because ultimately crude is going to go up, whether it was 6 months or 9 months, that's a different story. You can continue with your stock. Putting new money, there are enough opportunities in the market, so I won't suggest adding at this point of time.
What's the view with regards to where Praj Industries is concerned? The next query is from Sumit, who's writing in from Bengaluru. He's holding 144 odd shares of BSC, bought at 803 a piece, and he's sitting on a significant profit of 7.3 lakh rupees. He wants to know for the next 1 year, what could be the target for BSC? And should he continue to hold or book some profits at the current levels? Vaishali, I'll take this up with you. 7.3 lakhs is an extremely big number to have, right now in his basket of profits. Do you think he should book profits partially? Do you think the charts are constructive enough right now for BSC?
So I would say BSC is a stock which one has to hold on in their portfolio. But even if he's looking at it to get again a fair entry, I would say book partial profit. The ideal level to again re-enter would be, because market will go through whipsaws. So 52, 5300 would be again another level to get into. And that way he can maximize on his profits, because long-term chart we are looking at 6,500, 7,000 target. So that is the way I would look at this stock.
All right, so that's the view with regards to where BSE is concerned. Our next caller, Govind, is calling in from Hyderabad. Govind, a very good morning to you. How can we help you?
Good morning, madam. Good morning, Alex.
Good morning.
Ma'am, actually, I have one small doubt actually. Due to this five-star small business, I purchased 250 at the rate of, I think, 780.
Okay.
Current, because of there is no relation between the Trump tariff and all the things, this is the domestic business.
Right.
Can I add some more, ma'am, actually, for long term, for 2 to 3 years?
Okay, got your query, Govind. I'll take this up with Rajesh. Rajesh, we've been talking to experts and everybody has a consensus call saying that right now the right way to play the markets is invest in domestic plays. And that is what Govind is also banking on. He's asking whether he should add more shares of Five-Star Business Finance Limited, or do you think there are any other counters which are right now more attractive where domestic play is concerned?
See, there are a lot of domestic plays in different sector, maybe healthcare, hospitality, and other things. But since he's talking about NBFC company, Five-Star Business Finance, I think there are better opportunities in this sector only. For example, there is a Poonawalla which is trading at a considerably discount to what its value should be, or even Geo Finance, which have very good future plans going ahead. So these two companies are there into our radar. In the large cap space, we can recommend Bajaj Finserv, which is a holding company of Bajaj Finance, apart from which it holds insurance ventures and mutual fund and other things. So these are some of the better names in the NBFC space. As far as the Five-Star is concerned, you can continue with your holding. Maybe a 5-10% upside from these levels, that's almost 850 odd levels is quite possible. At those levels, you can try to exit.
Okay. All right. So that's the view on Five-Star. All right. So let's take Praveena's question. Praveena Mehta is writing in from Mumbai. She says she's a long-term investor and she's looking at possibly buying more of ABB, which she's bought at a price of 4,090. She's got 55 shares. And she's already seeing considerable upside. The stock is up and about today as well. There is a fundamental development also, of course, for ABB, which is why it's up and about in trade today. But since it's a long-term question, I'm going to come back to you, Rajesh. And she's looking at a 15 to 20-month time frame for this. Should she buy more at these levels, in your opinion?
Yes, one can continue. These are strong companies, maybe ABB, Siemens, Cummins. These are all strong companies for long-term portfolio. They are low beta stocks, don't react to much of the market, but still, considering the fact that government capex has also started, and it's just a matter of time when private capex also starts. So these are companies which one can hold for long-term portfolio, not only 12 to 18 months, 6 months. One can even hold them for 5-10 years. So yes, one can add at these levels too.
You were making a point on ABB,
Global. So ABB Global is set to announce its results on Thursday, that is tomorrow. And generally, the commentary that comes in from ABB Global impacts ABB India stocks a lot. So that is something to keep an eye out for.
Certainly, and also I think the reaction today is because of the outcome of the annual report. Certain findings there are leading to a positive outlook for the months and years to come. So that's certainly something to watch out for. All right, let's take the next question. It's on Suzlon Energy. And we've got Nagakumar, who's writing in from Hyderabad, who's purchased 10,000 shares of Suzlon. It's doing absolutely nothing at this juncture, this minute, but he's seeing gains because he's bought at levels of 40 rupees and the stock is currently trading at 54. He says that he can hold for the next 2 to 3 years. Rajesh, very quick view, and then I want to go to Vaishali on the charts as well. If I'm not mistaken, you had said to take money off the table if you have profits, right, on Suzlon?
Still, I am with my view that one should book profit, switch to Tata Power or a NTPC Green for that matter in the same space.
So Vaishali, from that perspective, since that's a fundamental view, at what level would you suggest is the best opportunity to book those profits? Do you do it in a staggered manner?
Well, actually, there's nothing really happening in this stock since a very long time. But I would say it can bounce up to 58, 60 and maximum to 65 right now. So these are the levels in different tranches you can exit.
Okay, all right. So that's a view on both the fundamentals and technicals on Suzlon. And the reason I did that is because a lot of you have interest in this company. Kamath is calling us from Bengaluru. Hi, good morning, Kamath. How can we help you today?
Good morning, sir. Sir, I hold 2,500 IOL chemical. I bought this before the split.
Okay.
My average price is 70 rupees. I wanted to know short term and long term, both of you, sir.
Understood. All right. And you bought this company, which obviously is in the chemicals and pharmaceutical space. What was the thinking when you bought it, Kamath?
No, they are, the leading manufacturers of Brufen, and the promoters were continuously buying the shares. So I thought they were increasing their holding. So I thought that there may be some good news coming in. That's why I bought it.
Yeah, you're absolutely right. It has a global market share of 35% apparently in ibuprofen, which of course everyone knows is the painkiller. And that is an absolutely important point that you've raised. It's an API, of course. And quite a few of these stocks, Rajesh, reacted sharply during this whole tariff turmoil, if we can call it that, because the thinking is that whatever is bad for China, which is a very large API manufacturer, is positive for India, and the large ones should stand to benefit. Is that the right thinking?
See, I differ with this view because I don't know what Mr. Trump is going to do, because as we all know, is a basically very erratic way of announcing things from his side. So I'm not sure that what comes next on Pharma. But yes, the fact remains it's one of the largest player for ibuprofen, doing very well. API is doing very well. And when China factory is concerned, one thing is for sure, that when China won't be allowed to do business with the US for the high tariffs and all, they may be dumping their products on other countries. So that would be a thing to see in future. Quantifying the benefits and losses at this point of time, it's a really difficult task. But as far as IOL chemical is concerned, at this valuation, I think one can continue to hold for a target of maybe 70, 72 odd rupees, depending on the fact that status quo is maintained on the pharma sector from Mr. Trump.
Hold is the view coming in on IOL chemicals, and of course we'll have to wait and watch out for as to how tariff turns out for the entire pharma space. All right, the next query is on Mubin Mehim from Kerala, who wants to know as to what analysts are currently rating for Siemens India, and whether this is to hold, buy or sell. Vaishali, on the charts, how is Siemens faring?
Well, I would say all these three stocks, as even Rajesh gave his opinion on ABB. So I think all these three stocks, they are at a fair value. I mean, technically they are well placed, and I would say that once we see momentum setting in, it would get into a trend, and I won't be surprised if this goes towards 5,000 levels. So according to me, it's a buy at these levels.
Okay, buy for Siemens is the view coming in from Vaishali. Our next caller, Murli, is calling in from Bengaluru. A very good morning to you, Murli. How can we help you?
Very good morning to you. I'm first of all, congratulations for posting a excellent way of answering queries.
Okay, thank you so much.
Number one, I bought 200 shares of Signature Global.
Okay.
The Gurugram-based real estate developer.
Okay.
At 1,118. 210 shares I bought. Now it is hovering around the same price, maybe around marginally profit.
Right.
Considering the future prospects, and they said to take up the growth in the next this year and last year and this year, with a higher ROE, EPS, everything in all formats, there is exponential growth.
Right.
Can I add more, hold or sell or switch?
Okay, got your query, Murli. I'll take this up with Rajesh. Rajesh, real estate has made a comeback in the past few days. Your take on Signature Global as well as the entire real estate space, because that is also one sector which has the domestic play, turning out to be in its favor.
Yes, it's a domestic play, and the second thing is RBI started cutting rates. 2 instances of rate cut has already happened, and there may be more coming in the near future. So these are good things for real estate or even auto, which are interest sensitive sectors. But as far as Signature Global is concerned, I think there are better plays in the market. It is a newly listed company with a whole lot of projects coming up. But at these valuation, I think one should try to switch from Signature Global to better names like Cottage Properties or Lodha developers, even Shobha developers in a better space. So I think one should try to switch from these to that.
Okay, so that's pretty much a comprehensive view on the real estate space. By the way, Macrotech developers gaining another 2.5%. It was gaining quite considerably in trade yesterday. If we can pull up the weekly chart for Macrotech, of course, yesterday the update that came through and the reason why the stock was up and about, there you go, so 11% or thereabouts, because the Lodha brothers have actually settled their dispute, which was a bit of an overhang on the stock. REC is the next counter that we're talking about. Gopi Krishnan is writing in from Riyadh, and he's holding 240 shares at a price of 293, and quite a few people are now on the fundamental basis turning positive on the likes of Irida, the likes of REC and PFC. But I want to check on the technicals. Vaishali, on the charts, he's in the green and considerably so. Should he accumulate more at this juncture or should he wait for dips?
So I would say, well, 360 is a very prominent support in REC, but I don't know whether it's going to go down further on. So I would say accumulate at every decline because that's the way one should go around. Keeping in mind 330, 360 is a good support band, and hold on for a longer time because we have higher targets.
Okay, all right. So that's the view on the technicals. We've got Abdul calling us from Mumbai. Very good morning, Abdul. How can we help you today?
Yeah, actually, I had a query regarding Vedanta share.
Okay.
I purchased it at a rate of 479. Now it is down. So my viewpoint is I can hold it for 1 year because I had invested in for the sake of dividend.
Right. Okay. So if you've invested from the perspective of dividends, why only hold it for 1 year, Abdul?
No, actually, my aim is I can hold it more also. But the thing is that I wanted to know कि और नीचे तो नहीं जाएगा यार.
That's a fair point, and you bought a considerable portion. So I'm just wondering, the follow up to that, of course, Abdul, is how much of this portfolio, how much of your portfolio does this account for?
Hello. Yes.
Yeah. So the follow up to that, because you bought 10,800 shares, my query is how much of your portfolio does this account for?
Basically, I had it consists around 70% of my portfolio.
70% of your portfolio. Okay. Yeah. So, okay. So that's usually, and I'm going to let Rajesh answer this question, but that's usually not a great idea to do because you have considerable concentration risk when you take just one stock and it accounts for 70%. No matter what that stock is, even if it's an HDFC Bank or another very strong company. But Rajesh, what's your opinion here? Vedanta, 70% of his portfolio, over 10,000 shares, bought from the perspective of dividends. He's looking at holding for a year. What's the outlook?
See, you said it right. It's concentration risk, 70% of your portfolio in a single stock, and that too a commodity stock, which have cycles going forward. And not to forget the problem of China, where everything depends on them, whether metals will pay out or not. So these things are there for the entire sector as such. But going forward, I think Vedanta being a large play on metals, having almost every metals under their belt, even crude oil, things are very good. Fundamentals are strong. They give out good dividend. They have announced demerger sometime back, but due to some reasons, demerger has been postponed, I would say, if not stalled. So things are good. The only thing is Mr. Abdul is having a very large quantity in his portfolio that he should reduce. Maximum 8 to 10% of one stock should be there in a portfolio. That's 10 to 15 stock in a portfolio. That should be an ideal number, I would say, depending on one's risk appetite. But 70% is too huge. And to answer Mr. Abdul's question, Abdul bhai, नीचे जा भी सकता है, कुछ भी होए. So be careful.
All right, नीचे जा सकता है अगर कुछ भी हो, is a view coming in from Rajesh on Vedanta. But yes, that's quite a comprehensive view that Rajesh has given on Vedanta. With that, it's time to slip into a very short break, but we'll be right back answering more of your queries on the other side, so stay tuned.
There's a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Alright, welcome back. You're watching Ask Profit and we're in the midst of taking all of your questions. In fact, we've got Dheeraj who's calling us from Hyderabad asking about IREDA and the stock has been on a tear. Dheeraj, you must be quite happy, you must be smiling at the kind of gains that you've seen over the course of yesterday and today. What do you want to know?
Yes, sir. Actually, I bought the shares yesterday, 1,000 shares of IREDA.
Okay.
At 167 rupees a piece.
Okay.
So, can I hold it for the next 1 or 2 months? Or should I shift to any other company like Cube Investment or Vari Energy?
Yeah, okay. So it's a fair question. You bought it based on the anticipation that it will move up very sharply in the short term, right? It's a trading call.
Yes, sir. Actually, I thought that it will post a good result, so I bought it yesterday.
Okay. Okay, so and you've benefited from that. In fact, incidentally, Dheeraj, we've got another viewer, Ashok, who's also asking about the same question, but he's not acquired the stock yet. He's wondering whether he can accumulate. So let me do this, since both of you all have asked the question. First, let me ask Vaishali on the charts. Vaishali, very strong move yesterday and today put together. What are the levels that you would watch on the upside and where do you book profits? Dheeraj only has a view for the next 1 to 2 months.
So I would say the way the trend is setting in for 1 to 2 months, it can go anywhere between 200 to 110. So that would be the level that he can book profit.
Okay. And Rajesh, you already spoke about, if I'm not mistaken, REC. I think I asked you a question on REC, but on IREDA, you must have seen the numbers. What do you make of it? It's strong numbers, but there's also this question about Gensol. Of course, I think that it turned NPA already last quarter. And so to a certain extent, we have to check whether or not provisions were made. But what's your view on the stock?
Yes, you said it right. The numbers were very strong. I would say it's better than expectation yesterday. And the only problem with Gensol that needs to be clarified whether it has been provided or not. Even if it is not provided, I think it's a very small percentage in terms of the entire AUM. So if it is not provided, there might be a knee-jerk reaction when the news comes in. But I don't think that would matter much to a company like IREDA with such a large AUM. But still, the fact remains it's trading at a much, much higher valuation when it is compared to PFC and REC, although they are into the same kind of operation financing the power sector. But yes, IREDA has something different that it focuses on renewable energy, which is the in thing, but still the fact remains the valuations are high. Somebody is trying to put new money, I would always prefer going for a PFC or REC rather than going for IREDA at this point of time, although it's a good company. So you're sitting on a profit, took a position for a short term, book profit and try to get out. For any new investor which is trying to buy, I would say wait for some more correction, maybe 160, 150, 160 odd levels if it comes by any chance would be a better levels to enter.
All right, just Alex was mentioning, and it's interesting to mention this today because Gensol, we're seeing significant moves in that particular stock, and 0.8% of IDA's total book is lent to Gensol Engineering.
That's the exposure.
That's the exposure that IREDA has. Moving on to the next query, Prakash from Chennai is a long-term investor and he's invested in IRCTC and he's invested it for about 4 to 5 years at 264 rupees at 290 a piece, and he's bought 264 odd shares. He's sitting on a profit of 1.24 lakhs, but what he's saying is that in the past 2 years the stock has not moved much, and he wants to know whether he can stay invested or exit and look for other growth or dividend stock. Rajesh, I'll come to you on this one. Is ICTC a good counter to keep holding, or should he switch?
Even we are very surprised, despite being strong fundamentals, all the divisions are doing very well, be it catering, rail, near, ticketing. All three divisions are having almost monopoly, rather monopoly on their business. Only the travel and tourism is not monopoly, but that also is doing very well. Debt-free company, giving dividends. Everything is in their favor. The new launch of new train, whether Vande Bharat or Tejas, is a big positive for IRCTC. They have tied up with Zomato, going for full coach booking, going for outside catering, but the stock is not moving. It's something of a classic case. If Alex would remember, ITC was not moving for such a long period of time. For a long-term investor, it's a hold from our side. Even it's a buy at these levels if somebody is ready to hold for 12 to 18 months. So that's my opinion. It's a very good company. Continue to hold.
Okay, so you're clubbing, you're looking at IRCTC in the same light as ITC. Am I getting that right, Rajesh?
See, not exactly same, because ITC used to give good dividend. The dividend yield was around 9% in those days. So that was better than a FD return, and I have compared ITC with a FD for investors. So I can't compare that in that way. The only thing, it's not moving at this point of time, maybe a long period of consolidation. After some time, it will move because the fundamentals are very strong, and some fundamentals would take the front line.
Okay. So that's a view on IRCTC, and we've got our next caller, Alex from Kerala. Alex, it's lovely to speak to my namesake. Good morning to you, and how can we help you today?
Good morning, Alex. I am coming again.
Yes, of course. Please go ahead. What's your question?
I have a query on TA India, tube investment. I am holding at a 2729, 18 shares.
Okay.
I need a fundamental view on this. I bought it around 2023, that level. It's in the same level at 2023. Whether the valuations is very high, or that their growth is justifying this valuation. Because their growth perspective is showing in that one. It's looking like its valuation is much higher, but it is justifying their growth. That's what.
Okay, so I get your question, whether or not, and whether to hold on is a question, because you've had tremendous patience, not anything else. Patience is the word that I was looking for. Rajesh, he's had patience with the stock, but unfortunately it's not really rewarded him. Would you hold on for the long term?
Yes, of course I would hold on. Belonging to the Murugappa Group, it's one of the very good companies. The group is very good. They're doing very well. It's only thing is the market has not done anything for this stock for a long period of time. That's because of the fact that it has run up quite a lot in the last 3-4 years. It's just consolidating at these levels. But with the kind of numbers it has been giving in the recent past, I think it's just a matter of time when it goes towards 3,000 odd levels. Continue to hold.
All right, continue to hold. Tube investment is the view coming in from Rajesh. Rajesh, I'll stick with you for the next question as well. Purvi from Ahmedabad wants to know 3 stocks from a longer term perspective that are good to invest right now. What are these 3 picks that you have in your basket?
See, it depends on your time horizon. If your time horizon is more than 18 months or 24 months, then I would say go long on, in the large cap space, go long on Reliance, Larsen and HDFC Bank. In the mid-cap space, you can invest in maybe a IOC or a Bank of Maharashtra, even Blue Jet for that matter.
Okay. Okay, so we've got Suresh calling us from Hyderabad. Hi Suresh, very good morning to you. How can we help you today?
Hi Alex, good morning.
Good morning.
Alex, I am holding the Motilal Oswal shares at around 80 rupees, 80 quantity at
right. 625, yes.
Yeah, 625. I am having enough profit, but can I add more shares now, around 200 or 300 more quantity now for a longer term, 1 to 2 years? I have been observing this one and it has fallen from around 1,000 rupees to 600.
Yeah.
So I think in recent fall, and overall, what is this ANC sector? How it will be perform in next 1 to 2 years? So just I wanted to know.
Okay.
Because like I have invested in UT AMC also.
Okay, that's a fair question. Suresh, Rajesh, I'm coming back to you on this one because at last count, at the end of March, you had assets under management for the mutual fund industry at about 65.7 lakh crore rupees. And I was looking at the trajectory over the last 5 years, which accounts for the kind of rally that you've seen post COVID-19. And the assets under management have grown at 24%, more than 24% compounded. Even if they grow at half that rate over the course of the next 5 years, they're going to double to about 120 lakh crore or thereabouts, right? So what are the prospects for Motilal and the sector as a whole?
The sector is very exciting, I would say. The entire space, be it stock exchange like BSE, NSE of course is not listed, BSE or players like CDSL, even CAMPS, these have very good long-term story, I would say, going forward. Even the EMC companies would be the beneficiary because of the kind of mentally thinking that has been changed in the mind of investor from savings account to mutual funds, SIP. That's a big change that has come in the entire sector, I would say. We have seen number of banks coming out and saying that saving deposits have gone down just because of mutual fund investments. So these things are very bright for the entire sector as such. Motilal Oswal being one of the players into that. We have a target of around 800 odd rupees in this stock. So I would say continue to hold. As far as new money you want to deploy, I think you should better deploy in a stock like BSE, despite the fact that it has run up quite a lot. From the levels of 500, which we started recommending, it's come to almost 6,000. But I think if the equity scenario is going to be there, BSE is going to be one of the biggest beneficiary. To be with that.
Be with BSE is the view coming in from Rajesh. The next query is on Cyient Limited. Sudhir is asking this query. He's bought the shares at the levels of 1,407 and he's bought 240 odd shares and sitting on a loss of roughly 51,000. Yes, there you go, 53,000 now. He wants to know whether he should hold or sell at the current levels. Vaishali, I'll come to you. What are the charts indicating for Cyient Limited?
Actually, all these stocks, KPIT, Cyient, they all have taken a very good beating. In fact, the whole IT index. But in my opinion, all this is very cyclical. And technically, if you were to ask me, this is a fair level. Average out your cost, buy at these lower levels. And once this stock starts picking up, you will see good returns coming in this stock. So if 6 months is the horizon, please continue.
All right, so if 6 months is the horizon, buy is the view coming on Cyient Limited. All right, our next caller, Shrikant from Hyderabad is calling in. Shrikant, a very good morning to you. How can we help you?
Madam, good morning, very good morning. Madam, I have bought this IRB infrastructure
around 46.06, 35,000 of share.
Okay.
Can I hold it?
Okay.
It's a short term. It's a short term. I bought it for short term.
Okay. All right.
Recently, I seen that last month, March month results are very good of full correction. That's why I purchased that. Can I hold? Please suggest.
Okay, got your query, Shrikant. I'll take this up with Vaishali. Vaishali, what are the charts indicating for something like an IRB infra?
So, well, it's just consolidating, but if it's purely on a short term, keep a stop loss of 45 and look for a target of 48 to 50. So that would be my view for a short term perspective.
Okay, all right. The next one is a long-term question. It's from Sarat, and specifically for you, Rajesh. Fino Payments Bank, for 1 year or more, he's looking for your opinion as to whether or not to do this. The stock is at 257. It's up and about in trade today, over 3% gains. What's the view?
See, we are not very excited about the entire space at this point of time because of the numbers, the asset quality, and all those things. It's better to switch to a full-fledged bank, maybe HDFC Bank or Axis Kotak, which we recommended in our show today only. So that would be a better option to go for.
All right, so that's the view with regards to where Fino Payments is concerned. Our next question is from Sai, who's writing in from Andhra Pradesh. He's holding 200 odd shares of Mahindra and Mahindra at an average price of 2598. He wants to know whether he should hold, sell or buy at the current levels. Vaishali, with respect to the charts, how is Mahindra and Mahindra faring?
Well, if it's purely for a short-term perspective, there's really nothing much happening. But if he's ready to wait, I mean, continue holding, we can have a target of 3,000, 3,200.
Okay. The next caller is from Noida. Sanjay is calling us. Sanjay, very good morning to you, and how can we help you today?
I had recently bought Shilpa Medicare around 1.5 months back.
1.5 months back.
I had 90 shares around 745.
Okay.
So I like to know future outlook for next 6 months to 1 year.
Okay.
And if Rajesh Garwalji said I can add more, so can you specific from Rajesh Garwal?
जी आप जरा हमसे ये explain करना कि why have you bought this? ये क्या इरादा था तुम्हारा? And when you bought it, what did you look at? आपने क्या देखा था?
मैंने कुछ नहीं देखा. रियली बताऊं तो someone has said me to pick this.
So suggestion था buy करने का. Okay.
Yeah.
Rajesh, on the fundamentals, then would you care to opine on Shilpa Medicare? And I'm pretty sure that you're not going to be as tongue-tied switching languages as I am.
See, switching languages, I don't think that would be much of a problem because I speak it. But as far as Shilpa is considered, I think one should consider holding this stock for a longer period. By longer period, it means at least 2 to 3 years. Company is doing very well in the oncology segment, and they have come out with new drugs, and then the API has been doing well. The numbers have been improving in the recent past. I think the target of maybe 900 plus rupees in the next 2 to 3 years is quite possible. So थोड़ा सा अपना टाइम होराइजन बढ़ा लीजिए और कंटिन्यू करिए और कोई भी गिरावट आती है वो ऐड कर सकते हैं.
क्या बात है. Wow. All right. I need to take some lessons from Rajesh. All right. 361 WAM is the next counter that we're talking about. Is a stock that is gaining quite considerably in the recent past. I don't know what it's doing today. Okay, finally cooling off a little bit. But let's pull up the 1 week chart for this company, for the stock, and it's done particularly well. So we've got viewer Ashok, who is asking about this, bought at levels of 946, so slightly elevated levels. The stock, okay, so it's up about 9% for the week there. So I'm not wrong. Vaishali, on the charts, what is the upside potential? Can he recover his buy price, and upside potential beyond that as well?
So I think keep a support of 900. And upside near-term target I would look at is 1050. So that would be the bounce back that I would see for now. 1050 is a cluster of resistance coming in. So I would say that that's a level to watch for.
Okay, so that's the view with regards to where 361 VAM is concerned. Our next caller, Rajesh, is calling in from Bengaluru. Rajesh, a very good morning to you. How can we help you?
Hello, good morning. Hi, this is Rajesh here. I'm having Sonacom's shares of 190 shares.
Okay.
I'm looking for long-term horizon and buy price is 524 rupees.
Okay. Rajesh, I'll come to you on this one. Sona Comstar, I believe, is the counter that he's talking about. What's the views with regards to that counter, and from a longer term perspective, do you suggest to hold?
See, it's a hold from a side at this point of time. It's a strong play on EV. A large part of their order book comes from EV. But the problem is a large part of order book is again from US, where we have seen the kind of Trump tariffs going on. And I'm not sure that whether the pause given for the auto sector at this point of time is continue for how long. So that's the only problem. Otherwise, the company is doing very well. Strong order book catering to EV. If nothing happens on the Trump side, I think these are levels to accumulate these stocks. So high risk, high gain type of bet. At this point of time, what I can suggest is continue to hold.
Continue to hold Sona BLW. It's had quite the wobbly few trading weeks. But continue to hold is a view from Rajesh. Bajaj Housing Finance is the next counter that we're talking about, and Mahindra Raj is writing in from Jaipur, and he's bought at a price of 135. Quantity is 800 shares. The stock is up and about in trade today, but he's wondering what to do from the long-term perspective. Rajesh, I'm coming back to you on the fundamentals. If I remember correctly, 25% assets under management growth in the fourth quarter. I can't recall exactly, but it was decent. And would you continue to hold this? Would you add more?
At this point of time, yes, it's an add from our side. Company is doing very well. You said it right. The CAGR growth in asset under management is phenomenal. I would say it's one of the best in the industry, if not the best. Valuations are also okay. It's a buy from our side. You can even buy at 130 odd levels. That's trading at this point of time for a target of maybe 20-25% upside in the next 12 months.
Okay, 20% upside. Okay. All right. And stock is already up and about. Today, it's 85% above its issue price. All right. Sanjeevi is calling us from Chennai. Hi, Sanjeevi. Good morning. And how can we help you today?
Hi. Good morning, guys. Thank you so much for having me. Just a quick question to everybody on the panel. So I'm currently holding Asian Paints, which I bought at around 2,700 about 2 years ago. Should I continue holding it, or is it a good time to average out and buy some more and expect an upward trend to happen because the crude prices have crashed? And does it look good for Asian Paints at this moment, or generally any paint stocks?
Okay. Can you help me understand what the time horizon you have in mind is for this stock? Is this a portfolio stock, Sanjeevi, that you're holding?
That is correct. Yeah, I'm looking at a long-term gains over here, at least 3 to 5 years.
Got it. All right.
I don't plan to sell it.
Do you by any chance have any other paint stocks that you're holding?
No. This is the only stocks. This is the only one that I'm holding.
Got it. I understand.
The crude-related stocks, but my question is specifically for paints.
Oh, you have crude-related stocks as well, downstream companies?
Yes, I do. I do have some Oil India and some ONGC.
Okay.
But largely my question was for Asian Paints because that's where I'm sitting on losses.
Got it. I got your question, Sanjeevi. And it's a fair question to ask because a lot of long-term fundamental investors are asking this question. Rajesh, patience with Asian Paints has not been rewarded. And a lot of people are wondering, should we finally pull the plug? And what is your opinion here?
See, I would say try to exit on any upside because as we have seen, Q3 numbers were pretty bad. That was below expectation on every parameter, I would say. And I don't believe there would be any reason to believe that numbers are going to improve in the near future as such, despite the fact that crude has crashed. But we should not forget that once almost a monopoly of Asian Paints, despite the fact that it was not a monopoly, but still it had a fair large number of market share. Now there are a lot of new players. Builders have come in, JSW is coming, Astral has coming. So that competition is heating up. So that is going to take away the premium that Asian Paints used to command. And even after these kind of corrections, trading at a high double-digit PE, so that the valuations are also stretched. So at this point of time, new addition is out of question. any upside should be taken as an opportunity to exit.
All right, a quick view on Anantraj is being sought by Sunita, who's writing in from Hyderabad. She's bought at levels of 460 rupees a piece. Vaishali, on the charts, how does it look?
So I would say Anantraj is one of the good companies. Even if I'm looking at the weekly and the monthly chart, it has come towards support. So right now, I think if he's holding, continue hold. And even if he wishes to add more, these are the levels where take the opportunity to add more and look for higher targets, at least to 700 to start.
Okay, all right. It is time now, the both of you, to get into the rapid fire segment. This is where we throw as many questions at you as you know over the course of 2 minutes. I will start with the first one from Kusuma, who's writing in on Torrent Power for the next 6 months. She hasn't bought yet. She's wondering whether to do so. Any price targets that you have on the charts, Vaishali?
So buy in decline. This is not the level to buy. Around 1500, 1550 is the level to buy. Look for a target of 1750 if 6 months is the horizon.
Okay, Shubh Sharma from Jharkhand. He's saying his father had bought 2,000 shares of Indigo at 750 a piece. Now the stock is trading at 5,200. Should he sell or hold? Rajesh, what's the view like?
If your funds allow, you can even add.
You can add more. All right, yeah. There's a reason why some people are calling it the best consumption play. Gale is the name of the counter we're looking at next. Invested for 4 years is Wilfred. He's gaining profits of about 82% and he's wondering whether to increase his holdings. What's the view, Rajesh?
Good profit.
All right, Vodafone Idea bought at 10 rupees a piece, bought 1600 shares. Exit or hold? Vaishali?
Exit.
Okay, Sudarshan Chemicals. Lakshmi wants to know, she's bought at levels of 1,137. Hold, sell or add on dip. Rajesh?
Hold.
Okay, Sumit has bought 104 shares of CDSL at 900 a piece. He's a long-term investor. Should he hold or sell? Rajesh?
Add.
Okay, Vinita from London is asking about PCBL. 413 is the buy price. She's got a long-term view. Rajesh, should she hold?
Buy more.
Okay, Raghu from Bengaluru is asking about Tata Technologies. He's holding 700 at an average price of 873. Vaishali, what's the view with regards to charts?
Hold.
Outlook on the hospital sector is being sought. 50,000 wants, Lavanya wants to invest. What should she buy is a question, Rajesh?
A lot of stocks. You can go for Narayan Hirdalaya in the mid-cap space.
All right, Sanjay Acharya wants to know if he should continue to hold Tata Motors. He's bought at 986 levels. Vaishali, on the charts?
Hold.
Hold. All right. Thank you to the both of you, Rajesh as well as Vaishali, for joining us today. Absolute pleasure, as always, having you on the program. All right. Well, that brings us to the end of this edition of Ask Profit. We've discussed a lot of a lot of stocks. Hopefully, this has helped you.
You need to get some sleep.
I need to get some sleep. All right. But thank you so much for joining in. We'll be back tomorrow to take more of your questions. So do stay tuned. Up next is Know Your Company, and this is NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company. Hello and welcome. You're watching KYC. It's a show designed to give you powerful, actionable insights into a single listed company daily. And today we're going to talk about Insecticides India. Interesting company per se. It's in the agrochemicals and biological and household products. More into crop protection and nutrition based in that sense with regard to what the company does. It has a portfolio of 20 plus technical products and 125 formulation products. Largely products are surrounding insecticides, herbicides, fungicides and biological products. So those are the four broad based categories of the products that the company does. In terms of domestic, a large part of the sale comes, or rather the large part of the revenue comes from domestic, but it exports to 30 countries with more than 100 customers and also commands a decent amount of an export base in that sense because of the number of customers they have. In terms of revenue mix, and this is where it's interesting because you'll see the skew in revenue being very, very sharp towards insecticides and herbicides. Combined commands 87% of the company's revenue. So look at insecticides is 48%, herbicides is 39%, and then fungicides and biologicals are just about 10 and 3%, so 13% in all. The one big thing that has happened, especially when it comes to an Insecticides India, again a very interesting piece here, that they've moved towards premium products. So their premiumization trend from FY21 to FY24 in the 3 financial years has gone from 46% to 59% in terms of premiumization of product. So therefore generics now starts to command a lower share. This particular trend may likely continue even going forward. The question is, what is the impact of this trend on the P&L, and we'll analyze that when the income statement comes up within our metrics. But essentially this is something that you may want to keep in mind. The other thing is how is it playing out segment wise. So B2C, which was 65% in FY22, is currently at 82%. B2B, which was 26% in FY22, is currently 11%, and exports is still roughly single digit. So that's the segment wise breakdown. Again, why is this relevant? B2C will always command a better amount of margin and therefore is more favorable to an Insecticides India. Can they continue to make that journey? How much can they continue to do that is really the interesting question, and we'll speak with management to try and get a perspective at the end of everything that we are going to speak about ourselves. We'll speak with Rajesh Agarwal, who's the Managing Director at Insecticides India, to also dive deeper and understand this better on what he believes the journey of the company will likely be. But let's talk about metrics as we always do. We'll start off with the income statement and thereafter the balance sheet, the cash flow and the return ratios. We'll keep those common on most companies. So that's how the parameters will stack up. Thereafter we look at shareholding, street cred, valuation and outlook and risks. We'll also look at the risks to the outlook. That will be important to understand. And we'll give ratings on each of the parameters. But Varsha Chandani joining me today morning to try and help dissect this company further. Varsha, income statement with regard, first off, Insecticides India, do you have maybe a thought or two with regard to the business itself?
Yeah, so Harsh, every company has a next leg of growth, right?
Sure.
For insecticides, it is the next leg of growth for this company is the premium products that they are trying to cater to, higher margin products, value added products, which will actually help build up their margin. So this is basically the next leg of growth, and for that they are also doing capex, which will actually speak when we will address the outlook and of course the capacity expansion that the company is going through. But let me just go to income statement. Now if you see, for the last 3 years the revenue CAGR for this company has been like 11%. But if you see in 2023, so in 2022 the revenue for the company was around 1,504 crores, which jumped up, and in 23 it did jump off with at 1,801 crore. And the reason why you're seeing a huge spike in FY23 was because of the capacity expansion that the company did and the new product launches that the company had come up with in 23. However, if you see the margins for the company, margins declined to single digits. Now this is due to, so there you go, from 11% in 23 the margins came up to almost 7%. Now this is due to higher input cost that the company was facing and also the higher inventory liquidation. So what exactly happened, if you see, there was a pricing pressure in the industry. There's still pricing pressure in the industry, and a lot of agrochemical and chemical sector which has gone through, and you're seeing the financials for the company has been very very weak because of the pricing pressure that the overall segment is going through. So for insecticides, you had this inventory in the balance sheet which was sitting at a very high price, and because of the agrochemical pressure, the chemical pressure that the industry was seeing in, the end product prices were very low, which actually impacted your sales and which actually impacted your margins, because you were buying at a very high price, the raw material you bought at a very high price, and the end product you were selling at a very low price, which actually impacted your margins. And that's why we are seeing the margins at almost 6.3, 6.8 or 7%. Now, so overall, you see, Harsh, the growth for this company has been slow, like 11% CAGR. Of course, because of the industry dynamics, the pressure in the agrochemical sector. But the one thing which we should actually ask the management, because we have seen that you were talking about, the increasing premiumization, but that has not led to increase in margins. That's the one question, that we should be asking to management.
Yeah, so we'll contextualize that, and thank you so much for giving that perspective as well, Varsha, that margins haven't bounced back despite that premiumization. Something to be kept in mind. Let's look at the balance sheet now. Shareholders' equity plus reserves would roughly be 1,100 crore. It's a 2,000 crore market cap company, so trading at 2x price to book. You're looking at long-term borrowing, which is probably less than 65 crore. And or rather long-term plus short-term less than 65 crore, and therefore the cash surplus that the company actually has is more than both the long-term as well as the short-term borrowings, which kind of nullifies any major risk that could affect this company. Plus on top of it, have to keep in mind that the market capitalization of the company is 30x of the cumulative borrowing, and the EBITDA number, annualized EBITDA number, is nearly 2.5 to 3x that of the borrowing number, and therefore enough margin of safety, enough comfort with regard to how balance sheet strength looks. Capital allocation seems to be happening okay and largely from retained earnings, and no borrowings are currently being used. Efficiency of that we will leave to the viewer because it's a cyclical business, and therefore something to be kept in mind that large borrowings on the balance sheet of companies like this can well impact the numbers, especially profitability, in years in which there is a bit of a slowdown, which it has experienced in FY22, in FY23, and to a certain extent in FY24. Am I right, Varsha, when we look at it this way, that generally a larger debt on companies like this especially can pose a very large risk because it's a cyclical business?
Exactly. And so the good thing is that, as you mentioned, the debt to equity ratio for this company is really low.
Yes.
So that is the advantage that the company has got, considering the pricing pressure that the segment is going through.
Fair point. What about cash flow, Varsha? How is that evolving?
So I would say it aligns with the income statement, first of all. And the other thing is, if you see, if I strictly speak for FY24, the cash flow from operation was around 184 crore, while the net cash flow is 43 crore. Now, if you see in FY23, cash flow from operation was negative 11 crore. Now, one of the reasons is because the company was sitting at a huge inventory. Your cash was stuck in inventory, and that's the reason you're seeing this negative cash flow from operation. And the net cash flow, of course, was negative 17 crore. But overall, if you see, because in FY23, as we spoke, that the company had a huge growth because it did a lot of capacity expansion, was going into a lot of capacity expansions, and this is the reason you're seeing, one is inventory. You were sitting at a very high inventory, then capacity expansion was going on. So that 1 year was very negative when it comes to, cash flow perspective. But in FY24, if you see a good cash flow from operation at 184 crore, and finally net cash flow at 43 crore. So we would give a kind of neutral rating for this segment.
Point taken. What I'm not liking though, Varsha, is the return ratios, and I've given this a thumbs down from a perspective that when we're looking at how the return ratios are playing out, we're seeing the ROC numbers at roughly 14 to 16% in FY21 and 22. Thereafter, we've seen a blip, and we've seen them remain there. So it's been anything between 9 to 13% on the ROC metric. The ROE numbers look even weaker in that sense. You're seeing around 7 to 11% ROE with FY21 and 22 looking not even at teens in terms of the ROE number. What you would want from a company which is small is to be high ROC, because you want it to grow quickly at a very, very good return to equity and return on capital employed. That is not reflecting fully at this point on an insecticides India. To a certain extent because of the industry in which it operates in, to a certain extent also because of some headwinds that have come through. The question will be that can they hit at least a basic early teens kind of ROE number? That will really be the question. So for now, we're going to give this a thumbs down because it continues to invest capital of shareholders back into the business. Right, Varsha? Yes. It invests straight back into the business, doesn't use debt to invest in the business, and therefore you want it to get better return on equity for shareholders. If it's not doing that, it may not be the ideal business to invest in, unless Harsh, it's at the right valuation.
On that point, I think in FY25 also you would see some kind of compressed return ratios because they are going for the capacity expansion. So again, correct. High denominator and lower numerator, yeah.
Perfect. So there'll be a pullback there. But yes. Varsha's shareholding? So we would give a thumbs up on that matter, because promoter, now skin in the game, that's very important when it comes to any company. 72% stake by promoters, which is very good. FIIs at 4.5%, though they have decreased their stake, but still okay. But what interesting here is DIIs, which has almost 9.5% stake. Now,
From this, almost HDFC small cap has 9% of stake in this company, while public has almost 14% of stake in this company. So good promoter holding, and of course followed by DIIs and FIIs.
Yes, interesting one, that one. Let's look at Street Cred as to how the stock has done. Over the last month or so, while the stock has done fairly well for itself, markets have been buoyant as well. When we're looking at the year-to-date data as well as the data when on the, there you go, that's the 1 year performance, which is roughly 12% odd. You're looking at a return ratio which is slightly on the muted side, even when we're looking at the 5 year performance, just about a 2-bagger. So overall, we're giving this a neutral because of the way in which the stock has moved. Last 6 months has been difficult. Last 12 months, not as bad. Essentially, it's done fairly well for itself. And the last month or so and year to date also, month or so has done well, but year to date has been muted. That's how it's played out on this one. We'll give it a neutral. But Varsha, on the valuation picture.
So, Insecticides India trailing at what, 14 PE appears compelling if you compare it with their peers, that is the Dhanuka Agritech and Sharda Cropcom. Now, if you see, I would say recovery is expected. Now, this is on the back of ramp up of new production and also increased share of high margin products, which will eventually lead to higher EBITDA margin and of course higher profitability, and also the acquisition that the company has done will impact their profitability in a positive way. So overall, if you see valuation at 14 times doesn't seem a kind of a premium valuation, but you have to consider 3 things, while evaluating this company. One is the higher exposure to premium products should lead to higher margins, and how the capacities expansion will play out for the company, what would be the capacity utilization that the company is targeting into, and of course the new products that the company is expecting. I think 10 new products is expected in FY25. So all these factors will actually lead to valuation re-rating, considering the demand, the positive demand that all the agrochemical companies are expecting.
Yeah, a possible valuation re-rating, Varsha. I'll just caveat it at that, but a 30% discount is significant. I take your point on that. Let's look at what the outlook looks like, and Varsha, please chip in, because you know this maybe better than I do. Let's talk about premiumization strategy. There's a premiumization strategy which is in place. It's going to contribute around 65%. Premium product is going to contribute roughly 65% in the next 1 to 2 years, which is currently at 59. It's better margins. They're going to grow premium products at around 20%, which is very, very healthy. You have new launches in the pipeline, and you have an aspirational EBITDA margin of 12 to 13%. Now, help us dissect this. Is this realistic? What are the risks looking like to this commentary?
So, on that margins front, when I look at the trend, Harsh, when you are increasing your premium products, there has to be increase in the margins, which the company has not seen.
And the B2B to B2C shift as well.
Exactly.
Those two things.
Two things. But I would give a benefit of doubt, considering the pressure that the company has been going through. But one thing is that if premium products are increasing, your margins have to improve. Number 2 is the launches that a company is going into. We need to see, because 10 launches were expected in FY25. We are in the last quarter. Hopefully that those 10 products would have been launched. And the third thing is the acquisition that they did will actually impact their profitability in a positive way, and that's one of the reasons why company is expecting double-digit growth, rather double-digit EBITDA margin. But the key risk that any agrochemical company faces is, one is of course poor demand and the delayed product launches that the company may see, and volatility in input costs will actually impact company, which they've seen the impact. And lastly, the pesticides ban, if government can consider, which may impact the company in the future. So these are the 3 main risks that the company may go through.
Perfect. Point taken. Let's quickly go across, before we go to management, look at what our KYC rating indicates with regard to this one. That's how we stack up in terms of our first 4 metrics, the next 4 as well. There you go. Those are our next 4 metrics, and therefore we stack up on as a 5 on 8 with regard to our KYC rating for an insecticides India. Let's go across to management. Let's speak with Rajesh Agarwal, Managing Director at Insecticides India. Sir, you know, a lot of our analysis also has hinged on the fact that there's been plenty of headwind for the industry as a whole. Talk to us about the unwind of that headwind, because we are seeing that as it plays out. How quickly can that happen, and how should your numbers therefore appear in FY26 from a growth perspective, purely from a top line perspective?
Okay. I would say that a big change has come in these past 2 years, because after the COVID had gone, the prices of all chemicals had declined and we had to face that impact, and we are out of that impact fully in FY24 itself, and 25 will see the improvements. I cannot declare the numbers because the results are yet to come, but I'll say that we'll have the all-time highest profitability in FY25, and this thing is going to continue in FY26. In terms of the top line growth, yes, we will be targeting a good top line growth in FY26, roughly about 15%. And majorly this entire top line growth, the target will be to bring it from the premium products itself. So that is the focus as a strategy. And I believe that the response which is looking for the season, the response which is looking for the products, what we have launched in the previous last few years is very good. And looking at that complete situation, I believe that we should be able to do this.
Right. Sir, Varsha here. Very good to have you. So as I understand, so the next leg of growth for Insecticide India is, premiumization, which you are expecting 20% growth also. Just wanted to have an update on that, because over the years you have been seeing the contribution of premium products going up, but that is actually not coming into your EBITDA margins. So just wanted to understand, with this 20% growth and with the contribution that you want to take your premium products to, what kind of EBITDA margins are you expecting maybe in next 2 years?
We'll keep on moving up step by step. I don't want to give very hefty numbers, but I'll say that we'll make a full recovery. In 25, we'll be happy with our results. In FY26, it will be evident from the first quarter itself, and all our quarters will show good performance. I am confident. And we can say that 10 to 15% type of growth will keep on coming in the next 2 years. So we can say roughly about 1.5% type of growth is possible actually in this FY26, and should be possible in the next year also.
Got it. And also one more question from my side. Considering your export business, I guess it's 8 to 9% export contributes to your overall business. Now, where you want to take this contribution to? Will you have a double-digit growth when it comes to export business in 26 and 27?
Yes, that will be, because we are working with many companies. We have started bagging some registrations. Very recently, we have bagged some registration in South America, and the business is going to start. So that will take us to the next level. And we are also having some like transactions are on, discussions are on with a lot of Japanese companies also. I see a breakthrough from there also. So I see a good outlook. This year, we'll be keeping our high growth targets for the export business. We wish, like we have been doing about 100 crore plus of export business. So this year, we wish to take it to about 200 crores.
Understood. Mr. Agarwal, you seem to be suggesting that Q1 of FY26 onwards, margins will take a sharper rebound. What are the levers that are giving you that comfort that margins will rebound? What has changed between FY25 and FY26?
We had launched a lot of products and we have very good response. Most of these products are herbicides, particularly the maize herbicide, the rice herbicides, and we have got herbicides for almost every crop, and we are the brand leaders, even in soybean, in pulses, in sugarcane, we have got good solutions. In wheat, we have launched solutions. So we are backward integrating, making the AIs by ourselves, launching the brands, and also we have launched certain mixtures, which are the patented mixture. So that is giving us the edge. And very shortly, we are going to launch one product of Nissan also, which is going to be a rice herbicide. So that is also going to give us an edge. And in the previous year also, we have launched one rice herbicide, which is a mixture, patented mixture, which has already gone to the market. So looking at our premium products, I'm very, very confident that we'll start getting the sales from Q1 itself. And this is going to remain throughout the year, because Q1, Q2, Q3, we have products for all. And we should get very good response from the market. That is my assumption.
Understood. So how should we look at the journey here, sir? You'll grow roughly 20% in terms of your premium segment, right? That will grow at roughly 20%. Top line is your guidance. You'll go towards a double-digit kind of margin in FY26 and thereafter move towards 12 to 13%. Where will premium products be in terms of the overall mix, therefore? And how much does premium and B2C contribute? What are the margins like on those products versus the others?
Like the premium products are the ones which are giving good margins. Roughly, if I talk about the gross margin, not on EBITDA level, that will be about 35%. And B2C can go up to 75, I will say, in totality, because what you were showing on the in the graph was 1 quarter figure. So generally, the B2C sale, B2B sale is also strong in Q1 and Q2 and Q4. Q3 is subdued quarter actually. So in totality, we see the B2B contribution would be something around 25%. 75 or 70% will be coming from B2C, and export will be contributing somewhere about 6, 7, 8% actually. So this will be the tentative percentage.
Understood. Also, you have one automated plant which is coming up in Rajasthan, which you have done a significant investment there. Just wanted to know what are the timelines of the completion and how this will impact your, top lines, and when can you see the financials coming in from this plant?
The target here, it's a place called Bherod. The specific place is Sotanala Industrial Area. Here we have taken over a 15-acre site. The plant is under construction. The target is that we wish to start the formulation in this plant in April 26. And in next 2-3 months, in the Kharif season itself, we wish to start with the technicals also. Yes, this will be DCS plant, and we are working on this. And I'm quite confident that we should be able to complete this project within 1 year.
So one last question on how should we look at this. So around a 15% top line growth with roughly a 10% kind of margin would lead you to around 200 to 300 crore of EBITDA over the next couple of years, 250 to 300 if I were to be more specific. And thereafter, if I cut out depreciation and taxes, that will leave you with a PAT of roughly 150 crore. Is that the right way to look at the journey, or maybe over the next year or two in the near term?
I don't have the results, but that will be my target for FY25, not 26. So 26 will surprise you with our results, and the results will be evident from Q1 itself.
Okay, noted, sir. Thank you so much. It's been a pleasure speaking with you, and great getting that context from you with regard to Insecticides India. But on that note, from Varsha, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome, you're watching The Big Question. I'm Tamanna Inamdar. Once hailed as a rising star and stock market darling in India's clean energy space, Gensol Engineering is now back in the headlines for all the wrong reasons. What has happened with Gensol is a story of bold promises of a cleaner future, which has now descended into a murky tale of financial mismanagement and misused funds for personal extravagances. The latest blow came from SEBI, which has now barred promoter brothers Anmol Singh Jaggi and Puneet Singh Jaggi from directorships in the listed companies, stopped the company's planned stock split, and named a forensic auditor to investigate the matter. The regulatory action comes after a probe triggered by a complaint from June 2024 about share price manipulation and fund diversion. What SEBI has uncovered is some damning details. Backed by loans worth nearly 978 crores from government-run lenders like IREDA and PFC, the company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. 260 crores remains completely unaccounted for. The company has bought only some 4,700 EVs, which is fewer than promised. Not just that, funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias, where the going price starts at 64 crores for a 4-bedroom, golf sets worth 26 lakh rupees, money transferred to accounts of wife and mother for personal use, money used to fund trips, payments of credit card bills, among others. Imagine that's not even the worst part. The company promoters have repeatedly lied to investors, and there are a whole lot of them. 36% of the free float of the Gensol stock is held by retail investors. They are left holding the bucket today. SEBI has noted that the company made misleading disclosures to investors filled with hollow MOUs. And when NSE officials visited their Pune plant earlier this month, what they found was shocking. Against the claim that the company has received large orders to build electric vehicles was a non-operational factory, no production, no staff, no minimal power usage, effectively indicating that there was nothing being done there. Based on this, SEBI has not minced its words, calling it a complete breakdown of corporate governance. It has also said that a listed company was being run like a proprietary firm. SEBI has accused that company funds were being used as if they were the promoters' piggy banks. Now, why has this shocked everyone? Gensol Engineering, of course, is a listed company that positioned itself as a key player in India's green energy transition. Its spectacular fall from grace has broader implications and lessons. The company has seen a market cap erosion of 6,890 crores since the second quarter of FY24. Its current market cap is just 490 crores, down from its peak of 7,380 crores. Share prices of the company have fallen over 80% from their high of 1,126 rupees. The Gensol episode has raised a series of tough questions on corporate governance, the regulator's role, credit agencies, etc. But the biggest one is, how did the promoters of Gensol Engineering get away with this scam for so long? To speak on this, I'm joined by Hetal Dalal, President of IIAS, Dr. Purva Javrekar, former member of RAC, SEBI, Pankaj Tibrewal, founder and CIO of Ikigai Asset Manager, and Suhail Nathani, Managing Partner at ELP Law. Welcome to all of you, and thank you so much for speaking with us today. Hetal, I'm going to begin by just getting your take. Now, I know this is an interim order. A forensic audit will follow, and probably if the requirement is there, it could go ahead with criminal charges. But as of today, investors watching this, and retail investors especially, what they're seeing for the Jaggi brothers is a slap on the wrist. They're barred from accessing capital markets. The stock split has been barred, and that's pretty much it.
Yeah, look, I think this is a very classic case in terms of what you typically see for companies which are not very well governed. I think when you look at the options for retail shareholders, they are limited. There is a legal action, of course, and they can 100 shareholders can get together, or 10%, or shareholders holding 10% can get together and either seek an operational mismanagement case, or bring an EGM, try and remove the promoter. But by and large, at this stage, I think from the shareholders' perspective, they can only hope that SEBI is able to bring about a change in management. I think the issue from what the SEBI order seems to suggest is very clearly an orchestrated plan to divert money from the company into promoter-controlled company for whatever be the reasons, including personal expenses and extravagant lifestyles. It's not a new story. And I think the fact that SEBI has come out with this interim order is indeed based on a complaint that investors have filed, is a starting point to some of the redressal to what has actually happened in the company. But I think at this stage, it's too early to call on what the final action will be. Yes, the board, the promoters have been barred from being on the board and holding key MPs. It doesn't really stop them from, remote control of the controlling the company through remote controls. But notwithstanding, at this stage, it's still a step ahead than where it was earlier. And from the shareholders' perspective, they can only hope that SEBI takes a much stronger stance in its final order. This is an interim order.
Yeah.
In the final order.
No, of course. What I think it's important for us to understand is the extent of fraud. Now, we have reached out to the promoters, and through this medium, I'm once again saying, come and speak to us if you have something to say, if you have a response to this, because there are two things. One is that, you are trying to run your company, you don't manage to. A lot of companies fail for a variety of reasons. That's one part of it. The other part is that you've gone out of your way to fool people. And that's where it gets shocking. I want your comment, Pankaj Tibrewal, on what this means from investor confidence point of view, because when the details come out, and I'm just quoting from the SEBI order, the promoters have diverted money to the mother, the wife, luxury flats, spent money on personal trips to the tune of 3 lakh rupees, shopped at Titan, bought golf clubs. I mean, it's a free-for-all that was going on here. Is there any other side of the story possible with the facts that we have right now?
So Tamanna, I think, as I've been saying across at different forums for the last 2 decades, investing is simple but not easy. And hence, corporate governance and forensic check becomes extremely important. We have a 11-point forensic framework. And if you look at the one most important thing which never lies over a period of time is cash flow. And we look at cash flow to EBITDA conversion. And generally over a 4-5 year period, if the cash flow conversion is below 70%, it's a red flag for us. And there are many other parameters like change in reserves, volatility in depreciation rates, auditors' remuneration in relation with the revenue growth rates, related party transaction, and so on and so forth. And we have given it as a part of our presentation, which is on our website, that what are the 11 forensic framework points which we go into. Also, in December, we wrote in our newsletter the IPO mania which was going around. And just to put numbers in perspective, so last year, 317 IPOs, total raise was 1,80,000 crores. And the average subscription was about 28-29x. An average listing gain was about 40%. So every investor thought that any company which is coming for IPO is a great company. But if you look at 2 important data points, which we have mentioned in our newsletter in December of last year, that if you look at over a more than a decade perspective, the companies start to pump up their revenue and their EBITDA and profit just before listing. So a couple of years before listing, you saw a very sharp curve of revenue and EBITDA and profitability going up, and cash flows being extremely weak. We see a huge amount of related party transactions before the IPO on the listing, before the listing. And after the listing, just the opposite happens, that the slowdown in revenue starts to happen, slowdown in profitability starts to reverse, and the real, character of the company. And just to put numbers in perspective, over the last 22 years, only 51% of the IPOs listed on size of 50 crores and above have been able to outperform Nifty. And only 26% of the IPOs listed have been 5 baggers or more. So in the short term, IPOs look like a great thing, but don't forget they don't have a history. And I think history is extremely important because tigers don't change their stripe. And hence, we always advise caution that whenever you are investing in an IPO company, make sure that you do your proper ground check, forensic check, whatever data you have. And if not, stay away for a while. Let that company show and perform over the next 12, 18, 24 months, and then take an informed call. Because there are companies which will never change their stripes. And the company you are mentioning is one of them, where all kinds of corporate governance issues have evolved post the listing of the company. And people fell into the wrong narrative, and they're losing money. So it's an unfortunate part.
No, so 2-3 very important things pointed out here, and I'm going to come to you, Suhail Nathani. In terms of liability, of course, the promoters who are using public wealth, shareholder wealth, they have gone ahead and even forged documents from PFC and IREDA and given it to credit rating agencies saying, yes, we are paying loans when they're not paying back loans. So false information given to exchanges. There's a whole host of criminality. I'll ask you about that as well. But what about the enablers? What about the people who came out and said this is a good stock? Mr. Tibrewal spoke about doing forensic investigations. How will a retail investor go to the factory and see that nothing is happening? I mean, NSE had to pull out Mahavitran electricity bills to come to this conclusion that nothing was being made there.
Sorry, Tamanna, is that for me?
Yes, Mr. Nathani. Yes, sir.
Okay, so when you talk about enablers, corporate governance has a framework around it. Okay, so there were failures at many points. If you look at this company, it had a lot of independent directors.
Yes.
It had an auditor. And if this fraud was so egregious, and I'm using this in a possibility situation because this is an interim order and as lawyers, nothing's concluded until it's concluded. But assuming all this were to be true, the fact is that how can the auditor not know there's no factory in existence? These are very serious breaches and fundamental breaches going to the root of the enablers or the gatekeepers, independent directors, auditors. Then there's another situation here. The other situation here is that these are the most fundamental of quote unquote fraudulent transactions. It's directly gaining in the hands of the promoters. So, sending the money into the wife's account or the mother's account. Something is definitely amiss. This is a pattern, and unfortunately, that repeats itself often times in this kind of fraud. But the data available seems to suggest that something else was occurring. And the point you make about forging papers, once you go down a slippery slope, then you do anything to save yourself. So when they were asking about the loan payment, so if you see the SEBI order, there's a table on what loans were delayed and whatever else. Rather than giving that information, they forged the comfort letter from the lenders to say the account isn't. So once you're down that slippery slope, you're going to grab any rope you can. And I think this is a tragic case of very poor corporate governance. And there are several consequences. One, of course, SEBI has acted in a timely manner and has acted in the limits of its power. Two, there will be criminal consequences. There will be auditor questions. There will be a whole bunch of questions that come out of this. And unfortunately, it is going to take time. And this is what will hurt investors, because until all this is settled, value of the company is going to be affected.
The slippery slope is at one end, and of course kudos to SEBI for coming out and investigating all of this. The company in question, it's a listed company, the stock is still trading, has not even come out with one word of explanation. Dr. Apurva Javadekar, give us your perspective of what is the extent of liability. For now, the promoters have been asked not to participate in stock markets or hold any key positions, and that's pretty much it. But how far and to what extent can any punitive action go?
So thanks for having me on the show. Just a disclaimer, I'm speaking in my personal capacity, or not in connection with any work done for SEBI in the past. Having said this, I think the charges that can be brought by SEBI are limited. Well, SEBI is it's a regulator for listed companies. I think if the charges are of criminal nature, that can be brought under by different different departments like SFIO, serious fraud investigation, and so on and so forth. I strongly feel that in this case, if the data that is out there has any merit or truth, then I think all those agencies will be involved sooner or later after SEBI sort of comes up with a final order. SEBI has already in the interim order barred them from participating in the securities market, but I think they can also sort of make credit rating agencies answerable to some extent, because in this case, really, internal governance is one thing, but there are at least 4 external agencies that are involved: auditors, the lenders and their due diligence committees, the credit rating agencies themselves, and there were ample signals even before SEBI sort of came up with the interim order that things are not in according to what
like what Dr. Javadekar
should be.
No, I'm glad you brought this up. No, because I just want to tell our viewers, on 10th of March we did a show right here on NDTV Profit on a program called Know Your Company, where we went into detail of Gensol. You can go on our website, you can go on our YouTube channels, where we have threadbare laid out why this was a fishy situation. But having said that, Dr. Apurva, what are the smoke signs or the red flags that people should have seen and we should have acted on earlier? Because this company is listed since 2019.
Right. So multiple on observable in public domain, it was kind of known from the financial reports of the companies that related party transactions are a big part of the revenues compared to the peers. So related party transactions are always a red flag. In fact, some of the other exchanges like Singapore and Hong Kong make it mandatory to have independent financial audit of specifically for RPTs before IPOs and so on and so forth. So RPT was a flag. Promoters were placing their shares beyond a limit. 70-80% of promoter shares are already placed. Debt was rising very fast. Interest coverage ratio is low. That's all in public domain. So you should have already seen that coming. But from rating agencies' perspective, because this reminds me of the Wirecard fraud that happened in that was a German tech company, a fintech company. Again, there the auditors relied on the self-reported data, and Wirecard was repeatedly saying that we have $1 billion cash sitting in our Asian bank, but no cash was to be found at the end. And again, this was just based upon the self-reported data. Here also, the promoters seem to have forged the letters, like the letters for on behalf of the lenders, PFC, and so on and so forth. But CRAs, the credit rating agencies, could have got an independent confirmation from the lenders themselves. Open banking is out there. You can obviously get information from CIBIL and Pharma about the defaults. Defaults happened in end of December.
So who was supposed to do this?
2024.
No, Dr. Apurva, who was supposed to do this? Because you had
my sense is audit. Yeah. Sorry, my sense is auditors in the routine course should get some independent evaluation of some of the balances themselves. They can get it. They have the authorities, and as well as credit rating agencies. So I think both of them. And internal audit committees, most of these related party transactions go through internal audit committees. So that, all those agencies or the offices had enough powers to do this. The one interesting point I would like to say, though, is the fraud. Fraud seems to have been perpetrated or implemented through a non-related party, which is Jio Auto. However, SEBI's regulations, LODR, mandates now that if a transaction is with a non-related party, but the ultimate benefit is going to be for a related party of the company, then that transaction ought to be reported. So that is a one violation from that SEBI has highlighted. But yeah, that's sort of interesting point that how companies are going at length.
Pankaj Tibrewal, this point that if the promoters want to perpetrate a fraud and use public funds as their piggy bank, then where is the watchdog till the ultimate watchdog, which in this case is SEBI, steps in? What were auditors doing? What were independent directors doing? What were credit rating agencies doing? And do you think that there is a larger role than what is apparent right now? Because think of it from an investor's point of view. They think all of these checks and balances are there in the system.
See, Tamanna, on the hindsight, we can ask questions to all of them, right? But the final, responsibility lies with the investors while doing their due diligence. And I believe that in India, getting the right promoters is the most important. We did a masterclass last year, 7-8 months back, when markets were at their peak with your colleague Neeraj. And the main point was what not to do in investing is most important. And I'm not very, I'm not very sorry for a lot of investors in this case, because the writing was on the wall. If you look at the last 5 years cash flow, operating cash, they had not made any operating cash flow. Actually, it was negative. So people were getting carried away by profit growth. But cash finally is the reality. And I always say top line is vanity, bottom line is sanity, finally cash in bank is reality. And hence also every part, auditor, regulator, rating agencies, bankers all have a role to play. But with the intention of the promoter is to do fraud, how can you prevent it?
No, so I don't know. Okay, no, so I don't know. I don't know if I entirely agree. If this is the
intention, you have to do that groundwork.
How will a retail investor go out and do this groundwork?
Don't invest directly then into stocks.
Hetal, do you agree?
My point has been very, very clear.
Hetal, do you agree? Go to a mutual fund.
Equipped of doing research.
Yeah.
Why go into that area and do the stock picking? Many stocks, when they were flying high, people were saying that, what have you done as a professional manager for 20 years? You're only giving 20-25% compounding. Look at my portfolio is flying away to 5x, 6x. Now the reality is, when liquidity comes down, all these skeletons starts to emerge. We have seen cycles after cycles, Tamanna. This is not for the first time. And the point which I am trying to derive is that if the intention of the promoter is to do fraud, whichever checks, balances, everything you do, if the niyat is not right, it will finally reflect at the outcome. So we may debate that what were the other agencies doing, what were not doing, but finally it's the call of the investors that what is the reason they invested in this company. Was cash flow there? Answer is no. Were other corporate governance issues checked out? Whether the promoter's background was checked out on what they have done in the past? Answer is no. So let's not try and fundamentally question all the other. They are also maybe surprised by the intention which.
So no, okay, that's a point of view. We're having a conversation. We're having all different points of view. Pankaj Shibrawal is saying that अगर चोर चोरी करने ही वाला है तो आप अपना पर्स संभाल के रखो. Net. But then you know who is responsible? Then why should retail investors then have faith in the Indian market? They do if they think that none of the system is working. Let me just get more points of view.
Just a minute, I wanted to make.
Yeah, okay.
You saw the biggest thing in Satyam in 2000.
Yeah, and no one can say that was not a top-rated company at that point.
It was the favorite company owned by so many people, but the intention was to do fraud and show cash as a part of the bank. And that's why we have in forensic called cash yield. In many companies, what we see, the earning on your cash balance is 1 or 1.5%. What does it mean? That if you're earning below your repo rate, that means the cash in the bank is not there. That means at the quarter end, you are showing cash balance because your yield can't be 1.5, your treasury management can't be so bad. So I'm saying that when you have those checks and balances very early on, you can know what to avoid. And in India, to be honest with you, out of the 5,000 listed companies, you need to know where not to invest in. And then your list of where to invest in becomes actually...
I'm running out of time. Let me quickly get more views in on this bone of contention. Whose fault is it? Hetal Dalal. If these promoters are indeed for fraudulent, as a SEBI interim order says, they can't help it.
Look, I think I'm with Pankaj on a lot of these things, right? My view is that, yes, if there is an intent to fraud, it becomes difficult. But I think there is also responsibility from the investors' end. Let's talk about related party transaction. That is clearly a red flag. In most instances, that's something one should question very carefully. Now, when you look at the transactions you brought up in December 2023 or even August 2023, right? All of these are basically providing securities or, support to family companies or group companies. The question is why? Now, in this instance, the audit committee failed to answer that question of why should a listed company provide support and financial support to group companies. Two, how many of the retail shareholders really voted on this transaction? Right? These transactions get put to shareholder votes. Retail shareholders only want to make money. They're really not looking responsibly at how the company is operating and whether they can exercise their right and their franchise as a shareholder. So if shareholder democracy
so exercise your right. Fair point. Suhail Nathani, just last point from you. I mean, at the end of the day, at least in terms of equity investors, no one's there to ever bail them out, as it should be. That's not how the system works. But will these promoters now be liable for what they've done, apart from the SEBI rap?
I just want to step back. One, I can't disagree. If the promoter wants to commit a fraud, it's very difficult to catch him. But in terms of the market needs to function. There has to be basic trust. You can't assume that, a fraudulent promoter can get away with anything and for the longest period of time. We've had this since time immemorial. The market needs to work and it can't be down to only the investor. Of course, caveat emptor and all that is well known. But what about the systems that were already in place? The point was made by Dr. Jatlikar that where was care? Where did they see when the lending agencies didn't follow the money to actually see that there was a plant up or not? How many cars were bought? The market needs to work for investors to have confidence. It can't be the investor's responsibility to check out everything 100%. Some fundamental issues just come from a solid market. And frauds happen everywhere. Germany, you heard, by fraud, USA, all the places they happen. But we continuously need to improve our systems. And don't forget, this is an SME IPO. You may want to look at how many SME IPOs have had.
I agree. That's the next question. We need to go back to the drawing board, and something Pankaj Tibrewal talked about, and they've written about that. Watch out for this IPO boom, because there could be a lot of muck hidden under the surface. We're not saying it's everyone and every SME IPO. We're not claiming that. You can't broad brush. That's not the claim, but you need to be careful. And for those who have defrauded the public so blatantly, well, I hope that there is clear comeuppance coming. It's just not enough to have a SEBI interim order. Much more, hopefully, to follow. Thank you to all of you for joining us on the show today. We'll take a very short break, but stay tuned. A lot more coming up on the other side on NDTV Profit.
That's huge. That is a biggie. It's on there.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the out
recover from day's low to trade flat. Nifty trades well below the 23,300 mark. Sensex at 76,700. Nifty PSU Bank leads the way in sectoral action. Media and defense among winning sectors as well. Metal, auto and IT drag the most. Gensol Engineering gets locked in lower circuit, down 5% in trade. This after SEBI barred companies' promoters from securities market for fund diversions. Company's 1:10 stock split plan has also been put on hold. Also watch the full coverage on Gensol India only on NDTV Profit at 6 p.m. Sigh of relief for IndusInd Bank. Stock gains more than 5% as external auditors find 1,979 crore rupee impact in derivatives portfolio as against the estimate of 2,100 crore rupees. IRDA buzzes on strong Q4. Profit soars 49% to 502 crore rupees. Net interest income jumps 58% to 758 crore rupees. Chat with management coming up on the show. Nifty Pharma dips as US Commerce Department starts investigation on pharma imports under its Trade Act. What could this mean for the Indian pharma sector? Detailed analysis on this show. Wipro all set to post its Q4 results today. Revenue expected to rise 1.6%. Net profit is likely to fall 1%. Will there be yet another flat quarter for the Indian IT giant? We bring you more details on the show. Hello and welcome to Profit Buzzers. My name is Mika Barve and with me is Hiral Daldia. And Hiral, let me pass on to you. How are the markets looking like right now?
I mean, it's an interesting day of trade. We are at 23,350 Mika. And from here on, what's the upcycle looking like is the key. And if you're able to sustain, then there is a potential of a rally that could continue. The FI number is also going to be very important today because that is going to tell us whether there is short covering happening in the markets or not. But though we are off the day's highs, but from the lows, we are again seeing a recovery. We hit a low of 23,273 in terms of Nifty 50 in today's session. From there, we are back at around 350 levels. So a 75 points recovery coming in there. Let's quickly pull up all the, a heat map in terms of individual sectors as well and see where the gains are coming in and where the losses are in today's session. Clearly, you have auto, which is on downer today. Metals is taking a beating, IT as well. And the Pharma pack, which is in the red. But what's gaining is the PSU Bank Index and the Private Bank Index, which is seeing gains in the range of 1.2% to almost 2% as we speak. Media is up in trade. Defense, second or third consecutive session where the up move has continued. Oil and gas is seeing a good run overall. So that's with regards to individual sectors that we can speak about. But let's quickly look at the Nifty 50 heat map and the contributors as well as the next one. If you see in terms of the heat map, IndusInd Bank is the top gainer for the obvious reasons with regards to the downtick or the impact on the derivative account. That number has been lowered by PwC in terms of their estimates. Axis Bank is on an uphill. Trent is seeing a good run today. HDFC Life as well as Eicher Motors and JFS is in the positive. Maruti, Hindalco, Bajaj Finance, Bajaj Auto, Shriram Finance are the ones which have been trading under pressure. Let's also look at the contribution heat map in terms of Nifty 50 because that will give you an idea as to which are the stocks which are holding, helping Nifty hold up to the gains. Axis Bank, ITC, Trent, and an IndusInd Bank are the ones which are contributing. What's interesting is your ICICI Bank, which was one of the top gainers in terms of yesterday's session and was helping Nifty 50 hold on, is the one which is contributing to the downtick in today's session. Bajaj Finance, Infosys as well as RIL. In fact, Wipro will be reporting numbers today post-market as Infosys will be reporting numbers tomorrow post-market as. So that's going to be a sector that will be on everyone's radar. So that's with regards to where, your large caps go, Mihika. But the trend remains absolutely interesting with the broader markets as well, and a lot of stock-specific action that you're seeing.
And they are outperforming. You have the Nifty Midcap, which is up almost 0.6% right now. The Nifty Small Cap, actually, the outperformer of the day, up almost 1%. If you look at the small cap, some of the small cap counters, you have 184 advancing versus 58 declining. JBM Auto is on my radar, up 11%, and we'll talk about why the stock is buzzing in just a short while. GMDC is also up 10.5%. DOMS Industries, Swans, Electra Greentech, NBCC, all of these counters are up over 5 to 6% in trade right now. On the other hand, in the small cap space, something that's not doing well is an MGL on the back of the APM allocation cut, and AstraZeneca and Anand Rathi also, under pressure. I also want to pull up a Shree Renewable Technologies. The stock is buzzing in trade and will be noting and reporting its Q4 numbers today, and the stock is in the green, up over 4% right now. Lastly, just taking a quick look at the mid-cap space, which the index is up 0.5% right now. And if you look at some of the counters, you have 101 mid-cap counters in the index gaining right now. Something like an IREDA, which we will be talking about in just a minute, up about 6% on the back of its Q4 numbers. And MRPL showing an uptick as well, up about 5%, followed by something like a Thermax and Paytm also showing strength of 3%. But IREDA is buzzing on a strong Q4. It's up 6%. Profit has soared 49%. Harsh, we have you here in studios right now. Could you give us a view, and we'll be talking to the management price?
Yeah, absolutely. Very, very strong numbers, as you correctly pointed out, Mihika, in terms of the way this company has taken shape since listing. It's regularly been posting a very strong set of numbers, so no doubt on that. And I'll take you through the numbers first. There's very strong, nearly 30% growth where the AUM is concerned. The loan growth has been strong. Total income also matching it, maybe a little better in fact. And your net interest income number has gone up by near 50+%. So there's been margin expansion which has played out in this year, in fact, and the margin expansion has been strong from 2.85%. The margin has gone up to 3.27%. What have been the margin contributors? It's been cost of funds, which has come down quite sharply over the last year or so. 20 bips reduction in the cost of funds in a year in which the repo hasn't really changed. So that's something which really stands out. Yields not going up materially, and therefore this is probably the only lever available to expand margins. Mind you, PFC, REC do 3.6% margin, and therefore is there scope for more margin expansion will be probably one of the few things that I'd want to talk to management about. I'd also want to speak about how the Gensol account is evolving and how that is getting recognized on the P&L. Because it's a large account, 650 crore, which is outstanding from Gensol. How does that
and what's interesting on that
account?
and the impact in terms of your asset quality, because if you see the asset quality trend as well from what you were mentioning, there has been a spike that has come in the fourth quarter as compared to your second quarter, right?
Yes.
Third quarter is where it was still lower. So your Q4 asset quality number, your NPAs, are higher than your second quarter.
Q2.
So
Q3 saw a spike, Q4 saw a cool down, but not as much of a cool down.
Cool down as compared to Q3, but still they are higher than the second quarter, right?
Yes.
In fact, let's also get in the management, which is Pradeep Kumar Das, CMT at IRDA, who will be joining us to discuss more. Welcome to the show, Pradeep, and a very good afternoon to you as well. And firstly, congratulations for a strong set of numbers. I'm sure you are expecting a question from us with regards to what happens to the Gensol account. But before we head across to that part of the business, aspect, is the kind of growth that you've seen currently in terms of your AUM and profitability expected to continue in FY26, or do you think it'll outpace what you've seen already this time?
Yeah, very good afternoon to all the viewers and you, and thank you very much for inviting. We are talking about quarter growth. 20 quarters consistently, continuously, we have executed the growth. And the CAGR of last 5 years is 27% loan growth. And if you see year on year also 28. So the growth is pretty steady. And not only that, in addition to the growth, being a regulated entity by RBI and SEBI being listed now, we have executed best quality corporate governance standard in the country. We're the first banking, non-banking company in the country who has published the audited result. We're the first public sector in the country who has published the result. So in an NBFC and project finance company, particularly those who are dealing with new and emerging technologies, we need to carry always certain amount of risk vis-a-vis the other vanilla lending and all. Sigma of that, if you take last 38 years, we have financed more than 1.5 lakh crore. And our cumulative write-up till 31st March of 2025 is around 215 crore. So therefore, growth is happening continuously, consistently. There are two factors. One, the demand factor, 485 gigawatt of renewable is going to be installed. That is what the national commitment at global level and national level. That is not only for capacity addition to have economic development, to ensure a sustainable environment. And we are very fortunate since 38 years, we have played a key role in handholding through financing and handholding through policy formulation and policy implementation by our ministry, that is MNRE, which deals not only renewable, also new and emerging technologies. So therefore, we have exhibited continuous growth. At the same time, we in IREDA in last 5 years, why I'm talking 5 years, in last 5 years our book has grown almost double the size addition. That means 3 times it has become what we had in 33 years. In March 20, our book size was 123,000 crore. Now it is crossed 76,000 crore. And if you look at last 5 years, when you talk about reporting the audited result, we are the fastest in the country, and it has not happened once. Continuously, from 30 days to 25 days, 25 to 19 days, 19 days to 15 days. Now we have targeted next year to do around 12th of April. So that speaks about our command, confidence and trust in our system, policy, process, procedure, and at the same time, the perfect ecosystem, what our ministry and Government of India has played by handholding to develop the sector in a sustainable manner.
Perfect.
And we are confident not only to ensure this kind of growth, further improvise on it, and further improvise in our corporate governance standards.
Point taken. So, sir, give us context. Harsh also joining in. Give us context. What's gone wrong, therefore, where Gensol is concerned? Because it's a large exposure. It's nearly 1% of your book, including interest and principal both. So, what, in your opinion, has gone wrong when it comes to that particular account? And when do you recognize for that? And how large will that recognition be? Because it will likely wipe out around a quarter or so of your annualized profit. So, when does that recognition happen? What went wrong?
First, I'll clarify, NPA doesn't mean write-off.
Okay, fair point.
I said in last 38 years, we have financed 1.5 lakh crores more. And our cumulative write-off is 215 crore. NPA happens. In March 20, our gross NPA was double digit. And 7.18 was net NPA. From there, we came down to below 1, that is 0.95 net NPA in December. So in September. So in due course of time, this is a sector where you have to take the challenges and you have to act proactively, which we have been doing consistently and continuously. Now coming back specifically to this, yes, we have lended, and remember, this is the larger part of our loan in this company or group is towards e-mobility. So e-mobility has to grow in the country, and that is not only going to become a game changer, but also going to ensure sustainable environment, because the transport population need to be arrested. So as of now, in last audited data, we have around 650 crores of unbased outstanding and 170 crores of unrun.
Pradeep, I will want to interrupt you over here. Just give me a moment. We absolutely understand that the lending that you have done to Gensol, majority of it has gone to the EV side of the business. The question over here which has come up over here is that there has been a fraudulent practice at the end of the promoters, where the money that was lent for the EV side of the business has been used for other transactions or other related party transactions. A lot of other things I'm sure you would have known as well as to what has happened. What has been the reason? What has been your on what basis have you lent to a Gensol when there have been such irregularities over there, number one? And number two, how are you going to account for it in your books?
See, first of all, as of now, our account with them has not become NPA. Number one.
Okay.
And number two, whatever overdues as of 31st March is around 80 crore. Against that, if you see, we have around 60 odd crores in the form of Desra and FDs. Okay. So roughly this 80 crore to recover, around 60 crore we can recover even overnight. But that is not the way to handle. See, now we have not stopped lending any additional financing to them for quite a long time, because if any of our developer is growing and growing very fast in the private space, we also have a review monitoring mechanism. Our team is doing, and since we are under RBI, as per the RBI policy, we have a investigation policy. So our team investigation committee is doing that. Parallelly, it is going on, and yesterday we are very fortunate. We have published the result, and then we have seen the SEBI's report in their website about their findings and all.
Okay, so Pradeep, I understand the point that the account with regards to Gensol has not turned into a NPA yet with regards to IRDA, correct? Now, taking the timeline into consideration, what are the number of days left for a Gensol to turn into a NPA with a IRDA if a default happens, number one? And number two, what is your conversation right now with Gensol, taking into consideration what has happened?
When we are doing investigation, and a kind of what it has appeared yesterday, that is leading towards a complete corporate governance breach and fraud. See, as a project lender, as a long-term lender, what we generally do after doing the due diligence, after our appraisal, and this is way back in 2022 and 23, we had financed for them e-mobility. And in last 2 years, they have grown very fast also. Again, in 23-24 also, we have done part financing. So what I said, out of this 650 and 170, majority of the e-mobility, there we are having the car registration with us, hypothecation to us. And in e-mobility space, our assessment is e-mobility business is going to be a sustainable business. So therefore, there are a lot of various options available for us with respect to recovery of the amount. Since we have majority of the assets through securitization, and also DSRA sufficiency is there to address fair amount of current overdues now. So at least for a month or two, we can manage with this. And then our team is investigating. And until unless we come out with a conclusion, it will not be fair on my part to comment here what is the exact number and what is the exact amount. Otherwise, I will be guiding my team what they are doing. We are working in one of the best corporate governance manner. So the team is doing its independent work. Good that we have found the report of SEBI yesterday. That report also we are taking cognizance. And since this amount of 650 crore, which is not that significant with respect to the total loan book what we are having today, that is not going to impact on the overall level. And moreover, since we are having the vehicle security, we can look into alternate options. One of the options could be we can go look into change management. If the change management happens, then in the past also we have handled it. It is not like that one account in renewable become NPA, then but that is going to impact the sector entirely. No. And since e-mobility is an emerging sector, we have to look into it. And this all now appearing to be quite a lot of indiscipline in the corporate governance mechanism with that group or company, which now is coming out. And moreover, we have 500 to 1,000 of lenders and all. We do monitoring, and whenever account goes to SMA, then we start taking action and all. We have a regular review monitoring system in place, and team is working on it. And the investigation committee, what is after the RBI, they are working on it. And very soon we'll come out with a amicable solution. And one thing I can assure you as well as to the viewer and to my investors, that we'll take most appropriate action within the prevailing rules, regulations, and governance principles, whatever will be in the best interest of the organization and sector.
Absolutely, point taken, and we do understand that, IRDA's exposure with regards to Gensol is just 0.8%, right? So it's not, the quantum is not the question over here. The reason we wanted to talk about Gensol was because there is this kind of worry, not for a IRDA, but with a Gensol amongst investors as to what has happened. So no one is doubting as to what has gone wrong with IRDA, because with IRDA, everything is on track in terms of the numbers as well, the kind of growth that we are looking at. So let's make that absolutely clear. In fact, my next question to you is with regards to the margin trajectory. Strong margin trajectory is what you've seen. How sustainable is it, and any deviations that you could see?
See, 2-3 points, how we have enabled this sustainability. We have improvised the rating last year. We have gone for AAA stable by all our domestic rating agencies, so that is the highest rating. Then we have gone for overseas rating, that is in the first attempt we got sovereign, at par with the sovereign rating. And then we'll further work on improvising that also. then that will enable us for the overseas borrowing at a cheaper rate. These two. Third, we had submitted our request to Government of India. The issue is now pending with Ministry of Finance, and we have requested for them to allowing us to go for the 54EC capital gain bond allocations, which recently HUDCO also had applied. HUDCO had recently got. We believe that we will be getting that soon also. But since it is with Government of India, and we being a separate entity, I do not want to influence Government of India. It is Government of India's call. But we are confident, since we are working in infrastructure sector and we are working on a green energy sector, which involves challenges and new and emerging technology we are supporting. We need to be given that kind of, and post our IPO, we are having fair amount of trust and confidence with our investor community. Once we get that allocation, we can resort to further cheaper funding. That will further bring down our borrowing cost and our margin will improve. And if you look at the overall interest rate, certainly there we cannot go up just like that, because we are working in a sector which is very much interest rate sensitive. In the vanilla area, it is
Sorry, sir, for interrupting. So where should margins go therefore? Will it be 3.5%? Will that be the cap? Are you happy with the 3.3% margin? Is there an aspiration to go beyond 3.5? Give us that perspective.
See, if you ask, we do not have any target.
Sure.
For that. But personally, I believe that 3 to 3.5 will be ideal, because here it is not just economic gain for which we are working. The moment any capacity addition we are supporting, that is contributing towards energy transition, decarbonization, sustaining environment. So therefore, for us, optimizing the economy of interest by improvising, yes, right. At times we have that authority kind of thing, because many area we are almost having a kind of monopoly or being a first mover. We can charge higher interest, but that will not be appropriate. We have to keep in mind how fast the sector grows also. And 3 to 3.5 is a fair amount of margin being in project finance, that too in RE finance.
Right, okay. So point taken. Really appreciate that answer. Sir, the other one is with regard to growth. You've grown at a very, very healthy clip over the last 2 years. Now your base is 75,000 crores. So it's starting to build in that sense. From sub 50,000 when you listed, you're currently at 75,000. So on this base, can you continue to grow at 25 to 30% is my question. I'm not asking you for the size of the opportunity. That I understand fully is very, very large. But can you grow sustainably with low credit costs at 25 to 30%?
Our growth is completely dependent on what kind of equity augmentation we can do. If we can have 1 lakh crore today, our balance sheet will be 7 lakh crore this year. So for us, we have richest of the expertise in the country with respect to green financing. So for us, the only constraint today is equity additions and ensuring corporate governance. As far as corporate governance, we have already established we are best in the country as far as banking, non-banking space with respect to reporting of the result. And every quarter we are doing full audited result, which is not a mandatory activity for the corporates, but we do on our own. And we are trying to improvise day by day, almost every day, whatever way our process, policy, procedure can be realigned, which is absolutely commensurate to the sectoral requirement as well as to the regulators' mandate. So we are playing a very balanced approach in that growth. We'll continue to do that. Only our constraint is that adding equities. Like we have planned for QIP, we could not do because of the market conditions and all. Because we don't want to just go to the market and sell at a very low price of our shares. We have to do the justice to our existing investors. And we augmented that through the PDI mode. And we have ensured a healthy CRAR 17.7 despite not having a QIP. So our concern is that. So more and more equity we have. And we are also strengthening our manpower. These are the two things which we need to augment in the time to come for ensuring this kind of growth. And this numbers is going to happen because when we have submitted by 2029, we are almost planned to become a marathon company. We have exhibited 27% CAGR growth. And last 5 years, we have given 27%. So with that spirit, we believe if we continue to maintain this kind of momentum of discipline in our approach, then we can reach to that stage also.
Understood. Got your point, sir. Thank you so much for joining us this afternoon, sir. It's absolute pleasure speaking with you and always good having perspective from one of the largest lenders in the power space. So thanks for coming in and speaking with us. Very, very interesting.
Thank you very much.
Thank you, sir. Very, very interesting, Hiral, from a perspective that he said that there are no restrictions with regard to growth for him, given that The only possible restriction is liquidity, and the only possible restriction is capital adequacy, which they are trying to, take care of through a QIP. They've tried that once, is what they said. Not comfortable with regard to valuations, but likely. We've seen a bounce back in the stock price. Can we pull up maybe the stock price for the last 3 months or so? We've seen a bit of a bounce back in the stock price from the lows, and who knows, they may well look to raise again very, very soon. As you can see, the stock price is bouncing back.
So
6% higher in trade
today, and absolutely, in spite of the Gensol impact, the street is not really taking that negatively, at least from an IRDA perspective, because the exposure is just around 0.8%, so 0.8% is the kind of exposure. Thank you, Harsh, for joining in the conversation as well. Let's just quickly pull up PFC and Gensol as well with IRDA, because that was the conversation that we were having as well. If we can have the 3 stocks that can be taken up together, Gensol has been trading under pressure. But as you're seeing the flashes at the bottom of your screens, 2 stocks that are in focus right now and taking a beating. One is Lupin, and the other one is Zydus Life. Both of them have gone down to the day's lowest levels, and this is with regards to a litigation on a key drug, which Lupin and Zydus have lost that litigation. I'll get in fact, Varsha, my colleague who tracks this space pretty closely, to get us more as to what was the litigation about, what has happened, and how does it impact both these companies. Varsha, over to you. Both the stocks at the day's lowest levels.
Yes, absolutely, Hiral, and as you rightly said, so this is a big negative news for both the companies, as there was a litigation or a court case going on, wherein now Zydus and Lupin has lost that litigation on a drug which treats overactive bladder. Now the name of the drug is Mybetriq, which contributed meaningfully in Q1 FY25 for both the companies. This drug contributed almost $35 to $50 million of sales for Zydus and 15% of EBITDA for company. And they were expecting 120 to 40 to 120 million of dollars sales in FY25 and 26 as per consensus estimates. And for Lupin, this product likely contributed almost 7 to 10% of EBITDA and $15 million of sales. Now, what these companies might have to do, because they have lost the litigation, they will have to withdraw the drug from the market, because somewhere in April 2024 they came out with the generic version of this product and started selling of this products, but now they might have to withdraw this product, and this means that they may see some financial penalty from the court. So this is actually very negative, because that contributed good numbers in Q1 FY25 and was expecting good growth in future quarters as well.
Thank you, Varsha, for getting us the details. In fact, we have, both our guests who are standing by with us as well, but we will ask them to wait. We'll quickly slip into a short break and then speak to them about IRDA, Lupin and Zydus. Please stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching Profit Buzzers on NDTV Profit. But let's welcome in our guest, Gaurang Shah and Brijesh L to discuss the stocks that are buzzing in trade today. Welcome to the show, gentlemen. Gaurang, let me come to you. I'm sure you've heard the entire saga with regards to what's happened with Gensol and the kind of exposure IRDA and PFC have on it as well. Any comments on that?
Well, thank you so much, Hiral, for having me on the show. Good afternoon to all of you all. Comments would be restricted to IRDA because that is where we have our coverage, and it does give a soothing feeling post the statement made by the management in the interview, which was just a few minutes ago, with respect to the exposure that they have of 80 crores, 60 crores is marked up for, which they can sell overnight and recover. They have not yet the account is not yet NPA. That is what was mentioned. So my sense is that the reason why I say this because IRDA, we have a fundamental coverage. We've been recommending the stock right from the time it got listed via an IPO note with a subscribed recommendation on the IPO. And post that we have a standalone fundamental coverage, and I don't think it's going to be that difficult because in terms of percentage, it's very, very small to the exposure that IRDA has to Gensol.
Right. So that's with regards to IRDA, Gensol. Gaurang, another question with regards to Lupin as well as Zydus as well. If you talk about both these companies, the recent news that we've picked up is in terms of the litigation where both these companies will have to actually withdraw their products as well from the market. How are you looking at both these names? And both of them have seen a downtick of almost 3 to 4%.
As we speak, we have coverage on Lupin and Zydus, both of them. I think the news is just out. We will need to draw down in terms of what kind of hit this particular story that has developed will take on the earnings and the profitability, because that is something that we'll have to work on. but we have a positive coverage on both Lupin as well as Zydus from a long-term point of view. We will possibly relook in terms of the hit that they will have to take on the bottom line.
So that's with regards to Lupin as well as Zydus. Brijesh, very quickly, what are charts indicating for both these stocks?
Yeah, so maybe there is a sell-off clearly. My concern would be the 200-day moving average, which I'm looking at into the looping. So basically, the value of the 200 is 2070. So for me, technically, as long as the prices are below the 200-day moving average, I will be cautious. And the recent low of this 18, close to 1850 is what I think it can drag up to. Maybe it can break that also. But then the view remains slightly cautious, and maybe I would look for another 100 odd points of correction in the looping. Coming to Zydus Lab, it has been an underperformer since October 2024, and now it has been like trading lower lows. So most probably with the overall negative bias, I think it can go back to 800 or might break 800 as well. So I'll wait for this correction to get over and then we'll review the position.
Right, so that's with regards to the pharma names. But let's quickly see the flashes at the bottom of your screens where the statement is coming in from the White House, where they're saying that China will now face up to a 245% tariff on imports to the United States. And this is as a result of their retaliatory actions. How much of this is actually actionable and executionable or not is anyone's guess. But that's what we're picking up in terms of the retaliatory action of China, who will now face a 245% tariff on imports. What they also said is that more than 75 countries have already reached out to discuss the new trade deals, and as a result, the individualized higher tariffs are currently paused amid these discussions, except for China, which actually retaliated. So because China retaliated, Harsh, a 245% tariff is what they are going to see on imports to the United States. And I mean, the question is going to be with regards to execution with China.
It's been a lot of back and forth, from 40% to 84% to 245%.
And what pocket within India also benefits as a result of this, whether this is sustainable.
There is that kind of shift. We just spoke yesterday, we had a Nomura note about smartphones and how the supply chain could shift, and how you have something like a Samil or Dixon that could benefit more from production in India. So there are pockets in certain stocks that do benefit if this does come to play.
Let's just pull up Nifty 50 on the screens very quickly and see what's happening, if there is any minor reaction on the back of this as well. So that's, I mean, if we can just get a Nifty 50 chart, there you go. Nothing, I mean, major shifts happening over there. But now that Harsh is still with us, he's patiently waiting to do his bull, bear and banter conversation on YouTube. But Harsh, that you're with us, very quickly, if you could tell us how have the earnings been with regards to ICICI Prudential as well as ICICI Lombard, because these are the other two stocks that are in focus as well.
Yeah, absolutely. So when we speak about an ICICI Lombard, while overall the top line was much better than expected, what has really kept the street slightly tepid on this counter today is the fact that the combined ratio has come in at 102%. 102.5% versus the estimate of 102%. This number essentially indicates the profit made on the top line for a general insurance company in the most layman terms possible, and therefore as you can see that the profits were lower than expected. Where has that profit come in lower than expected? Where has it disappointed? Claims ratio. The claims has been elevated this time around versus the expectation. Management says this is par for course. There's nothing major in that sense. They're focusing more with regard to health, less with regard to motor, because they continue to see pricing pressure in the motor segment is what the management told us. They believe that should unwind in FY26, and therefore there should be a double tailwind with regard to both health and motor in FY26. But that recovery in motor has been long awaited. As of now, we're not seeing it, and that is the other piece that's possibly keeping a lid with regard to how Lombard is reacting in trade. But outside of that, that's how the numbers shaped up. Now let's talk about ICICI Prudential, because that was the other one where we saw a decent kind of a number. We saw 3,500 crore being the APE, which is the top line equivalent. We saw very strong growth sequentially off a low base. YOY, it was a -4%. So it was a tepid growth number on the APE count. In fact, it was lower than our estimates as well, around 2.5% lower than what we were penciling in terms of top line. Value of new business came in largely in line at around 795 crore rupees, 2% growth YOY, 54% QOQ. VNB margins came in at 22.7%, and this is where the kicker starts to appear. Up 1.5% both QOQ and YOY, so we're seeing an uptick with regard to VNB margins. That is expected to sustain in FY26. Product mix changing, which is the key positive, and that's likely why the stock has reacted the way it has in trade today, Mihika.
Got it. So you have ICICI Prudential as well as Lombard in focus. In terms of the stock reactions, it's fairly opposite. ICICI Lombard currently down, Prudential up 3%. Gaurang, I'll come to you first. What are your views on something like an ICICI Prudential or an ICICI Lombard in the insurance space?
Well, Mika, so let me give you a broader perspective. We at Geotis Investments Limited are positive on both general as well as life insurance companies. ICICI Lombard happens to be under our fundamental coverage. That's a disclosure. On the life insurance fund, I think the run rate is going to be relatively slower in terms of bottom line improvement with respect to the insurance premium, especially the new insurance premium run rate. So LIC, SBI Life, HDFC Life, and ICICI Prudential Life. These are the 4 insurance-related plays that we are positive on.
Brajesh, what about you on the charts? How does the picture for something like an ICICI Lombard or Prudential, shape up?
So basically, after the good amount of correction, this ICICI Pru is looking good on charts. It looks like the stock has taken support, and maybe from another 4 to 5 months kind of a time frame, we believe this ICICI Pru can go back to 650 levels. So definitely it's a buy kind of a scenario, and from the positional trading kind of a perspective, 650 would be the immediate target for the ICICI Pru, and this we are still waiting. Maybe 1900 is a level where the ICICI Lombard might see some resistance. Once that zone is clear, then most probably that can see some reversals, but then the conviction kind of a trade is with the ICICI Pru.
Right, so that's with regards to ICICI Lombard as well, which is slightly under pressure right now. Another stock which is seeing a good day in trade today is IndusInd Bank. Key is they're going to see a financial hit of close to around 1,979 odd crores as per the PwC report versus what was estimated, which is lower. Vishy standing by to get us more. Vishy, what does this actually mean?
It's difficult to say at this point in time, Hiral. It's been a weird sort of a day as far as IndusInd Bank is concerned. Yes, if you look at the number that the bank has come out with, 1,979 odd crore, that is relatively lower than the 2,200 or 2,100 odd crore expectation that the market had. But having said that, there's also an additional point that the bank has disclosed, that the external agency has found discrepancies in the derivatives portfolio. So that is very clear. So now you have, apart from an internal assessment of this saying that there was a discrepancy, now you have an external validation of this point. The board, if you remember, on the 20th of March had also appointed another agency to look at this entire issue, to essentially bring accountability in this entire process. So basically, who is responsible and what should be done with those because of these issues. Those kind of advisories will come from this other investigative report that will come out hopefully by the end of this month or early next month. What we understand is this is Grant Thornton that is doing this investigation. Depending on the outcome of that investigation, you will see some action at least at the bank. Already the CEO is on a deadline. So there is a March 31st deadline that he has, after which he has to, of course, step down as the CEO of IndusInd Bank. And the bank is already in the process of identifying a successor for Sumanth Katpalia. Where that process is, we do not know. We just do know, however, that by October at least, they need to submit names to the RBI. So obviously the process might be currently in full swing. But as far as the stock is concerned, it's been a good day. I think the next big trigger is going to be what is going to happen with the Grant Thornton report.
Yes, the Grant Thornton report is going to be crucial from here on as well. Thank you so much, Vishy, for getting us the details. Brajesh, what are charts indicating with regards to an IndusInd Bank?
See, it's very clear that, even when there are no fresh negative surprises, the stock is moving up. But when I look at from the derivatives point of view, at the 800 strike price, the call writers are very aggressive and they are not unwinding their shorts. So this is not giving me any kind of comfort. So I believe this is the pullback, at least till this monthly expiry is over. So maximum is 800. So it's an opportunity. Whoever has done a trading kind of a move in the IndusInd Bank should take this opportunity to take the profits. And long term, I am not very confident as of now. We'll have a wait and watch kind of a scenario. But whoever has bought lower should look this 780 to 800 range as to take the profits, and just to post result and post the management call, we should take the view. But on an immediate basis, this level of 800 will act as a resistance zone.
Got it. Let's also talk about an IGL and MGL. Both of the stocks are in focus and under pressure as the government's new APM allocation is effective today. Now, this space is something that has seen a lot of volatility in terms of the APM allocation. So, what could this mean for these two counters? Well, Samit is here to tell us more.
Yes, I don't have the numbers handy, but yes, the valuations for the city gas distribution companies have contracted right from October, when the first APM gas allocation cut had started, because the profitability scenario changes for all the city gas distribution companies, given the fact that now the cheaper gas is getting replaced by somewhat expensive gas. So yes, the valuation multiples have contracted, and this recent allocation cut was already indicated by us on Friday, April 11th, and that is what has come in pretty much in line, 20% cut in the APM gas allocation. But this time the positive announcement that has come in is that the notification clearly says that this reduction in the APM gas allocation will be fulfilled or will be replaced by new well gas. Unlike last time when the APM gas allocations were cut, city gas distribution companies had to rely on more expensive spot or Henry Hub or oil linked gas contracts, because of which the margins had taken a hit. But this time they will be getting the new well gas, which is just $1.3 per MMBTU expensive as compared to the APM gas price, but way cheaper when compared to other gas like Henry Hub, oil linked gas, difficult field gas or spot LNG gas. In fact, when you compare it with the spot LNG gas, new well gas is cheaper by nearly $7 per MMBTU, and analysts believe that if IGL and MGL are able to fully replace this shortfall in APM gas by new well gas, then their margins could improve sizably. Another positive point that has come in for IGL is the fact that IGL in their notification has clearly stated that the new well gas allocation will be 125% of the APM gas. So this will help them to replace the APM shortfall much quickly as compared to other players.
Thank you, Samit, for putting all of that into perspective. Gaurang, I'll come to you. Your outlook on the space. I mean, a few months ago, this APM allocation cut was seen as a major setback to the margins. But this time, they have the new gas wells coming in, and versus the spot price that becomes, much cheaper. Your outlook on the same?
So I think alternative and changes, Mika, is going to be the order of the day as we go into the future. And that's what the government is focusing on. First of all, reducing our dependency on imports, and of course, increasing our dependency on clean and green energy and viable fuels. So this, while short to medium term, it can have some kind of an overhang on related companies, but we at Geojit Investments Limited remain positive on Mahanagar Gas, Indraprastha Gas and Petronet LNG. Our sense is that there is visible amount of spend from the center and state level for increasing the infrastructure for distribution of pipeline gas, be it in form of CNG or PNG. So while short to medium term, there would be a little bit of concern, but switchover and viability and cost saving will translate into positivities.
So that's with regards to MGL as well. And you're talking about the gas distributors. Moving on, you have the auto pack that is in focus, and this is on the back of media reports indicating that the government is expected to launch a tender for procurement of almost 10,000 electric buses. And this will be under the PM e-Drive scheme. Puneet joins us with the details. Puneet, what are you picking up from media reports? And secondly, which are the companies that stand to benefit and who have the capacity to deliver?
Well, thanks for that. So definitely it's a big news coming out from the Union government, 10,000 electric buses to be procured by the government, and now the Heavy Industry Ministry is expected to launch a tender essentially in May of 2025. Now, this will be of course launched by CESL for intra-city bus movements for electric buses, and that is one of the key aspects of the scheme, where they are looking to allocate roughly 3,000 crores for procuring roughly 10,000 electric buses. Now, this is part of the PM E-Drive scheme, which was launched earlier last year. The scheme has provision of roughly 4,391 crores for deploying roughly 14,000 buses. So this new order could be part under the PM E-Drive scheme essentially, and this has been allocated and announced as well as approved by the cabinet as well. Now, when you look at some of the key players, there is JBM Auto, Olectra Greentech, Tata Motors as well as Ashok Leyland, which is stand to benefit from this. JBM Auto has a capacity of about 20,000 e-buses, and they are already starting to procure this over the last 2 to 3 years, where they started to supply this to state transport undertakings. Apart from that, Olectra Greentech also has an order book already of about 10,000 electric buses. So these both are key players. And we also have legacy players like Tata Motors as well as Ashok Leyland, which operates the Switch India brand in terms of the electric bus segment specifically. For Ashok Leyland, they already have an order book of 1,800 buses, and the company has recently mentioned that they will not be looking into getting into GCC contracts but outright sale, which is essentially helping margins, as well as Tata Motor, which has already supplied more than 3,500 electric buses. So all these players in focus on the back of this new tender that could be thrown for electric buses to be supplied across 9 cities.
Right, so that's with regards to the electric bus procurement tender that could be on the cards. Thank you, Puneet. Gaurang, your view in terms of the beneficiaries, any recommendations?
Well, so Hiral, out of the 4 names that your colleague was just mentioning, we are positive on Olectra Greentech, Ashok Leyland because of the Switch Mobility, and of course Tata Motors. And my sense is that this is just the beginning of the change that we are going to see, as we were discussing about the gas distribution companies. So there is going to be more and more such changes, not only at the center level, but also from the state utility or state transport utility. So that's going to be more positive in terms of gaining more orders for these companies.
But Brijesh, I'll also come to you. JBM Auto, Olectra Greentech, Tata Motors, Ashok Leyland, any of these counters look good on the charts at current levels?
Yeah, I'm pretty confident that all these 4 stocks which we spoke look extremely good from the weekly point of view, and it looks like the near-term bottom for this, all the stocks are done, followed by Tata Motors also. So near-term outlook is quite extremely positive, and I won't be surprised if we see another 30-40% kind of a gain over the next quarter or so. So view is extremely bullish. Somebody wants to take a long bet should initiate a trade in this.
So that's a bullish call coming in as well with regards to few of the auto majors that could be one of the suppliers of the 10,000 buses that the union government is looking to procure in the EV space. But completely out of time. It's a wrap on this edition of Profit Buzzers. Thank you, Brijesh. Thank you, Gaurang, for joining us in as well. And a thank you from Mihika, the team that put the show together, and myself. In fact, lots more lined up on the other side. Please stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor Anushi. Well, Anushi, not much of an action in the markets today. It's largely flat, just 20 points down, right?
Right. What we are looking at in Nifty is in just like a little bit of red, currently seeing cuts of around 0.14%. The latest news that we're looking on our screens is, of course, on the China tariffs being at the number of 245% here. So that is something to keep in mind. But in terms of where the benchmark indices are headed today, almost flat action that we are seeing. Global cues also kind of an indicator of that. Nifty Bank, we are seeing around 0.7% of an uptick in trade today. So strong moves for the Nifty Bank that we are looking at. But in terms of where the point contribution table is, if we are seeing for the benchmark indices and Nifty 50, Axis Bank, ITC, Bharti Airtel right on the top that we are looking at. IndusInd also in favor today because of the lower number that we're looking at in terms of the derivative discrepancy that is there on what was expected. However, if you're looking on what is leading the drag is something like an Infosys, Reliance Industries and Bajaj Finance, which is under pressure. So this is as far as where the Nifty 50 is concerned. In terms of where the Nifty Bank, as we've said, about 0.7% of gains here. Let's also have a look over the sectoral chart if you can see where the sectors are headed today. So it's a mixed bag that we are looking at in terms of the charts over for the sectoral indices. Nifty PSU Bank leading at the top here with about 2% of gains here, followed by something like a Nifty Media and Nifty Oil and gas seeing gains of around 1% each. While on the other losing side, we are seeing something like a Nifty Metal and Nifty Auto under pressure, seeing cuts of around 0.58 to 0.59% each. But let's also talk about the broader markets, what's happening there in terms of where the Nifty Midcap 150 is concerned. Let's pull that out. We are seeing almost flattish movement here as well, following where the benchmark indices are headed in terms of where the stock-specific action is concerned. We are looking at some strong gains in counters like NTPC Green, IRIDA buzzing on the back of its fourth quarter results, Indian Bank also up around 4%. While on the losing side, we have something like a Coromandel, which is down about 4%, along with something like a Lupin, with cuts of around 3%, along with Sonacoms, which is seeing about a 3% cuts. In terms of where the small cap 250 is concerned, small cap 250, however, is in favor in terms of where the mid cap 150 and the overall benchmark indices seeing gains of around 0.55% in trade today. Some of the strong movers here includes JBM Auto, MCure and DOMS, while on the losing side, we are seeing something like MGL and AstraZeneca seeing cuts of around 3 to 4% each. So this is as far as where the broader market action is concerned, Thomas, right?
Yes, but the big news is coming in the pharma space. Lupin and Zydus. Zydus, in fact, is the top ethanol loser. It's related to one of the patent that they have, or one of the litigations that they have lost, which could result into not only stopping the drug supply, but also big penalty that could come in for Lupin and Zydus. Let's get in Varsha with more details on what's been buzzing.
Yes, thank you for that. So the two companies are in focus, Lupin and Zydus. Now we all know because they've lost the litigation on a particular product called Mibigron, which treats overactive bladder. Now there was a court case which was going on with the innovator company for this product, and the decision has gone in favor of the innovator. Now previously if they actually had got US FDA to launch this generic drug, and both the companies were selling the generic version in the market. Now why this is important and why the stocks are reacting, because this product is actually very important when it comes to both the companies. This contributed meaningfully in Q1 FY25 for both of these companies. Trick contributed almost $35 to $50 million of sales and 15% of EBITDA in first quarter of FY25 for Zydus. And also according to consensus estimates, they were expecting $120 million and $40 million of contribution in sales for FY25 and FY26 for Zydus from this product. And for Lupin, it likely contributed almost 7 to 10% of EBITDA and $15 million sales when it comes to Lupin. Now both these companies will have to withdraw this drug from the market, and they could see some financial penalty from the US court.
Right. Sneha, coming to you on this. In fact, first welcoming our guest, Sneha Poda, Vice President Research Wealth from Motilal Oswal. Well, Sneha, coming to you on this Lupin on Zydus Life, do you see this as a very big negative, or this is something that they could pass through this, or they could again file an application on this drug or on this litigation?
Okay, so basically, see, in the current scenario, obviously this will be a little dampener in the short term, from the short term point of view. Obviously, like over the medium term, they can again reapply for it, but in the near term, the sentiments will get affected. And moreover, given the fear that the tariffs might be imposed by Donald Trump, so this is already keeping the pharma overall counter under pressure, and with this news coming in, so the pressure might further escalate. So in the near term, there will be a little dampener from this news.
These stocks that we're talking about, Lupin and Zydus Life, heavily down under pressure in trade today. But let's also talk about some of the auto companies which are there. In fact, what's the news here is media reports suggesting government may soon launch a tender to procure about 10,000 electric buses, a move that could benefit multiple players within the automotive segment. Who are these players? Puneet joins in to tell us more on this.
Well, thanks for that. So definitely a positive move coming in from the union government, looking to procure 10,000 electric buses very soon. Now the Ministry of Heavy Industries is expected to float a tender sometime in May of 2025, so not so far away as well. Apart from that, this will be procured under the PM E-Drive scheme, which was announced in 2024. Now CESL will be issuing these tenders for intra-city movement, specifically for passenger carriers. and the subsidy could be approximately 3,000 odd crores. Now, do note that in the PM E-Drive scheme, the total subsidy for subsidizing the purchase of electric buses was roughly about 4,391 crores. And this 3,000 crores will be coming in from that aspect. In the PM E-Drive scheme, they were looking to subsidize roughly 14,000 odd buses, electric buses specifically, and these number of 10,000 is also coming as part under this particular PM E-Drive scheme. Now, players such as JBM Auto, Electra Greentech, Ashok Leyland as well as Tata Motors are now in focus. Now, specifically for JBM Auto, the company has a bus capacity of 20,000 electric buses manufacturing in a single year. So definitely a key beneficiary there. Apart from that, Electra Greentech also has an order book of about 10,000 electric buses, and Ashok Leyland, which manages the Switch India facility specifically for its electric bus segment, could also be another key beneficiary. They have roughly about an order book of 1,800 buses at the end of Q3 of FY25. They've also recently mentioned that they will be only looking to enter into contracts for an outright sale of electric buses and not get into a GCC contract, which has deferred payment over 12 years. So another key beneficiary could be that. And finally, Tata Motors, of course, they've already sold roughly 3,500 electric buses over the last 3 to 5 years. So definitely these 3 to 4 players specifically in the electric bus segment could be big winners going forward. And the new state budgets advocating this, such as Maharashtra as well as Delhi, for electric buses could be some of the key beneficiaries apart from the 9 cities that are targeted under this new scheme for 10,000 electric buses.
Okay, thank you Puneet for sharing in those details. Sneha, coming to you, a couple of players that Puneet was talking about which could benefit from this government grant that we're looking at, which includes the likes of JBM Auto and Electra Green, which are buzzing in trade today as well, along with something like Tata Motors and Ashoka Leyland also, where there should be more focus on. I want to understand your view on any of these stocks and if you have a pick over here.
Okay, so obviously there's a big order, and these players are likely to benefit. In fact, if I have to recommend a stock, I would in fact go for Ashok Leyland. So in case of Ashok Leyland, the company has been quite active in case of electric buses, and if we look at their Switch India subsidiary, that is expected to break even in Q4. So hopefully this positive news comes with the result announcement. So at EBITDA level, they are supposed to break even this quarter, and at the PAT level, they are supposed to break even by FY26 end. So we are quite positive on Ashok Leyland because the order book which they have in electric buses is quite robust, and if they manage to win this will further add on to the overall order book. So we believe that one can pick and choose Ashok Leyland. With regards to Tata Motors, there are lots of ifs and buts because it has got a huge global presence. So Tata Motors, I would suggest to avoid at this current level. And in case of Electra Green, though this counter has corrected a lot, but the valuations I feel is still a little expensive. So my pick would be Ashok Leyland, where the valuations are a little comfortable compared to Electra Green, and the Switch, if it manages to turn profitable, then that would be a big booster.
Right. Another pharma stock that has been buzzing in trade is Hykel on the back of strong volumes. Let's get in Varsha again to give us more details on Hykel.
Yeah, thank you for that. So yes, if you see, volumes are trading at 9x of its 30-day average, and the stock has seen an intraday high of almost 10%. Now, if I were to talk about the growth prospects for this company, well, this company provides an API and intermediates to basically they're into B2B business, providing APIs, research services, and intermediates. Now, pharmaceutical contributes almost 62% of their overall revenue, followed by crop protection at 37.5%. Now, they're targeting high teens CAGR growth over next 3 to 5 years, with they are aiming to exceed 20% of EBITDA margin, and their animal health project is the next big growth for the company, for which they are targeting almost 400 crores of revenue in the next 5 years. And the crop protection sector is expected to stabilize with the domestic demand. The new multi-purpose facility at Panoli is expected to ramp up in next 2 to 3 years, and the capex guidance for FY25 is around 140 to 150 crore, while for FY26 it's around 150 to 200 crores. Therefore, if I were to talk about their API business, several projects are actually moving towards validation and commercialization, while for CDMO business, where animal healthcare is one of their CDMO projects that they've got, they are also progressing towards commercialization, and the strong pipeline with 13 to 14 products are into various stages of development. And lastly, on the animal health contract, they are seeing significant traction with a new product pipeline and healthy inquiries that are coming in for the company, and they're expecting commercial sales to commence from FY26 when it comes to animal health business.
Right. Sneha, any views on Heikel? Have you tracked this counter?
No, we don't track this counter as such. I mean, we don't have it under coverage, but my view is that since they are into crop protection business, so with the good monsoon that is expected, this counter is likely to do well. And as mentioned, since couple of their products are in the pipeline for commercialization, so that will further drive the growth. But yeah, we don't have the coverage on this counter.
Okay.
Right.
Right, so that's in regards with Heikel that we are looking at. But another counter which one should focus on is something like Bharat Forge, and this is after Morgan Stanley has maintained an equal weight on the stock. My colleague Puneet joins us with more details on this.
Well, thanks for that. So definitely the US is currently in a big slowdown, and that's roughly 41% of the standalone revenue for something like a Bharat Forge, and that's what Morgan Stanley has mentioned, that they've said that, you know, the US machinery team has also lowered the guidance for Class 8 truck market going into FY26, and Morgan Stanley believes that they will only see a modest increase, if any, in 2026. They maintain the equal weight target price of 1170 rupees per share, and they have said that, you know, any kind of growth guidance will only come in the second half of FY26, and specifically that could happen if the pre-buy gets triggered because of the EPA norms. But overall, you know, we've also spoken to Jonathan Starks, who's the CEO of FTR, and they track the Class 8 truck market very closely, and they mentioned that as of now they're not anticipating any growth in FY26, and if these new norms under the US EPA is delayed, which is essentially the green norms, if delayed in 2027, could be another, you know, big fall in terms of earnings for something like a Bharat Forge. So overall, it's a slightly negative tinge and negative tone that, you know, Morgan Stanley has taken, and the US market slowdown is expected to hurt something like a Bharat Forge going forward.
Okay, so that's the view that we are seeing for Bharat Forge. Thank you, Puneet, for those details. Sneha, coming to you, your view on the stock?
Okay, so even we are not really bullish on the counter because, as we know, the US truck rate segment is not doing well. Even the defense segment, they somehow there has been a delay in the ramp up of this segment. So both the divisions are not doing well. So we are really not expecting good numbers even for Q4. So my suggestion would be to avoid the stock at the current levels.
Right. Well, a couple of city gas distribution stocks that remain in focus, IGL and MGL, and this is on the back of the fact that the government has reduced the APM gas allocation. Now, we had indicated about this back on April 11th, Friday, that the government would reduce the APM gas allocation from 51% to 40%, and that is the notification that has come in. For IGL, the APM gas allocation has cut down by around 18%, and for MGL it has come down by around 20%. Now, this reduction in APM gas will actually be replaced by the gas that will come in from the new well gas, and this is a positive announcement, in fact, which has come in. Now, though this replacement of APM with the new well gas will increase the overall gas cost by around $1.3 per MMBTU, but the new well gas is much cheaper when compared to other sources of gas like Henry Hub, oil-linked LNG, difficult field gas. In fact, spot LNG, if you compare with the new well gas, it's $7 per MMBTU more expensive. Unlike last time when the APM gas allocation was reduced, city gas distribution companies had to rely on these other sources, which they do not have to rely this time, and they will get new well gas, which is much cheaper compared to these other sources. In fact, analysts believe that if IGL and MGL were able to replace these volumes with new well gas, then the margins could improve sizably going forward. So keep an eye out for IGL and MGL in trade. They both are down in trade today, but it would be important to track how the margins move going forward. Sneha, have you tracked or have you seen this news bet which has come in on the city gas distribution companies where the APM gas allocation has reduced, but the positive news this time that has come in is that this will be replaced by new well gas?
Yeah. So, according to our estimates, roughly, post this news, the impact at the EBITDA per SCM level will be roughly about 8% for IGL and 4% for MGL. Now, but what we believe is that though there's an impact on the EBITDA per SCM, but the margins will not be impacted to this extent. The impact on margins will be quite lower, and we're assuming that the companies might go for the price hikes, and which will help to somewhat offset this hit on the EBITDA per SCM. And we are assuming that the renewable gas pricing will be about USD 9 per BTU, or it would be above that. So it really depends upon what the pricing is and whether the companies are able to take price hikes. So depending upon that, the margin hits will be known. But so far, it looks like the impact on margins will be somewhat a little lower. So the counter could consolidate for some time till we get the further clarity.
That's the views that we are looking for the city gas distribution companies. But another stock which is in focus on the basis of its higher volumes is something like ITI Limited. Now the volumes today, if you look at it, it's 5 times compared to its 30-day average. But let's see if there's some fundamental news or what's the developments happening in this space. We have Puneet joining with more details on this.
Well, thanks for that again. We've seen the new BharatNet projects essentially being a key trigger for stocks like ITI, as well as something like a Tejas Networks, and ITI has been in focus because of that as well. Now, the company has announced on 9th of April that they had secured an order and emerged as L1 for BharatNet 3-stage project. They specifically mentioned that this was from the states of Himachal Pradesh, West Bengal, as well as from the Andaman and Nicobar Islands, and the total order value was almost 5,000 crores specifically for this particular order. This is of course in package 8 and 9, which was announced over the last couple of months. Now, the development will be of middle mile network of BharatNet projects, and in this particular quarter, it will be key to watch out for in terms of when the other, if ITI had bid for the other contracts as well, and when is it expected to open in terms of order trending, because we've seen that kind of positive impact on stocks like Tejas Network. But ITI has been buzzing on that aspect ever since the last couple of weeks, and going forward in Q4, the commentary of further getting such orders from the BharatNet projects will be something to watch out for.
Huge order wins for the company, something that we've been seeing in this counter. But Sneha, coming to you, do you have this stock under your coverage? What's your view on ITI Limited?
Okay, so we have it under coverage, and what we believe is that though these developments are positive, but then at the same point in time, the key thing which needs to be watched out for IDEA is that the subscriber base, where they have been continuously losing to Bharti and Jio, so that has to reverse in order to get the traction. Moreover, despite the government coming in to support IDEA with regards to the dues that are pending, but even after that support, there will be substantial dues with AGR dues which will be pending, and that needs to be paid over next 2 years. So the company might have to further resort to the fundraising. Thirdly, they have to do a lot of catching up in terms of capex in order to be ready with the 5G deployment. So Bharti Jio are way ahead in terms of capex on the 5G front, whereas IDEA is lagging. So these are some pointers which will keep the counter under pressure. So there might be ups, there might be bounces that we may see in between, but unless and until we see clarity on these points, the stock will continue to hover at lower levels.
Right. Moving on, GQG Partner and LIC have cumulatively increased stake in Adani Group companies since the last quarter. Let's get in Hiral with more details on this one.
Thank you so much. Absolutely, it's the Adani group of companies that are in focus. And firstly, you have GQG, which has actually doubled down on Adani companies, and they've gone ahead and raised the stake in 5 stocks. If you talk about Adani Enterprises, from the 3rd quarter to the 4th quarter, the stake has come up from 3.67% to 3.84%. If you talk about Adani Ports, that's the only place where there has been a marginal downtick that has come in. Adani Greens has seen an increase from 4.21% to 4.49%. Let's look at the other companies as well. The stake has gone up. Adani Energy has seen a marginal increase from 5.1 to a 5.23. Similar trends in terms of Adani Power as well as a Ambuja Cement, though, has seen a marginal downtick. So that's with regards to where GQG partners and entities go and their stake in Adani Group of companies is concerned. But moving on, if you have to look at what LIC has done as well, in Adani Enterprises, Adani Ports, as in both these companies, the stake has gone up marginally. Adani Green LIC stake has remained stable at 1.36%. And look at the other companies as well. From Adani Energy, again, it's remained pretty much stable. Power has gone up from a 5.07 to a 5.55%. And Ambuja Cements has seen an increase from 6.57 to a 7.69%. What's interesting over here is the kind of the quantum of increase that has happened with regards to the group companies between GQG as well as LIC. So there is the DII as well as NRI focus that is coming in, where the stake has been increasing, and this is happening in challenging times as well. So interesting moves with regards to the group companies.
Okay, thank you, Hiral, for bringing in those key details for the Adani Group companies that we are looking at. Do note that the channel that you're watching is part of the Adani Group network, so take a note of that. But let's take a look at some of the BFSI counters on focus on the back of their fourth quarter earnings as well. Here's Harsh to give us key details of the likes of ICICI Lombard, IRIDA and ICICI Prudential.
Yeah, so I'm going to first start off with the Lombard. I mean, yes, the combined ratio, which is generally the metric we look for, has come in slightly above our estimates, but largely in line set. And what really stands out here is the top line growth. The top line growth has come in at 20% YOY, which is the net earned premium has grown nearly 20%, 19.6% YOY, nearly 4% sequential. That number looking extremely strong. They continue to guide for very, very strong double-digit kind of retail health, or rather growth in the retail health segment. So that's one thing to look out for. That's the real positive. The claims have obviously been elevated or rather slightly higher than expected, and therefore your combined has been slightly higher than expected. That's how it's looking. But overall, a strong set of numbers. IRIDA also very strong results. Now, we've spoken about how the Gensol exposure could well impact IRIDA, but at this point, the overall numbers don't seem to suggest that. 38% growth on the total income number, 40% on interest income, very strong growth on the NII front as well, and PAT growth of nearly 50% YOY. The provisions number has spiked a little bit. That, to be fair, is understandable because it's off a low base. But nonetheless, you're seeing a very, very solid set of growth numbers as well. 11% QOQ on the loan growth number, 28% overall as well on the loan growth number. So very, very strong numbers overall. ICICI Prudential, last off, you're seeing APE growth of -4%. So slightly muted number on the APE count, below our estimates, marginally below our estimates as well. Value of new business largely in line, and that's taken the VNB margins higher. The product mix seems to be improving, which is the key positive in this particular quarter. A thumbs up only on the basis of the fact that we've started to see a bit of margin recovery, and the guidance seems to suggest that APE growth will be slower than VNB growth, which means that margin recovery will continue in FY26 and 27. Of course, some cuts in terms of estimates by brokerages, but nonetheless overall looks like a positive count.
Okay, thank you, Harsh, for bringing those key details. Neha, quickly coming to you on these three counters which are buzzing on the back of their fourth quarter results. What's your view on something like an IRIDA or ICICI Prudential that we're looking at?
Okay, IRIDA we don't track, but ICICI Prudential we are quite positive. So when we look at the numbers at the PAT level, the numbers were in fact a huge beat to our estimates. Now what has happened is that though the APE growth was a little muted, but then the VNB margins has expanded, and that has been largely because of the shift in the product mix that we have seen. So the revival in the non-linked business and the momentum in the high margin ULIP products led to the margin expansion during the quarter, and even going ahead we believe that the margin expansion will continue for the company. So we are positive from that angle because the product mix is improving, and that has been a calculated effort which has been taken by the company. It continues to focus on improving its margins rather than focusing on the APE growth. Even in APE growth, they are targeting more than the industry growth of 15%, and VNB growth they are targeting higher than the APE growth. So ICICI Prudential we are quite positive. When we come to your ICICI Pru, so the general insurance industry, the FY25 was not good for them because of the regulatory, a lot of changes that has been done on the regulatory front. But from FY26, we are expecting some sort of recovery, and it's looking at focusing on the motor segment and the health segment, wherein they are expecting good double-digit kind of growth. So we are seeing some signs of recovery, and in fact it is reflecting in the April month data as well, with the channel checks that we've done. So some sort of renewal recoveries are being witnessed from this month. So gradually FY26 should be better for them. So we hold a positive view for both of them, but our preference will be for ICICI Pru over ICICI Lombard.
Right, Sneha. Well, Sneha, thank you for joining us and giving us your perspective about the markets and the specific stocks. Well, with that, it's a wrap on this edition of Top Trades. Stay tuned and keep watching NDTV Profit. India Market Close up next.
That's huge. That is a biggie. It's on the
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
The first stock on the list is it's IGL now. If you see the stock that has popped up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. Quickly, a check where the Nifty is. We're at the day's high where the Nifty 50 is concerned. We're up around 1/3%. Thereabouts 23,400 breached, but it's just about been breached. So let's pull up the Nifty intraday, and there you go. You can see that sharp spike on the Nifty. I wonder what's causing that, and let's pull up contributories pretty much immediately. Try and zoom in because this spike is quite sharp, and Axis Bank and HDFC, so banks leading the charge clearly. Then there's Bharti and ITC. Let's pull up the heat map as well. Try and see what Axis is doing, because second day in a row now, Axis is up 4%, nearly 4% plus. IndusInd up nearly 7% now. Second straight day where IndusInd has done 6 to 7%. So very, very strong moves on both of those counters. And private sector banks as well as PSUs are enjoying a good day, at least in trade. And LIC is up 1.25% as well. Let's pull up the sectoral heat map. We'll probably see that PSU banking index up 2.2%, private banking index up 1.7%, and Nifty Bank up 1.3%. So that's leading the charge, at least on the Nifty 50. And we'll pull up the intraday on the Nifty Bank in just a minute. Let me cover auto, which is down 1/3, IT down 1/3, and Pharma down 1/4%. So those under some bit of pressure. But that's how it's shaping up as we enter the last hour and a half to close. Let's look at the Nifty Bank intraday, and likely that spike will get mirrored. The Nifty 50 spike is getting mirrored here on the Nifty Bank. Can we also have the Nifty IT? And I want to see whether this move is there on the Nifty IT as well. Well, not so much. Clearly not. Okay, so we've seen a bit of a spike on the Nifty IT as well. So yes, we're seeing a decent spike across sectoral indices, at least the heavyweight sector is seeing that. And we're off the day's low where the Nifty IT is concerned. So that's the other positive. But the Nifty 50 is at the day's high. Let's look at the advanced decline very quickly before I hand it over to Neeraj for broader markets. But there you go. The advanced decline is 2:1. It's in some sense been slightly more choppier than what it has been over the course of the last few trading sessions, where it's just been one way. In terms of how the advanced decline has been, and therefore slightly more choppier, but nonetheless we're very, very comfortable in terms of the breadth in that sense. Neeraj.
Yeah, good breadth. Small cap index doing well, and a clutch of stocks flying around. Just very quickly mark a few. So the winners, GMDC 12%. Actually, there's a lot of conversation in market circles about a large noted investor buying heavily into GMDC, but some of the PSUs by and large, GMDC, NTPC Green, EIL, IREDA is up about 6.26% as well. So a lot of ITI up about 5%. So a lot of that variety of stocks have done well. There is strength in JBM Auto with recent DOMS Industries on news. So that's the other set of names which have not, let's say, not had a bad outing today. And also just a set of stocks in which we are maybe seeing some sharp moves. Now, we spoke about the Nifty itself having a fairly sharp move, and you saw what's happened to IndusInd Bank and a few others. But there is Ajax Engineering, which is up quite significantly in the last few minutes of trade. So keep an eye out for that. Bombay Burma has some spikes. IPL or India Pesticides has some spikes. So those are a few names that you want to keep an eye out for. Now, the other development that has happened as news has floated in is that GQG Partners and LIC have cumulatively increased stake in the Adani Group companies since the last quarter. Hiral Johnson with more on this one. Hiral.
Thank you. So clearly you have GQG, which is double down in terms of Adani group of companies. They've gone ahead and raised stake in nearly 5 Adani group companies. If you see the kind of numbers that we're seeing, Adani Enterprises, the stake has gone up from 3.67% to a 3.84%. It's only Adani Ports where there has been a marginal downtick that has come in. Again, an increase that has come in terms of Adani Green as well, from a 4.21 to a 4.49. So that's the first set. If you talk about the second set of companies as well, in terms of energy, the stake has gone up. A marginal increase has happened in terms of Adani Power as well. And if you talk about Ambuja Cements, that's where you've seen a marginal downtake. And this is mainly if you talk about the legal shadows that have begun to recede, as well as if you talk about the global sentiment as well. That is also seeing some bit of stability that has come in. And you have one of the most loyal backers of Adani that is back on the buying table and big time. Now, you talk about aggressive accumulation that is happening in the month of March quarter comes, and this is at a time when there has been turbulence with regards to Trump's tariff blitz, and that has rattled emerging markets again in 2025. Now, let's also look at what LIC has done with regards to the group companies. Enterprises, there has been an uptick that has come in from an LIC. They've gone ahead and increased stake in Adani Ports as well. Their stake in terms of Adani Green has remained absolutely stable. And if you see the other set of companies with regards to LIC, Adani Energy again has remained stable, whereas it's gone up in terms of Adani Power as well as Ambuja Cement. So clearly, I think it's 4 companies in terms of LIC where they have gone ahead and increased stake. So clearly, it's the Indian mutual fund industry which is also increasing stake in terms of Adani names such as Ports, Green Energy, Energy Solutions, and even LIC, as we already mentioned, has gone ahead and increased stake. In fact, Ventura Securities and Jefferies are the ones who have started to have a positive outlook in terms of Adani Power as well as Adani Ports as well.
Okay. Thanks a lot for that, Hiral. So interesting buying happening in select names. We've seen that happening selectively in a clutch of very bottom-up specific sectors. But here, that group has seen some buying. That Devin Choksi looks at multiple things, but also conglomerate stocks very, very closely. Johnson right now for some perspective. Devin bhai, so good having you. Thank you so much for taking the time out. And would love to know, what do you think about this? Is this value buying? Because, I mean, GQG's name in India rose to fame when at the peak of the Hindenburg issue, they made some very large investments in the Adani Group.
Hi Neeraj, good afternoon. Well, not very surprising though that they have bought in the last quarter the particular stake, largely because of the market condition also favored them, I think, at lower levels. Frankly, the fundamentals of the businesses of either you look at Adani Enterprise or Adani Ports or even for that matter Energy Solutions or Greens, they remain absolutely, I think, convincing as far as I think their execution plans are concerned. I think they are on track. So from a perspective of buying at lower levels, I think it's something which is justified, particularly when I think you are already invested about 80,000 crores in the group over last couple of years in which I think you invested. So certainly they have added, I think, marginal stake increase. As I see it, I think a couple of developments are favoring them. In case of Adani Enterprise, in this year, that is financial year 25-26, 2 of their main properties, call it, I think, the businesses, the airports and the roads are likely to get demerged out of the main unit, that is Adani Enterprise, which has incubated these businesses. They are likely to get separately listed, and that's where probably I think one is going to get the advantage of buying Adani Enterprise stock, I think, to get the advantage of the shares coming in from these 2 companies. It is expected that both these companies, the airport and the roads, both are cash generating machines. And it's expected that some of the large investors, infrastructure investors included, for the sake of buying businesses also which are generating cash, I think they would probably get into this particular business. The port, once again, I think is showing a robustness, already touched 500 million metric tons of the business on cargo handling side. And I think going ahead, along with the mix in the international market, going ahead, I think they are talking about increasing the cargo handling to 750 million to gradually to about 9 million metric tons by the end of 27-28. So it looks, I think, a very strong proposition for anybody to look at this particular business from a perspective of seeing the growth into it. And likewise for Energy Solution, which is in transmission and distribution business, which is again, I think, a big cash cow. It basically, I think, suggests that these all businesses are well integrated, driven by the domestic economy factors, and certainly working well as far as I think the long-term investment is concerned from the perspective of large investors.
So this is Harsh also joining in. Great chatting with you. So wanted your take with regard to cement, because there's just so much happening within that sector. There's pricing, which is an issue. There's consolidation, which is playing out. And you have these two large players, ACC, Ambuja, both of which are Adani Group stocks. What within cement and how should one play it? And would ACC Ambuja disproportionately outperform in that sense compared to the others is really what I want to understand.
So my understanding of this business is fairly simple. On one side, you have got the raw material, which is limestone. On the other side, you have got a complete logistic under your control, be it, I think, inland water transport arrangement, or be it, I think, the railway cargo arrangements. I think you have a complete handle on this particular aspect. So logistic cost management gets taken care of with the infrastructure that is there in the port as well as railways. And the raw material, which is including the limestone mines, and at the same time, the lower energy cost, I think, which is basically helping them. On one side, they're implementing the green energy. On the other side, I think they're adding both Ambuja as well as the ACC, systematically a mix of blended energy, which is, I think, from the agri-waste as well. So in my viewpoint, I think they are basically taking care of on input as well as output, I think, cost management systematically. And unarguably, the cement as a commodity is basically finding higher and higher demand at every stage. With the cost factor remaining low and the demand remaining on a higher side, with the increased capacity utilization, it promises to increase higher amount of profit in the current year as well as in the next year. So from a perspective of looking at commodity, which is driving the growth and the cash is generated along with, I believe that I think this is probably becoming, I think, an important play for Adani, given the strength that they have in both these areas, the input as well as output, as well as distribution.
And so that aligns well, because the way LIC has hiked its stake, and I want to flag this off, from 6.4% in ACC in March of 2024, it was just at 6.57% in December of 2024. Now sitting at 7.7%, so sizable increase. They've literally bought 1% of the market cap of ACC in one single quarter. That is LIC. Of course, and known to be a value buyer, right, in that sense. What about green energy, sir? Prospects there. Is there value in that business?
Well, yes, I think the best part is that initial phase of putting larger cash and remaining, I think, cash deficient, I think that stage is getting over. Largely because of the fact that I think you're putting across 50 gigawatts of energy, green energy, capacity by 2030, and today as they complete different modules, they start generating the cash. So to a greater extent, I think the cash which is being generated is being deployed for creating the further expansion. So to a greater extent, I think this is an automatic machine in a way, if you want to call it as, wherein the cash generated is getting deployed into the expansion part of the activity. In my viewpoint, I think the cost of implementation on a per megawatt basis, as far as the green is concerned, is actually coming down because of the use of the better technologies, etc. And that is possibly also helping them in having the better amount of, I would say, profitability factor getting established for that. So one can remain confident about it. Of course, I think the energy, the green is basically, I think, right now quoting at a valuation which is not extremely cheap, but at the same time, if one is having a view for next 3 to 5 years, certainly at some amount of time and price correction, one can buy this particular stock into the portfolio. That's what our view is.
I have one final question, Vinbhai, and that is on the flagship with the Navi Mumbai airport around the corner, the airports business getting a lot of traction, and some of the other businesses reaching a really sweet spot in terms of size and operational metrics. What's the thought here? Hasn't really performed, and maybe because of that valuation, it seems to be a logical buy for a large investor like GQG. But what should a retail investor do? Adani Enterprises.
Yeah, Niraj, I think the airport business to me is a daily cash generating business. Like I think your road and the toll business that you have. And I think what they are possibly doing is creating an expansion in this space as well, wherein your existing airport operations, I think, are expanding to the new airport that you are acquiring as well as building. I think that is continuously going on. So in my viewpoint, I think this business will continue to generate cash. And as I always call it, this is a business, the road as well as airport, which are heavily capital intensive businesses. They are largely good for, I think, some of the large funds like sovereign funds, insurance funds, pension funds, or for that matter, I think the hedge funds which are focusing largely on the infrastructure side of the story. For them, I think they remain good because it provides you the discounted cash flow visibility over next 25 to 40 years because of, I think, the inherent operations that they have built into this space. So yes, I think I don't know about retail investors, how much patience they would have for continuing with this kind of investment, which is demanding higher amount of infusion of capital also from time to time. But I think for such kind of large institution investors, I think this business remains, I think, an attractive proposition to build the fund.
Okay, all right. Thank you so much, Devin Bhai, for coming in, giving us that perspective. Of course, the headline being that both LIC and GQG, known as deep value investors, have hiked stake in most Adani Group names. Thank you so much, sir, for giving us your perspective on why that may have been so. But from one conversation to the other, we'll go from micro to macro. We have Ankita Pathak, who's a macro strategist and speaks about global equities as well. She's a fund advisor at Ionic Asset, joining us this afternoon. Welcome, Ankita. I want to first start off by understanding how you're seeing the global setup at this point. You have US, which has hiked tariffs on China further by 200, or rather now making it 245% a tariff on China. With this entire battle playing out, how does India stack up, and what is your strategy globally with regard to where you're deploying?
Hi, good afternoon. It's a pleasure to be here firstly, and I think a bang on question. I think at this point it really doesn't matter whether it's it's 200%, 300% of tariffs, because this news is going way farther than what we would have imagined. So I think there are three possibilities here. One is that this is a US-China war. Everyone else is just looking at it from a viewership perspective, and within US-China also, they are smart enough to not have it on commodities that matter, right? So you saw US exempt smartphones, semiconductors, etc., which was, I think, it's a smart move because US big tech needs this. Then the second case is that this war actually escalates, and that is when the other countries need to start putting retaliatory tariffs, because someone needs to, nobody wants to bear the brunt of it. So there's excess supply in the market that China will now hold. Where will it go to? Will it go to Europe? Will it go to India? Will it go to Latin? And therefore, will these countries have cross tariffs happening? In my opinion, this is the worst probability that could happen, which will lead to a lot more volatility, I would say, in quarters ahead and not just months. And then the third outcome, which is, I think, the best case possibility, is that, China and US sit on a table, they get this out of the way. Maybe you will have headline numbers which are obnoxious, but for commodities that matter to the rest of the world globally, those will be out of the tariff zone, and basically the trade will continue as is. So this could be the war more of words than of substance. So if I were to go probability wise, I think the first outcome that I mentioned, that this is a US versus China war. Everyone else is now holding their seats just to see how this unfolds. I think that is where we are, where the 70% probability is. I would still say there's a 10% chance on this escalating. And I think 20%, the best case scenario, is where the two countries also solved for themselves. Now, within this, how we are investing globally has become very, very, I would say, interesting for us also. So from a very top-down perspective, I think Europe as an economy in itself is coming out strong. We've seen, flows move from US to Europe. We've seen Europe also do a lot more fiscal stimulus, revive of the defense expenditure. And it's also coming from very, very low valuations equity wise. So I think that has come out as a great space to be, which is not subjected to as much volatility as US and China right now is. So that is one space that we are watching. Of course, we also are not fully dismissive of the US and China market also, because within these markets, there exist businesses that don't depend on each other economy for supply chains, revenues. And because the major indices are getting, thrashed, and you see these whiplash movements in the indices, it is indeed a great time for an active manager to find opportunities which are fundamentally good businesses. And now I think in next 3 to 6 months, these businesses which were historically trading at about, I was 30 times forward PE would fall under 17 times forward PE and would become attractive again for the next cycle.
Ankita, would you taking large allocation calls right now, considering the situation is fluid and maybe talking about valuations or prices might be less material currently, or are you taking those bets right now?
No, so we're taking very, very cautious calls. We are holding large amount of cash. There is obviously fundamentals, there is good businesses, but there is also a lot of uncertainty. And I mean, let me just bring this example up when, Trump said that smartphones, etc., are exempted. And then yesterday he said, all your big tech companies did really well for a bit. And then yesterday he said that, one kind of a chip is a H20 chip, which NVIDIA could send it to China before. They can't do it anymore. And then you saw that volatility kick in, and all of these tech names were also slashed. So this has nothing to do with fundamentals. This has nothing to do with, valuations, etc. But I think for us, we are holding cash and we're looking for opportunities where this impact is the least and could be the least. The best way to do this is that when you're doing US companies, don't do companies which have a very strong supply chain from China or revenue from China. Similarly, when you're doing China, don't do companies which are very heavily dependent on global exports. And I think that way an active manager can protect the fund from tariff wars.
So Ankita, therefore, how should so you're positive Europe is what I understand. You're also positive silver within the commodities basket. Are you increasing allocation even at this point to silver over gold? You prefer gold as the better commodity, silver as the better commodity? Give us the rationale.
Fantastic. So gold and silver both have been our very, very strong call at Ionic Asset. At some point, we also wanted to, tell people that 2025 is going to be the year of asset allocation. So we need to look beyond equity and maybe carve out incremental allocation to both gold and silver. So we started with saying, more gold, less silver. And this would be, about a year back from now. From there, of course, gold's returns are known to all of us. And I think at this point, it is silver which remains like a very strong buy on dip commodity for us. Also easily accessible to Indian investors now. Silver, because it is very undervalued compared to gold. So I'm sure gold to silver ratio at 90 times is at a historic high. The industries that silver catered to, especially in EVs, renewables, etc., are seeing a good demand. And if we do not see a worldwide global recession, the chances of which are very, very meager because Fed has its own tools to exercise, I think silver remains a very strategic buy on dip. And I would definitely prefer it over gold. Coming to gold, I think for investors who bought gold, we are still recommending hold and not a clear sell, because I think there is still some value on the table. And this is coming from increasing and continued increase in demand. So the data has not really changed. And second, from the fact that when there is global uncertainty like this, if the risk of sentiment lingers on for another 6 months or so, I think gold will continue on the margin to do well. So between gold and silver, I would say more silver, less gold, but not a hard call on gold to sell as of now. I think there is still margin there.
Point taken. And what about the US 10-year? There's been just so much volatility there. Would you at this point, and also given the fact that there'll be roughly $10 trillion of repayments that the US will have to make, or refinancing which US will have to do in calendar year 2025, would you at all look to bet on that, or do you believe that at some point you will get better pricing even there?
Yeah, so I think US 10 years have become, I mean, it's a question in itself. It has broken the long known correlation with the dollar index also. So yields are high, DXY is under 100. It's an interesting macro picture to have. But let me just break down the US 10-year into what's happening structurally versus what's happening tactically. Structurally, of course, there has been a fall from domestic buyers. There has been a fall from foreign institutional buyers. And of course, we know the US's big debt problem. So the supply has been very high. So that the sheer fact that demand is falling, supply is high, would lead to higher yields. That is now. Beyond this, there are also many movers of US yields today. Okay, so one, there was a huge supply that was expected this week itself, and it looks like investors have really sold their existing holdings ahead of the fresh supply. Again, there is something known as basis rate, which was used by the hedge fund managers, where the difference between the treasuries and the future could be used to make money. And the expectation is that there is a huge unwinding of this basis rate that is also happening, which is pulling up the US yield. So I think these two are very, very current factors. These are transient factors versus demand supply, which is a very, very structural factor. So I personally believe that the transient factors is something that is causing this unprecedented volatility in the US yields. We are seeing a movement of about 20 to 30 basis a day, which is unprecedented and unusual. In terms of, what would be a good point to buy a US 10-year, I think it's a good staggering point. So I personally, if the yields are hovering above 4.3% onwards, I think some exposure can be taken for US treasuries for investors who do so. And then over time, once Fed has to act, maybe it's 6 months from now, when these yields start to fall, there will be a directional play towards I would say 3.5, if not lesser on the US yields.
Thank you for that perspective, Ankita. Thanks for taking out time, coming in, speaking with us. What we're going to do is we're going to slip into a very, very short break. On the other side, we'll bring you chatter behind dealing rooms in our segment Third on the Street. And we'll take, of course, top stock of the day, and we'll continue to take a couple of global views which are coming through. So stay tuned.
all packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They are saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
To India specifically,
Back with India Market Close right here on NDTV Profit. We should pull up the markets once because remember, since the start of the show, we've actually had a fairly decent clip on the indices and kind of maintaining that, which is actually a good sign. No changes. Volatility is still down 2%, small caps are still up 0.85%, but there is green on the screen. And therefore, it's that time of the show when we should try to know what is top of the mind of the dealing rooms. And Sumit joins in on the herd on the street segment. Sumit, it's so increasingly bottom up, right? I was with Sunil Singhania today, and the conversation is that it's all bottom up right now. Difficult to take thematic calls except for avoid IT. So my question to you is, when you are thinking of talking to these guys, right? What are the stocks that the dealing rooms are focusing on today?
Well, firstly, again on the sell side, what is the dealing room saying about it? It's on the pipe manufacturing companies like Astral, Supreme Industries and Finolex Industries. Now, dealers are indicating that there has been a price cut, PVC price cut yet again in the month of April. This time the price cut is around 2 rupees per kg. And so far in April, if you see, the total price cut has been around 4 rupees per kg. And year to date, the prices have been cut by nearly 9.5 rupees per kg. And this price cut could have an impact on the inventory and the margins of these pipe companies. So keep an eye out for the pipe manufacturing companies. On the buy side, as Neeraj sir was asking about it, IEX is one stock where there are buy flows on the FI desk. That is what dealers are indicating. Then Paytm, again buy flows on large HNI desk. The buzz on the street is that very soon the company might get its payment aggregator license, and that's the reason why the stock is up 4% in trade today. And lastly, it's Polycab and KEI Industries. Buy flows on institutional desks, both FI and DIs have been buying these counters at lower levels, is what this dealing room is indicating. And the buzz one of the reasons what dealers are probably saying is that that institutional investors are expecting strong Q4 numbers from both these companies, that is KEI Industries and Polycab. So keep an eye out for both these counters in trade.
Okay, so those are some stocks for you, and also flashing at the bottom of your screen, want to quickly highlight Swaraj Engines as well. Stock has moved 10% on the back of numbers. Have a look at some of those numbers. Margins largely flat on a YOY basis, but the growth is extremely good. PAT up 29%, EBITDA up 27%. So that's what's essentially enthusing the street, it seems, but Swaraj Engines is one of those. Let's quickly bring on board Lancelot Dukuna and Kush Bora, both of whom are joining us this afternoon. Welcome, gentlemen. Kush, let me start with you because want to know what's happening with regard to the Nifty today. It's certainly not in its element as has been the case over the last few days, where there's been a very range-bound day of trade, a gap-up opening, and thereafter a range-bound day of trade. Today, relatively, we've seen more volatility. What are the levels you're looking out for? What are the levels you're eyeing, and what are the trades you're making?
Don't be so greedy, Harsh. We've had a spectacular run over the last 5 sessions. Give it a day or two of breather, right? Will you?
Sure.
Also, I wanted to check. I mean, is that is the 245% tariff news true or not? Of course, I heard it a while back. Even you mentioned it. But I mean, earlier it used to shake markets, and it used to be stuff of memes. Slightly disappointed to say that the memes have at least gone, but heartened by the fact that even the markets are not reacting to it anymore. But maybe I shouldn't speak too soon. Now, as far as the Nifty goes, I mean, remember yesterday we spoke that it's a good idea to stay long in the market. If you're okay with a 1:1 risk-reward ratio, you could go on and create long positions as well, where 23, 500, 600, those kind of levels will act as resistance, 23,000 will act as support. That view remains. But now what happens is, with that view, the 1:1 risk-reward ratio is also taken out of the window. So I would wait for a dip closer to the 23,300 level, perhaps even slightly lower, to create fresh long positions from where my risk reward ratio becomes very favorable. Also, the 23,300 put, like yesterday, even today, has had a significant addition, suggesting that could act as a bit of a support level. So closer to those levels, about 100-150 point dip should be a good entry opportunity. If you have a long position, continue to hold with that as your stop loss. But fresh long should only be done on declines on Nifty.
Understood. And what about the Bank Nifty, Kush? Because that is showing a totally different picture of resilience.
It is. I mean, this one's not in the mood for taking that breather, right? But that might mean that you might see a round of profit booking coming in. Unlike the Nifty, the Bank Nifty has actually gone into overheated territories on smaller time frames. Also, the PCR is now approaching 1.2, 1.22. We know 1.3 and higher are the overheated zones. So for me, Bank Nifty just now would be a profit booking, opportunity. Yesterday we did speak of a resistance level of 53,200. Beyond that, 54,000 comes into play. Today's high was 53,123. So not a bad idea to book profit partially, if not fully. But here too, the view remains that you might want to buy closer to the 52,000 mark, a decline of about 1,800 points or so. Again, risk reward ratio will be favorable, and as I said, it's already such overheated territory, so some profit booking is par for the course. So Nifty long is a hold. Bank Nifty, I would suggest it's not a bad idea to take some money off the table and re-enter at lower levels.
And two stocks in particular, Kush, before I take your picks and thereafter go to Lancelot. We have IndusInd Bank up 7.5%, 7+% move, or rather 6+% move, second day in a row. Axis Bank up 4.5%. That too, second consecutive day in a row, 4+% move. What's your sense with both of these?
So if I were to pick one of the two, I would pick Axis Bank, largely because the structure's positive. The major trend was consolidation, and now you're seeing a breakout above some of the key levels. The 200-day moving average has been taken out today after some time now, about 3-4 months. In fact, first time in this calendar year. So this momentum is here to say. We've seen the entire sector at play, where the top picks were HDFC, ICICI, then Kotak, and now finally a catch-up play on Axis Bank. So from that perspective, from a catch-up trade perspective and the increasing momentum perspective, there's a good possibility that for levels of 1,200 and about 1,235, 1,240, Axis Bank could still stretch this run. As far as IndusInd Bank goes, we know, it's been beaten down quite a bit. Here the case is that no negative news is a positive news. Not a good idea to be in a stock where such a theme is playing out. Also, it might just start facing resistance around the 800 and 825 mark. So if you have a position, take these opportunities to perhaps offload or exit out of IndusInd Bank. Axis, yes, you could still create long positions for levels of up to 1240, 1235.
And your picks for this afternoon, Kush?
going with a long and a short, given the kind of caution, or not caution, but given the kind of pause markets might hit. So KPR Mills is a positive. The stock had a good run. Volumes have also picked up above the resistance level of 1020. Now, the targets on this one are 1070, 1105, 1000 being your stop loss. On the short side, I've got a pharma name, which is Glenmark Pharma. Barely participated in the kind of reversals or the short covering bounces also that the markets have seen, continues to reel under the pressure, has broken the support zone of 1360. So on the downside, your targets are 1340, 1320 with 1375 being your stop loss.
Okay, thank you for that, Coach Lancelot. Let me come to you, and thank you for waiting by extremely patiently. Two pockets which are doing very, very well in trade today, and has been, and we were just speaking to Coach about that, Nifty, both on the private banking side, but the PSU banks as well. What are your views, given that there is a repo rate cut, that you're seeing around 25 basis points shaved off on most private sector banks in terms of their savings bank account rates that they're offering, and we're not seeing that translate fully yet to lending. So what's the sense? Is banking going to likely perform better than expected in this rate cut cycle?
Yeah, in the rate cut cycle, you will see banks exhibit better margins because, like you said correctly, they haven't yet reduced, substantially the lending rates. So lending rates always take a little longer to reduce, and so the flow of falling rates necessarily doesn't get translated to lower lending rates, and that helps the bank in terms of improving net interest margins. It also helps the bank in terms of being able to extend credit, because since rates are lower, then they can also extend further credit, and it becomes easier for borrowers to look at, maybe borrowing a bit when the rates go down. So the other aspect of the lowering of interest rates as well as the yields is that their treasury book will also get restated. There would be some amount of treasury profits being reflected in the quarters going forward. And as long as inflation keeps falling and you start seeing a lower trajectory for inflation, there is possibility that we might see maybe another quarter or maybe another 0.5% drop in rates over the year. And that bodes well for banks, both private sector and public sector will benefit from this reduction in rates. And given that valuations, of banks had not really gone up significantly over the last 1 or 2 years, it also gives a relatively attractive proposition because you're likely to see earnings upgrades and valuations remaining where they are. It makes it an attractive investment option.
Okay, well, on to what could arguably qualify as stocks of the day. Lupin and Zydus trading lower after losing a litigation on a key drug. Let's go across to Varsha for more details. Varsha.
Thank you for that. So yes, Lupin and Zydus both the companies are under pressure because they've lost the litigation on a particular product called Mybregon, which treats overactive bladder. Now, there was already a court case going on with the innovator company for this product, and the decision has gone in favor of the innovator. Now, please remember that previously both these companies had got US FDA approval to sell the generic version of this product. And now, why this is very important and why the stocks are down, because these products were very important for both Zydus and Lupin. They contributed meaningfully for both of these companies in first quarter of FY25. So for example, for Zydus, it contributed almost $40 to $50 million of sales and 15% of EBITDA in Q1 FY25, while according to consensus estimates, they were to contribute $120 million and $40 million of sales for Zydus in FY25 and FY26. For Lupin, the likely contribution was almost 7 to 8% of EBITDA and $15 million of sales from this product. Now, because both these companies have already launched the generic version of this product, now they might have to withdraw the drug from the market, and eventually they could see some financial liability for both of these companies.
Okay, interesting. Thank you so much, Varsha, for that perspective. Lancelot, let me come straight to you with regard to a couple of these counters. Zydus Life, Lupin. Zydus is in fact down 7.5%, Lupin down 4%. Now, anything between 5 to 10% of their EBITDA impacted. Do you believe that is a bit of an overreaction or justified?
I think, given that valuations are where they are, this is reasonably justified, even though it's down 7-8%, because, this drug does provide them with a fair bit of revenue as well as fair bit of contribution to the EBITDA. And also going forward, one has to be a little careful that, we've still not seen impact of anything that is coming up on the US front. Hasn't yet really got factored into the earnings calculation so far, and that may unfold over the next quarter or so. So it does look like it's becoming a fair valuation. It's not really let's say an overestimation on the downside. I think it's reasonably fairly priced in at this point in time.
Okay, so fairly valued. Kush Bora, your view with regard to technicals on both of these?
Well, both of them have been under pressure for some time, and there's this falling trend line resistance for both these stocks. Even in the last week's up move, when these stocks tried to move higher, they weren't able to cross, some key technical levels, and the volumes also on the way up weren't really as encouraging. So I will not take this dip as a buying opportunity. In fact, some of these support zones are being tested. So for a Lupin that comes close to the 1900 mark, 1890 to be precise. Beyond that, the recent low of 1800 will come into play. Zydus also very close to the recent low that it made last week, which is close to the 795 mark that comes into play. So I wouldn't really be in a hurry to buy some of these names. The major trend has been negative, and any recoveries have also not been so meaningful. So for now, they are an avoid for me.
Lancelot, are you buying into any of the healthcare? Actually, not healthcare. I'll limit it to pharma within healthcare, only because of the fact that there is a bit of an unknown element to what could happen to pharmaceuticals. So sometimes valuations come in your favor. Have you used any of these to add up positions or buy new positions into pharmaceutical names?
Not yet, because while the prices of these stocks have come off, so valuations have come off. We need to understand what is also going to be the impact on the sales and the profitability going forward, especially because for most of these companies, the US is a major market. And it's not only the tariffs actually as an issue. Over the past couple of years, we've seen a lot of companies be subjected to FDA inspections, and there has been greater restriction in terms of maybe making it more difficult for for Indian companies to access US markets. The other interesting thing that we've been seeing is that while many drugs do go off patent, the values or the prices of the original drugs actually are dropped down significantly. So people who are trying to compete in that space and make other versions of the drugs that have gone off patent find it difficult to really sustain, because the original manufacturer has dropped prices significantly. So I think the entire model has been changing a bit, especially with those companies, pharma companies, which are focused on overseas markets, and because of which the growth coming from overseas markets is a lot less as anticipated. So really speaking, I haven't been adding any of these stocks at this point in time.
Interesting. Lancelot, so what have you been buying at this point? What is that one sector or maybe 3-4 bunch of stocks that you're really liking, and give us the rationale behind those?
So in the healthcare space, we've been very positive on the hospital sector because we believe that is a domestic play, and it is something because of the demand that has been growing. We are seeing greater need for hospitals, as well as with more and more people getting covered by the hospital space and by insurance. That sector is gaining a lot of traction. So there is a shift from maybe smaller hospitals to consolidation taking place, and you are seeing larger hospitals consolidate and create their operations where they can take advantage of scale. So that's a sector which we've been looking at and adding. The other has been in the insurance space because, we always felt that life insurance as well as general insurance is a space that is going to see significant growth in India. And it's a domestic marketplace where we aren't seeing that much of impact because of things, direct impact because of tariffs, etc. And we did get results of ICICI Prudential, which came out yesterday, that have shown that the company has been growing. There is a focus on protection now, more as opposed to looking at insurance with investment products. And that, growing awareness of taking insurance for life protection is actually driving business of the insurance companies on the rise. And that we feel is a good opportunity from a little longer term perspective. And in this correction, we saw that valuations also had come off. So that made it an opportune investment opportunity.
Okay. Interesting nuggets coming in there. A couple of stocks which you may want to keep on your radar. But IREDA in focus on the back of numbers. What we're going to try to do today is try to look at the bull case and the bear case on IREDA. Of course, the stock running away in trade, but always interesting to look at the bear case as well. So let's pull up. Firstly, in terms of growth, it's been extremely strong, right? It's a fast-growing sector, large tailwind with regard to where renewables is concerned, and they've grown their book at 27% CAGR. That, if I were to tell you, coming from a PSU, is of course indeed very, very strong. But what's the bear case here? It's the assets are chunky, they're large assets, and therefore any small slips, and we've seen this in power financiers, any small slips can cause a lot of pain. The other one is that IREDA comes off a very, very low base as well. So that 27% growth rate is on an extremely low base. In fact, a couple of years back, they were 1/10 the size of PFC, REC. They continue to be roughly a 7th in terms of the size, relative size versus PFC and REC. And therefore, quite in that sense, the growth to be put in perspective. Let's talk about margins. That's the other key piece which is driving profitability higher. Margins have gone from sub 2.9% only in this year, in this financial year, to 3.3% nearly. It's a 42 bp margin expansion, but the margin expansion has come on the back of a lower cost of funds and not higher yields. How sustainable is that? Your cost of funds coming off even more is always difficult, as there is always a bottom in terms of how much can cost of funds come down, and therefore NIM upside from here, I'm not so sure whether that may be doable or not. We spoke with management as well. Unlikely that will sustain. So some bit of that profit headwind may just go away. The third piece is with regard to the way in which profitability has evolved. You've seen a strong surge in terms of profits. 2 years, 40% CAGR profit, 27% CAGR loan book, 40% profit, margins aiding profitability. But there is one account, Gensol, which constitutes around 600 crore odd in terms of size, 650 crore, which might be slipping or might impact that profit compounding in this particular year. Maybe. We'll have to wait and watch for that. But that's the risk that the company faces, chunky assets, therefore. Last off, on valuations, stocks fallen 42% from peak levels, so clearly it's well off the highs, but still trades at 5 times price to book, which is certainly not cheap. Forget for a typical NBFC, but even more so in case of a power financier PSU, and therefore something to be kept in mind. Lancelot, which side of the fence do you sit on, if I can ask you? Would you sit on the bullish side where IREDA is concerned, or the bear?
Well, I am on the bearish side at the moment.
Okay.
And the reason behind that is, one is when you are financing only a particular sector, there is always this high risk that whenever that sector slows down or growth in the sector slows down, you will tend to see, higher proportion of NPAs, and then it becomes very difficult for the companies which are only financing a particular sector. And we've seen it in the past, whether it was tourism as a sector or it was power as a sector, and you had specialized financing, companies only for that sector. And there are periods of time when the sector undergoes, a bit of stress, and that could lead to, severe problems. The second issue with, with IREDA is that it is focused on a sector that at the moment, people are expanding at a very hectic pace. And because of the, the government's support as well as the thrust on that sector. But most of this financing takes place, for a long period of time, maybe 3 years, 5 years, 7 years. And over a period of time, conditions change, people's, activities change, and that could all have a negative impact on the sector. So that's why I would rather stay away from the sector at this point in time.
And would that view be the same for a PFC REC as well, given the fact that they are all within the power financing basket, but valuations are starkly different? So therefore wanting your view there as well.
So I think as far as PFC, REC are concerned, it is, while they do finance power, but, they are financing various segments of the power sector. So you can have power generators, you can have, people who are in the distribution line, the power transmission line, the power equipment manufacturers. So they are catering to various clients across different kinds of, although it is at the same broad generic power sector. So all people do not, let's say, get into trouble at the same point in time. Maybe the manufacturers or the power distributors, they may benefit at some point in time. The other people could have a tougher time. The actual users of power could have difficult conditions. So it sort of evens out, So I would still say, and even the valuations are a lot more favorable for both PFC as well as REC as compared to IREDA. So from that perspective also, these two could be still more, let's say, beneficial in terms of looking at it from an investment perspective, whether to add, it would be better to look at PFC, REC as opposed to only IREDA.
Okay, thank you so much, Lancelot. We'll let you go on that note, and what we'll also do is we'll slip into a very, very short break. On the other side, we'll continue to get you top ideas, top buy today, sell tomorrow recommendations also coming your way. Stay tuned.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
All right, back with India market close. Now, today a clutch of stocks are actually falling off the cliff as well. So, look at Balu Forge. I think Balu Forge is down 10%. JTL Industries, I think, is down 20%. Okay, Balu Forge has recovered a little bit, but still down. JTL, 19%. Gensol, I'm sure, is reeling under pressure even right now. So, there are issues for that stock, down 5%.
No pressure, Neeraj. No pressure.
Whatever had to be exerted has already been exerted. So yeah, point well taken out there. Ease My Trip is under a lot of stress as well. So 8.5%, 9% lower for that stock too. A clutch of names coming under some very, very high pressure currently. In addition to pharmaceuticals, some of the names which we spoke about as well. Kush, you'd be loath if I ask you for a chart check on Gensol, so I will not. but let me try and dig out some others which have actually had a good run today, right? So the likes of GMDC, which is up about 10-11%, or a JBM Auto, or in fact a clutch of PSUs today, including an EIL, NBCC, etc., are all doing fairly well for themselves. On these PSUs, any thoughts?
I think they're coming back in favor, Neeraj. Started with PSU banks, largely some of the PSU financial NBFCs also. But I think some of these names are now starting to, make a comeback, and a strong one at that. I think this is also, a flavor of the undertone of the market, where when some of these names start to participate, you do get a sense that the bulk of the worry perhaps is over. Now to come to some of the names that you've mentioned, good moves on the likes of GMDC, Engineers India. If I were to pick one at the moment, it would be Engineers India. Good volume consolidation was on the cards for about a month and a half, 25, 30 odd sessions, and then it's given a breakout. Mind you, this was a follow-through move. Yesterday also the stock was up about 5.5-6%. But I think from a positional standpoint, there is still a room on the upside. 195 to about 208, is where the stock could still head to. 170 comes in a good support zone, so that should act as a stop loss. GMDC also is shaping up very well. The volumes are significantly high compared to, for the last 20-30 days average, maybe even more. But it's now coming to the resistance level also. If you see from the day highs, it slipped a bit. So I will wait for the 325 mark to be taken out, perhaps some cooling off as well, on the downside. 305, 300 is where you start to accumulate it again. Structurally looking good, but I prefer Engineers India over GMDC. And GMDC, as I said, on a decline closer to 305, 300 level, should be a good add once again.
Samir, good afternoon and thanks for joining in. This, since we are talking of PSUs, right, and there is a bit of a flavor that has come in. There are some couple of PSU funds as well, I believe, which are in the lieu of getting launched too. Can I start off with a micro and then expand to the larger PSU bucket? Power financiers, a bucket which is in the right mix in terms of a sector which is growing. Do you and the valuations aren't too expensive except for IREDA maybe, but do you like this space? And you could like IREDA as well, by the way, good numbers, but IREDA, PFC, REC, do you like them? Why or why not?
I do like that. Okay, so let's talk about PFC, REC. IRDA, like you said, the numbers have come out, they were good, but we find valuations very, very uncomfortable there. NBFC trading at over 4 times, 5 times price to book, especially when it's government owned. I mean, it leaves limited room for upside. So from that perspective, we would not invest in IREDA. PFC, REC, both interesting. So PFC, actually, if you buy both PFC and REC, because REC is the subsidiary, 51% of REC is owned by PFC. So you kind of get the entire basket of both of them. The renewable energy space is seeing a lot of growth. And at the end of the day, it's not only going to be IREDA who does the renewable energy, PFC, REC are also going to participate in that. That aside, you're going to see nuclear power getting it set up. You're going to see expansion, more expansions coming even from the thermal side, because in India, we cannot rely solely and all completely on, renewable sources of energy. So we will have thermal expansion, and that would be an opportunity. Now, when you look at the books, largely it is through the private PSU space, right? The government, the loans. So the risk of default is now very low. 90% of the book is to that in the case of PFC. And 10% is to the private space. And that also is very limited. I mean, to some of the larger players, so the risk is very limited. So you have this business which has good growth opportunities, low risk, valuations are decent. It's trading closer to 1 time book or a little under 1 time book. So you have valuations in your favor. And if what we expect to happen happens, and the book is able to grow at anywhere between 10 to 18%, which is our expectation CAGR over the next 3 years. It's a large band, but we would prefer to say that it'd be more like 14-15% growth. If they're able to generate that, I think the stock can easily give a re-rating multiple moving up from 1 to 1.5 times book, plus the 15% growth. So you're talking of decent returns for both PFC and REC over a period of time.
Point taken. And while we're speaking about power financiers, let's also talk about IREDA. We spoke with the management of IREDA, and we spoke about Gensol and the lending, as well as how they're planning to account for possible loss coming or emanating from Gensol. Mind you, the lending was to the EV segment of Gensol, but how are they going to account for it in the books? And we spoke with Mr. Das, who's the managing director at IREDA, about that. Listen in.
As of now, our account with them has not become NPA. Number one. And number two, whatever overdues as of 31st March is around 80 crore. Against that, if you see, we have around 60 odd crores in the form of Desra and FDs. Okay. So roughly this 80 crore to recover, around 60 crore we can recover even overnight. But that is not the way to handle. You see, now we have not stopped lending any additional financing to them for quite a long time, because if any of our developer is growing and growing very fast in the private space, we also have a review monitoring mechanism. Our team is doing, and since we are under RBI, as per the RBI policy, we have a investigation policy. So our team investigation committee is doing that. Parallelly, it is going on, and yesterday we are very fortunate. We have published the result, and then we have seen the SEBI's report in their website about their findings and all. So our team also now working on it.
Okay. The other one expected to declare numbers is an HDFC Life. We've seen some zing on the stock last couple of days. Samir, curious to know your view. Expecting to see some bit of margin dilution to play out, likely even in this quarter, Q4 versus Q3. Maybe 20 bips thereabouts is the expectation. Curious to know what your view with some of the life insurance pack is like, Samir. Some of these names have corrected significantly from the highs. Some of them have languished for a while. Something like an HDFC Life within this band. Interesting play. What, according to you, what's your view?
So we believe the growth opportunity for the entire life insurance space is phenomenal. Over the next few years, you'll see all of the players being able to grow, because the penetration in the market, as much as we want to say is there, is very limited, because most of this penetration is done through kind of investment products and not through general, just like a basic life term plan. And I believe that is an opportunity which is going to keep growing. Sorry. So like I said, the opportunity is large. Again, for HDFC Life, maybe a little bit the stock has run up. It's run up from 600 recently to about 700 and odd, 715 as I can see on the screen. And that means that the valuations have also caught up a bit. So that is not something I'd be in a rush to buy. So if I wanted to make a play right now, one of the easiest plays for me to make in the life insurance space is LIC. The stock has seen a decent correction. The embedded value that they have is extremely large. They are still the largest player in the market. Yes, they're losing some amount of market share, but that doesn't matter because the market by itself is also expanding. So they are also being able to generate new business. And like I discussed, the embedded value is there. Once the value unlocking happens, I think there's a re-rating on the cards for LIC. So that would probably be a top play, followed by ICICI Pru Life. Again, yesterday they announced the numbers, which were decent. There was a bit of margin compression because if you look at this, if you look at through the books, there was a loss on its investments that was booked for the year because maybe markets were down, maybe interest rates moved up. But those are things that happen in a quarter, and I don't think we should look at that in a totality. The embedded value still, again, for them is also decent, and we think there's good upside. So our top pick LIC, followed by ICICI Pru, and then if HDFC corrects closer to 620 odd levels, we definitely be looking to buy into HDFC again.
Interesting. So those are some names for you and some levels to look out for as well. Curious to know, Sameer, what your views with regard to a Z Entertainment are if you cover the stock and if you have a view. Stock is up 5%. We've seen this fall considerably, and I bring this up because I remember maybe a couple of weeks back we had a very interesting CLSA note talking about that the stock being on the cusp of a re-rating of sorts, both a turnaround of sorts with regard to numbers as well. You'll see margins get better, etc. What's your sense?
So actually, we did have coverage on it. We've, of course, recently not looked at it very aggressively. I haven't sent out any note, but I know the company well. And what I can tell you is that, look, I think a lot of the pain point and the worst that is there in the stock is done. From here, the downside is very limited. And rightfully, you said, I think CLSA, or you quoted the CLSA report saying that they're looking for a turnaround. We've been waiting for the turnaround for the last 3 to 6 months. We also have been thinking that, with the kind of channels that they have, the kind of programmings that they have, their Z5 getting more and more traction, more users getting on board. It should hopefully turn around the profitability of the company. And once that happens, then there's a definite re-rating on the cards because it's probably trading at, I think, if we were to extrapolate based on what their revenue could be and what their profitability could be, it's trading at probably 1/4 or 1/5 the times the valuation of maybe something like a Sun TV or something like, some of the other channels that are there. I mean, some of them are even loss-making for that matter. Z is not that bad in a shape. So our view is that, yes, the worst is over. Question is, when do they turn around and how quick is it going to be? Once that does happen, I think there is a re-rating opportunity. So one can stay invested if you've invested. Keep an eye open. Once you see numbers getting better, I think it's better to jump on the bandwagon then. You may pay a little bit higher, but at least the turnaround is in place and the management has been able to turn the business around. So I'd wait a little, but I would definitely be a buyer in this stock in the near future.
Sameer, sorry, very, very quick question before I move on. Last 6 months, the stock has been pretty volatile. It's down 30% in the last 6 odd months. At what price point do you see ideal value here? From a viewer perspective, that will be great context.
So ideal value is there even today. Okay. If you have patience of maybe 3 years or 4 years, I think there's ideal value even today. The reason I'm saying wait a little to buy is I want to see the turnaround actually start happening and where the traction is going to come for them. Because the ad revenue growth is something that is extremely important and that has not really happened in the recent past. So once we see that some of that content which is there is able to pull the ad revenues because of the kind of programming that they're airing, then I think the opportunity will open up, and I think it could take another 6 months before we start seeing that traction. So I would wait. Ideally, there is value today also.
Okay, perfect. All right. So great views coming in. But anyway, let's switch focus. Sources have told NDTV Profit that the government may invite bids for electric buses under the PM e-drive scheme. Let's go across. We have Aishwarya joining in. Aishwarya, firstly, welcome to NDTV Profit. Also, what are you picking up? Please tell us.
Thank you so much for that, Harsh. So what we're learning from our sources, and of course this is in order to give a push to the electric mobility and green mobility push that the government has been an eye out on. What we're learning from our sources is that Centre will be inviting bids for electric buses in a phased manner under the PM e-drive scheme. Now, the Ministry of Heavy Industries is the one that will be driving this particular, driving the bids for the electric buses and are seeking bids for about 8 to 10,000 electric buses in the first phase. Now, the bids may be called as early as next, which is across during that time. And these electric buses will be used to operate intra-city across 9 cities in India. We still have to get clarity on which cities they're targeting for this. Now, for context, the government had earlier notified the PM e-drive scheme back in February 2025 following the budget announcement. As far as the scheme is concerned, offers about over 4,000 crore for procurement of 14,000 electric buses by state transport undertakings as well as public transport agencies as well. So that's the update as far as the PM e-drive scheme and procurement of buses is concerned. As far as the government's goal for green mobility or electric mobility goes. Back to you.
All right. Thank you so much for that, Aishwarya. But let's put this into better context because we've got some stocks which are flying in trade, and we've covered this a bit even earlier during the day. Puneet's here to help break down the stock impact. Puneet.
Well, thanks for that. So definitely the listed players such as JBM Auto is one of the key beneficiaries. Now the company already has a capacity of manufacturing 20,000 electric buses in a year, and they've already got an order book of about 5,000 electric buses for the next few months. So definitely if an incremental addition of orders is expected under the PM e-drive scheme, as my colleague Ishwar highlighted, one of the beneficiaries could be JBM Auto, and we're seeing the stock react positively as well. Apart from that, the other one would be Electra Green Tech, but there is a couple of caveats here. Now the company already has an order book of 10,000 electric buses going forward. The other aspect is that its capacity hasn't ramped up as expected. The stock, while reacting positively, has manufacturing capacity of about 2,500 to 3,000 buses. So it already has an incremental order book, so might be a key beneficiary going forward. But Electra Green Tech is something to watch out for. And the other two are legacy, bus makers. Ashok Leyland being the first one. Now it operates and the electric bus unit under Switch Mobility India. Now we've seen recent action on Switch UK. So the focus is back on the profitable as well as the high growth India market for the electric bus segment. They already have 1,800 buses in terms of order book going forward, and one key aspect that they highlighted amongst the whole Switch UK aspect, that they will not be looking to enter into any GCC contract, which is effectively deferred payments over 12 years. They will be looking to outright sell buses directly to state transport undertakings as well as public sector units. So that is one. And finally on Tata Motors as well, company already has 3,500 electric buses running all across India, and we've seen states such as Karnataka, Maharashtra, Gujarat being the forefront of that, and Delhi could be another one. We've already seen they want to get 5,000 electric buses going on road very soon in the budget as well. So these could be some of the key players to watch out for in terms of announcements for electric buses, and definitely a positive aspect in terms of margins going forward for these players as well.
Thank you so much for that, Puneet. Kush, let me come straight to you with regard to a technical view with regard to a couple of these. JBM and Electra, both of them flying away in trade. What's your take on charts?
So a bit of a caution on Electra. The stocks actually tried to move higher, but has actually given up. Even if the move today is considered, then you'll see the stocks actually come off the 1275, the kind of highs that it has made. Volumes are good, the news is positive, hence the stock is reacting. But other than that, the broader trend on the stock has been down. So I would actually be a little cautious on Electra. If you have it, then it's not a bad idea to continue to hold, but I wouldn't add a fresh. So a wait on Electra. Quite opposite to this is JBM Auto, where the stock did attempt a rebound over the last month and a half, but along with the market volatility, it sort of gave way. Now it's again back to its spinning ways. The resistance levels of 665 also being taken out rather convincingly. 700 might act as more of a psychological level, but not too much of a technical significance here. JBM Auto is the one that I would go with if I were to pick one of the two. On the upside, you're still looking at levels of 735 and perhaps even a 780 as moves on the upside. 640 will now start acting as a support zone, so that's stop loss.
Okay, and Kush, while we are at it, your BTST?
Sure. So the BTST today is Apollo Hospital. We've discussed this stock just about last week, I think, for a second target of 69.50. That's been hit today. The stock also above the 7,000 resistance mark. The momentum is good. And I think I've listed pretty much all the big hospital names over the last week or 15 days, as picks. And the entire sector does continue to perform well. Going forward, the targets for Apollo hospitals are 7140 and 7300, with 6870 being a stop loss.
Okay, let's also go across to Puneet, still with us. Wipro set to come out with fourth quarter numbers. Again, IT will come back into focus as we start to wind down this week, tomorrow. Both today Wipro, tomorrow Infosys, and then we'll have another long weekend. What should we expect from this one, Puneet?
Well, specifically, it's expected to be a slow quarter for all the large cap IT peers, and Wipro is no less. 1% expected in terms of revenue growth for the company, while margins are expected to largely be flat at 17.3%, while I think the street might anticipate a positive margin for 17.3% because it's the first time in the previous quarter that they breached the 17% mark in terms of EBIT margins. If that continues, it will be a positive because of other impacts as well. While profit is expected to be largely flat to a negative bias, a fall of 1% is expected to come in at 3,317 crores. Now, in terms of key expectations, while revenue growth will be driven by the BFSI, which is the banking and financial as well as insurance segment, as well as some positive aspect on healthcare, it could be offset with slower growth essentially in telecom as well as the technological segment specifically. We've also seen that the positive INR depreciation, which was expected to impact positively, will be offset largely by the hedging or margin as well as the wage hikes which will come in this particular quarter. It's largely neck and neck essentially, but 17% margins for me specifically will be one of the things to watch out for. Apart from that, we look at the quarterly trend as well. The EBIT margins, as I mentioned, largely been in the 15 to 16% range, so and a beat will be a big positive on that, as well as the deal wins. It's slightly slowed down around the $1.5 billion range over the last 3 to 4 quarters. That's one of the key things to watch out for in this particular one. While the attrition rate has largely remained stable between 14 and 15%. And finally, in terms of guidance expectations, both Nuvama is expecting Wipro to have a -1 to roughly a positive 1% guidance for Q1 of FY26, and Nomura is also expecting a similar band from the -1.5 to the positive 1% range. And one of the key monitorables will be, of course, the commentary on the deal pipeline going forward, as well as the consulting business. But overall, a largely flat result, with some key things to watch out for, like EBIT margins and the commentary going forward as well.
Okay, well, thanks a lot for that, Puneet. And just marking a few stocks which are showing some very interesting moves now, and we're trying to do a bit of a last mover moves with Kush and try and understand what to do with some of these stocks. Max India is one which has had a fairly sharp uptick, will come up on your screen, but I think actually it's off from the highs of the day, but still higher in trade. Okay, so I stand corrected there, 8% higher. But DOMS Industries, let's see if that one has a bit of a spike or no. It is a late hour mover, yes indeed, 8% higher for DOMS. CEAT has gained over 2-3% from the lows of the day, or maybe slightly more. In fact, 4.5% higher too, so pretty good going. And I wonder if ITC is decent, Karur Vysya is decent too. Some 4-5 names, Kush, out there. CEAT in particular stands out. Any thoughts?
Indeed, it does. CEAT actually, at the high point of the day, it's been building on the gains that it had at open. Good moves on this one. Could actually see much higher levels going forward, about 3120 to 3200 on the upside. Now the resistance of 2920 will start acting as support. So not a bad idea to continue to hold on to this one. Maybe you could go ahead and add as well some. But amongst some of the other names that I mentioned, two stocks, that I would pick. One would be DOMS. This had featured on our radar also a while back, but then it dropped off because of the sharp fall that it had made. Now the stock took support at the 200-day moving average, rebounding from there. I think this could well move to 3,000 levels or higher as well. That's the kind of volatility that the stock usually has. This time it's on the upside. Your stop loss is at 2,700. Also, the second stock is Karur Vysya Bank. This has actually been one of those stocks which has done well but has gone under the radar for a while now. So I like this one in particular. Every dip that you get, about a 3 to 5% kind of a dip should be taken as an accumulation, as a buying opportunity. Not a trader counter, more of a buy and hold kind of a strategy in this one. But yes, today the stock is now broken above the 200-day moving average. This momentum could well continue. I would suggest a buy and hold on Karur Vysya for levels of 235, 250 as well. And on the downside, you've got 20-day moving average support near the 205 mark, so that should act as the stop loss. So positive on some of these names, Toms, Fiat and Karur Vysya Bank.
And Sameer, if I were to come to you with regard to, again, sector or a pocket where you are seeing value at this point, give us your thoughts, view.
Well, banking is one of the spaces that we have always been very positive on, banking and NBFCs. So we believe that space will continue to do well. So that is one. We think the auto space is actually also quite interesting. Tata Motors has seen a decent correction. Some of the auto ancillaries have also corrected. Of course, some of them valuations, like the stocks that we like are Motherson Sumi and Sona BMW, but they are still, valuations are a little bit on the higher side. Corrections for Sona BLW to closer to 400 is something that we would like. Even a little low, maybe 380 would be the ideal time to get in. Motherson Sumi closer to the 100, 110 range would be ideal. Tata Motors is a buy right now, and banking in the private sector bank, if you go down the value chain, apart from the HDFC, well, HDFC is still interesting, but the ICICI and Axis, if you avoid it, you go down to IndusInd, IDFC, First Bank, that is interesting. The NBFCs which we like are something like L&T Finance, AB Capital. We think the growth opportunity in both of these is still very strong. Valuations are relatively attractive. And as you see the microfinance coming out of the pain point, some of these lendings that you do will come back and boost. We believe the renewable energy space is still something one can focus on. We've been quite positive and constructive there. We think the opportunity is a multi-year opportunity. So companies in that space, something like Sterling and Wilson Solar, there's KPI Green, Suzlon Energy, NTPC Green, Tata Power, all of these actually are very interesting plays from the 3 to 5 year perspective, and that's where we remain constructive.
Okay, thanks for that. And Sameer, we'll let you go on that note. But Kush Bora, very, very quickly, ITC, can't let you go without talking about that. Very quickly.
A good move, consolidation, but I would suggest wait. Momentum is not building up. Perhaps after it crosses 430, you could consider a long trade. But for now, if you have continued to hold, I wouldn't advise, fresh trade till 430 is taken out.
Okay, Kush, thank you so much. We'll let you go on that note as well. Thank you for your views. 0.5% higher on the index. We're closing at the day's high. Really no reason to complain on a day like today, especially after the kind of Friday we've seen, long weekend thereafter. We've seen a good Tuesday as well, and we're sitting 0.5% higher even today. So absolutely nothing to complain about. Let's pull up the intraday chart, and 1.5% on the Nifty Bank. That's what's essentially driving this little bit of an uptick that we're seeing on the Nifty 50 index today. We look at constituents, but there you go. So that's the Nifty Bank, 1.4% higher again at the day's high. We're at 53,000 plus in trade today. 700-point rally seen on the Nifty Bank. Both private sector as well as public sector banks doing well for themselves. You can pull up the charts for both of those, the private banking index as well as the PSU banking index. There you go. Both of them doing very, very well. 1.7% higher on the private banking index. The PSU banking index up 2.5% in trade today. So certainly a day of cheer for the financials. Let's look at the heat map on the Nifty, and likely those are the pockets in focus. Nearly 7% higher on IndusInd Bank. Very similar kind of number yesterday that we saw in terms of gains for shareholders. 4% up on an Axis, second straight day for that as well. Trent has had a really good day. From the lows, it's up nearly 5%, close now 3.5% higher. The Adani twins also did relatively well. Adani Ports up 2% odd. SBI has done well for itself as well. And HDFC Bank was up over 0.5% thereabouts. ICICI also just about there. IT was one pocket which was slightly more muted in trade. That's one pocket which you will find slightly on the softer side today. We saw auto as well, slightly on the softer side. Bajaj Auto, Tata Motors and Maruti among those which haven't had the best day. But nonetheless, we've done fairly well for ourselves on the index as a whole. Let's look at the advanced decline, and that's broadly what's played out in terms of the breadth as well. Fairly solid breadth, almost through the day, if I can call it. Just a couple of blips here or there, but otherwise the breadth was strong and well in favor of the bulls even today. What I also want to look at is the sectors, and within sectors, I did speak about IT and auto being slightly muted, but along with it, Pharma also has had a dull sort of a day today. Metals were up just about 1/3%, so underperformed for sure. FMCG was the one which has outperformed outside of the financials pack. The financials have done very well for themselves. Realty was the other one within broader markets which has done well. Oil and gas also, energy doing well for itself today. So that's how it showed up. Let's look at last off the BSE 500 top gainers, top losers before we look at cues for tomorrow. JBM Auto, no surprise there, along with an NBCC sitting pretty on top. IndusInd there, 7% higher as well. EIL, one of those top gainers. ITI was the other one based on news. But look at the losers, 8% lower on an Ease My Trip. Zydus Life, again, no surprise given everything that's playing out with regard to news on that counter. MGL down nearly 5. Coromandel seeing a correction after the sharp, steep rise that we've seen on the stock price yesterday. 4% down today. AstraZeneca, Lupin, the other ones which have seen a bit of a correction today. And Sona BLW 3.5% lower as well. So that's largely how it's played out. Let's look at what to watch out for tomorrow. And no major pieces that are gonna play out on Indian markets, it seems. But US retail sales is one thing that at least US markets will be looking at keenly and will likely impact India as well indirectly. US crude inventory is the other one, industrial production, but crude inventory is the other one. And there's a speech by the Fed chair, Jay Powell. You'll want to try and keep note as to what he says, because maybe some direction there or some change with regard to commentary. You have Japan import-export data, but outside of that, you'll have corporate earnings to watch out for. You have Infosys, ABB, HDFC Life. These are all numbers out tomorrow. You'll have Wipro's numbers out today. Impact of that will come in tomorrow. Shares and stocks to exit lock-in. You'll have Diffusion Engineers, 2% of the shares to exit lock-in. But with that, we will also close the queues for the day, and we'll also close India market close. From Neeraj, myself, everyone who puts the show together, thanks so much for tuning in, and stay tuned, stay safe. See you tomorrow.
all packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They are saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat, obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system for sure.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show. US benchmark indices end higher, giving up gains from the previous session. The Nifty ends about 23,400 mark and the Sensex ends about 77,000 levels. Now broader markets clinch on to gains outperform benchmarks. All sectoral indices, barring auto, pharma, end with gains. Auto and pharma react to the ongoing trade tensions between the countries on the back of tariffs. PSU Bank index jumps over 2%. Rupee strengthens to 85.65 levels. This as the currency grapples with ongoing trade tensions between countries. Massive inflow of foreign capital, weaker dollar and lower crude prices impact the rupee. Pharma index gives up gains made in the last few sessions on possible exemption from Donald Trump's tariffs. Although India's pharmaceutical exports to the United States worth nearly $10 billion annually may come under pressure as the US government initiated an investigation on Monday into the national security implications of importing medicines and related ingredients. Now, the probe launched by US Commerce Department will assess the extent to which the country's reliance on foreign pharmaceutical imports could pose a threat to its domestic healthcare system. In light of the US government probe, India's Pharmaceuticals Export Promotion Council, or the PharmExcel, says that it is in the process of identifying companies trying to understand the background better. Says that the probe letter is for the opioid basis dedicates. Bank of America highlights the valuation conundrum for consumption companies, says business growth is the big factor affecting valuation and the growth is almost always relative. Now, this makes sectoral global trends key. Now, BofA is uncertain if the valuation divergence is here to stay or expand. They have an increasing bias towards retail and discretionary spaces. Morgan Stanley maintains equal weight stance on Bharat Forge with a target of 1170 rupees, says the US slowdown is bigger risk as North America formed 41% of standalone sales in Q3. Now, the US machinery team has lowered Class 8 forecast for 2025, expects a modest increase in 2026 and removes pre-buy expectations from their estimates. China's action of suspending the delivery of Boeing will impact India's interglobe aviation. Since Boeing may reallocate deliveries to India, Air India CASA have placed major orders for Boeing jets recently. The government's new administered price mechanism gas allocation becomes effective today. Mahanagar Gas stock falls after disclosing a significant cut in its allocation of APM. The APM gas replaced with New Well gas. The New Well gas cost higher by $1.3 per million British thermal units than APM gas due to lower crude prices. Bernstein believes Kotak Mahindra Bank is the biggest beneficiary of the lower cost of funds, maintains a market-performed stance on the company with a target of 1950 rupees, says the company reported faster growth than peers. IndusInd Bank is the top gainer on Nifty today after external auditor PwC's reports identifies post-tax impact at 2.27% of the bank's net worth. The negative impact of 1,979 crore rupees as of June 30, 2024. Morgan Stanley maintains an equal weight on IndusInd Bank with a target price of 755 rupees. This is after the external agency confirmed the derivative discrepancy loss, which was largely in line with the management estimates. Gensol Engineering share prices has fallen to all-time low. The stock hits the 5% lower circuit. This after market regulator SEBI in its interim order asked the company's promoters to be barred for alleged fund diversion and record falsification. ICICI Lombard stock slips despite good growth in their assets under management and profits after tax numbers. Now, the management says weaker growth in two-wheelers and tractors is indicative of weak rural growth. Expects health insurance to deliver double-digit growth over the longer term. ICICI Prudential, on the other hand, jumps over 3%. After delivering a margin growth above street estimates. Now, the annual premium equivalent or the APE component growth is slightly below expectations, whereas the value of new business has outperformed expectations. In a bid to push electric vehicles, the government will launch a tender for procurement of 10,000 electric buses. This will be done under the PM E-Drive scheme. The tender may come in May and the subsidy could be for around 3,000 crore rupees. Stocks of JBM Auto Electra Green jump on the back of this news. Now, it is also speculated that the centre may invite bids for this initiative with the Ministry of Heavy Industries and bidding for 8 to 10,000 buses in first phase. Landmark Cars rises after strong growth in Q4 update. The total revenue from operation has increased up to 1,525 crore rupees. The vehicle sales rose 21%. After sales services shows traction as well. The pre-owned vehicle sales declined 45% on a sequential basis. ITI stock surges to intraday high of over 5%. This as the company commenced work on the State Network Operations Centre, that is the SNOC, of the monumental BharatNet Phase 3 project at Solan in Himachal Pradesh in coordination with BSNL. The total value of the order is 5,050 crore rupees. Now, it will involve the development of middle mile network of BharatNet project. HSBC believes that IT sector may not underperform the market in 2025. The sector is extrapolating the lessons from past macro crisis, says that GCC competition, generative AI uncertainty and rupee volatility are the negative variables. HSBC continues to expect mid-single-digit compounding growth. ICICI Bank slashes their interest rates on their savings account by 25 basis points up to 2.75%. Now, the accounts with balance below 50 lakh rupees will attract savings account rate of 2.75 annually, while those with balance over 50 lakh will have a rate of interest of 3.25% per year. Banking Laws Amendment Bill is now finally a law. after the president's approval. The government will implement these laws in phases. Up to 4 nominees are now allowed per account, which was currently just 1. This is applicable to deposits, lockers and safe custody accounts, and being done to reduce unclaimed deposits in the banking systems. Indian steel giant JSW Steel has announced that they will invest 50,000 crore rupees in the state of Maharashtra, which will create 10 million ton green steel per annum near the financial capital. Now, this investment comes in mandatory because a major chunk of green steel is exported to European markets. It will also reduce the 10 MTPA capacity of carbons used in conventional plants currently. Big negative for Lupin and Zydus Life as both companies lose litigation on key drug Myrbetriq. Now, this drug is used to treat overactive bladder and contributed significantly for both the companies in Q1 numbers. Now, both Lupin and Zydus will have to withdraw the drugs from the market. Brand wars between Honasa Consumer and HUL intensifies. Mamaearth brand parent Honasa Consumer plea in Delhi High Court over HUL's disparaging sunscreen advertisement. Now, the dispute centers on HUL's ad campaign, which alleges that some sunscreen products in the market falsely claim SPF 50 protection. HUL said that Lakme follows in vivo SPF testing, a globally recognized method, and has done so since 2015. Infosys announces a partnership with Spark New Zealand, a telecommunications and digital services company, to drive digital transformation and reduce operating costs for Spark. Now, the partnership will leverage Infosys AI-first services, including Infosys Topaz and Infosys Cobalt, to enhance Spark's technology delivery model and reduce its operating cost. The Competition Commission of India has approved a proposed merger between Aster DM Healthcare and Quality Care India. The transaction also involves private equity investors BCP Asia 2, Topco 4 PTE and Centella Mauritius Holdings, who are existing investors in the Quality Care India. Clayton, Dublier and Rice make an open offer to take over Sanofi. Now, the entities will acquire shares from company shareholders. This comprises of 26% of voting share capital. Dr. Reddy's clarifies on acquiring Sanofi India's insulin brand Lantus, says the company has on comments on the market speculation. Shares of both Sanofi and Dr. Reddy's end higher in trade today. Heineken N.V., the promoter group of locally listed United Breweries, says that its India business reported organic net revenue growth in the low teens for the quarter ended March 2025. While growth remained positive, Heineken said that its India business lagged the broader beer market due to a temporary halt in supply in one of the company's largest states. Gallant Ispat rises after the company's board approved proposals to expand the installed production capacity of the existing integrated steel plant at Gorakhpur. Now, the company's board approves 1,015 crore rupees of capex for the above expansion and captive solar power plant. The much-awaited Amravati Airport becomes operational today. The first flight successfully lands with Maharashtra CM Devendra Fadnavis being on board. Regional connectivity has become a reality, unlocking new horizons of growth, says the Maharashtra CM while sharing pictures on platform X. You can now withdraw cash money from ATMs, even traveling in train. Now, Indian Railways start installing ATMs in trains on a trial basis. After trial run success, the ATMs will be formally launched. The first trial run was completed yesterday in a train from Nanded to CSMT in Panchavati Express. All factors like possible network challenges, security and privacy are being considered. The Supreme Court is hearing a batch of pleas challenging the constitutional validity of Waqf Act, which was passed by the Parliament earlier this month. Now, the petitions include those filed by AIMIM Chief Asaduddin Owaisi and Aam Aadmi Party leader Amanatullah Khan. So far, 10 petitions have been listed on the issue, and a batch of pleas will be heard by Supreme Court bench comprising Chief Justice of India Sanjeev Khanna and Justices Sanjay Kumar and KV Vishwanathan. Businessman Robert Vadra appears before the Enforcement Directorate again after a 6-hour questioning yesterday. The husband of Congress MP Priyanka Gandhi Vadra is being grilled in a 2008 Haryana land deal linked case of alleged money laundering. On a post on Facebook, Robert Vadra says, and I quote, that I'm here for any kind of unjust behavior. I believe in truth and truth will prevail. And viewers, Wipro has come out with its Q4 earnings result, and joining me is Puneet Javeri on this. Puneet, over to you. What do the numbers suggest?
Well, numbers are actually largely in line with what the estimates were. Revenue was expected to be around 22,500, and it's come in bang in line with that number as well. EBIT margins also was largely expected to be flat at 17.3%. That number has also come in. But there's a beat happening on the net profit number. It's come in higher by 6.6% versus the estimate. It's roughly about 3,588 crores versus 3,367 crores on a quarter-on-quarter basis. And that number is a key positive. I'm also looking at the attrition rate that's largely maintained at 15%, another key positive for the company. But when I look at the deal wins, and that's one of the key big numbers, total bookings have come in at roughly 3,955 million versus 3,514 million on a quarter-on-quarter basis. It's a huge jump of 13.4% at least on the total booking number, and this includes all the bookings that the company has done in this particular quarter. When you also look at specifically in terms of the large deal booking, as the company clarifies it, is roughly coming at 1,763 million, or roughly about $1.7 billion in this particular quarter. It's another big, huge number for Wipro in this particular aspect, because, you know, when you compare with the last quarter, which is generally a slow quarter, it was 961 million. And even if I remove the quarter-on-quarter cyclicality, look at the last year, it was roughly at about 1,191 million. So roughly about $1.1 billion. So definitely the deal wins has been really strong for Wipro in this particular quarter. I'm also looking at some of the other key aspects because they have released their press release right now. So looking at the bookings number, it's again a good beat. I mentioned 13.4% in this particular aspect. And while there is a beat on the margins on a year-on-year basis, it's a really strong number. Attrition, as I mentioned, it's maintained. And, you know, the guidance also flashing on the screen right now for Q1 of FY26 is roughly about 2,505 million specifically in this particular quarter of Q1 of FY26. And brokerages had largely maintained this particular number as well for Wipro in this particular quarter. So it looks like results largely in line as well. And when you look at the bookings number specifically, that's really some number that's caught my eye. It's really coming at a very strong number in this particular quarter. Now, expectations was of, you know, FY26 to be -1% to +1% growth specifically for Wipro. I think that number has largely been maintained in this particular quarter as well. So that's another key positive. And, you know, to take this discussion forward, let me invite in Rahul Jain of Dolat Capital as well. Rahul, you know, thanks so much for joining in as well. You know, results largely seem in line in terms of the top 4 financial numbers as well. Would you agree with that? And also wanted to start off essentially with the booking numbers as well. It looks like a very strong beat on that aspect as well, right?
Yeah, so from our number perspective, I think there is a slight miss. I would call it out from a revenue perspective. A slight better in terms of margin. To your question on deal signing, the number look exciting, especially on the large deal side. However, if you look at the guidance which they are suggesting for the quarter, I think it kind of suggests that those advantage of TCV are not getting factored in the near future, and that is where something which make us slightly thinking about in terms of full year prospect, because the large deal which they recently announced, we were anticipating their number to be higher because of that, but it's a very long 10-year deal, so the ACV value is not that great, and that's why the number of value in terms of booking looks high, but the translation of that into the current quarter number is not excitingly resulting in a negative growth expectation that they are having for Q1.
Fair point, Rahul. And, you know, I also want to understand, you know, because they've mentioned the guidance going forward, roughly about $2.5 billion. But when you look at the percentage, it translates into a sequential guidance of -3.5% to a -1.5% in constant currency terms. I just want to understand with your aspect as well, because this looks like a slightly weaker number, essentially in terms of guidance. What was the number that you were working with?
Yeah, our midpoint assumption was flat revenue. So we were more like thinking of -1 to +1 type of band. So that way it looks pretty weak. And as I said, our hope was more led by that large win that they already announced a few weeks back. But it seems that there is a lot of other pause and worry, which is probably causing them to think this quarter to be weaker, and it's been already highlighted by their clients selectively. And it's a big negative because if you're having exit quarter being negative here in Q4 and then you start with, let's say, midpoint of what the guided band is, let's say -2.5% in Q1, it would be very difficult to recover from there to report a positive number for the full year. So I think this will be seen as a negative. Basis this, I think it would be very difficult to anticipate FY26 to be a decent year for them.
Stay on, because we also have Avinash Gorashankar of Profit Mart joining in as well. Avinash, Rahul is mentioning that it's a slightly weaker number according to the estimates. I just want to understand in terms of the top four numbers, revenue, EBITDA margin, EBIT margin, as well as the net profit. What do you make of these numbers?
No, I think these numbers were, in line with expectations. But I think, as you rightly mentioned, the outlook for quarter one, the kind of guidance, I think that is something the markets would be quite disappointed. Because, even if the company were to report flat revenues, that would have been a matter of consolation. But I think, if you're talking about sequentially, 1.5% kind of, degrowth in constant currency terms, then I think it clearly portrays the fact that, I think clearly the US market is still witnessing a lot of headwinds, for IT companies. And specifically, if you talk about Wipro, they've always been weaker on the guidance, if you compare it with other companies within the, within the IT basket. So I think to that extent, my sense is these numbers are unlikely to, re-rate the stock. The stock has not, delivered in terms of very strong numbers, but I think that was an expected line. But I think now what comes out in the first quarter, and obviously how they maintain the, the momentum in terms of revenue and margins is going to be very critical. I think any kind of letdown on the revenue growth could have a direct impact on their margin. So I think, it's not a great number, but at the same time, market was expecting these weak numbers. But definitely, I think very difficult to say, now whether this will get re-rated in the next 6 to 8 months. I think markets would definitely love to have much more stronger numbers to get a re-rating here.
Got the view, Avinash, and stay on, because let me go across to Rahul again. Rahul, we've seen the segmental performance of the company as well. We've seen the energy, manufacturing and resource segment has gone up by roughly 40 basis points in terms of contribution, while it's largely flat essentially in terms of banking as well as the consumer names. Anything on the segmental performance that you're spotting right now?
Yeah, so I mean, for a very weak quarter, I think doing that segmental analysis does not help much, because any which ways the net number is negative, which would mean that most segments would not have contributed. I think what we would like to hear is what they will give commentary here on for next year, because in US we have already seen the BFSIs reporting very strong record numbers, and at the same time their outlook on tech has been decent if you look at the BOFA release and stuff like that. And meanwhile TCS also commented that BFS is looking good. So those are kind of input would be more crucial. This quarterly movement in the segment, especially in a negative quarter, would not a much number to look into.
And Rahul, anything specific apart from the factors that you mentioned in terms of commentary that you're looking forward from the conference call as well?
So yeah, I think it's clearly the Q1 guidance which they are implying, I think gives you that kind of a hint that they might talk about certain pauses or project ramp-up delays or something of that sort, because bookings are good, but irrespective of that, it's not translating into revenue. So any comments on those points is something which we would be more keenly watching out for.
Avinash, similar question to you specifically. I mean, I know that the numbers have just come out, so I appreciate both of you joining us. So specifically, Avinash, anything that you would be looking out for in this particular conference call, and anything in the result that catches your eye?
I think clearly, what kind of, order wins does the company expect in the coming quarter? And I think what is the kind of margin outlook? Because clearly, margin outlook maintenance is very important. If they can even maintain the same EBITDA margin, and obviously in terms of the incremental order book, what kind of order book is expected to come in? Because that would give us a fair idea about what could be the run rate, for the coming financial year.
And, Rahul, you mentioned about the segmental performance as well. We look at the strategic market units as well of the company. The Americas one region specifically has just contributed 0.2% in terms of growth, while we've seen Europe actually have a 2.5% negative fall as well in this particular quarter. When you look at also the sectors, I think the highest one has been in healthcare, and that's been one of the key issues that's been pointed out by something like TCS as well. That amongst manufacturing as well as healthcare is something that's getting affected in terms of the order booking as well as the revenue in this particular quarter for all IT companies. And is that something that you're going across for the large cap peers specifically to see an impact there?
Yeah, I think commentary is going to be evolving in this quarter as well as in the upcoming quarter because of all this major, turmoil that we are going through. Because please note that some of the commentary that management may highlight is basis their conversation that might have happened in the month of March, while most of the bigger action from a macro point of view has shaped up in last 10 days. So there is a good possibility that some of the impact, positive or negative, would, mostly get factored in these upcoming guidance. However, if we also recollect from TCS commentary, I think barring for BFS, they were not positive on any space in particular, and consumer they turned fresh negative during the quarter. So I think that would be another area to understand how one should anticipate this, both from a geographical point of view, as you were mentioning, and also from an vertical commentary perspective.
Got that view, Rahul. And Rahul, thanks so much for joining in. Appreciate you staying with us. You were with us for TCS results. So thanks so much for coming in so promptly for these results as well as Avinash. Thanks so much for joining us for these results. So overall for Wipro, specifically we see that, while the numbers are largely in line, it's slightly disappointing, as, both Rahul and Avinash pointed out. While the deal wins has been strong in this particular quarter, and that will be something that the management will be speaking about. We have the press conference scheduled at 4:30 today as well as the management call with the analysts at 7 p.m. I think the conversation is going to be revolving around what the management is seeing in terms of commentary with its clients going forward. Any kind of outlook in the Americas one as well as the two region. We've seen Europe also degrowing in this particular quarter. Some commentary aspect on there, but overall, while the results slightly, largely in line with estimates, and estimates weren't that great of just about a percentage in terms of revenue growth as well as margin revenue, profit was expected to just slightly be higher. It's come in at that level, but the deal growth and the pipeline that the company has not translated into revenue. That's the view from Dolat Capital as well. And essentially, we are seeing that as well. So it's going to be very interesting with what the management has to say in the press conference. So do stay tuned to NDTV Profit, and that's going to come in at 4:30. But overall, results, slightly disappointing in terms of Wipro as of now. And on that note, we'll take a very short break on earnings edge for Wipro specifically. Stay tuned to NDTV Profit for more.
All packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
After a subdued start, benchmark indices recovered from intraday losses to post gains in the second half of trading. Last hour buying helps lift the market out of its earlier lackluster phase, marking a strong close for the session today. After the US slaps China with a whopping 245% on tariffs, China's foreign ministry reiterates that it seeks no confrontation but will not remain silent in the face of US pressure. IndusInd Bank shares jumped 4% in early trade, emerging as one of the top gainers in the banking sector. This follows an external audit by PwC, which confirmed a 1,979 crore discrepancy in the bank's derivative portfolio, a figure slightly better than the bank's earlier estimate, bringing relief to investors. Gensol Engineering shares fall by as much as 5%, hitting a yearly low on after SEBI alleges that its promoters had diverted company funds. In a first for Indian Railways, the Mumbai-Manmat-Panchavati Express is India's first train to feature an on-board ATM. Hello and welcome. This is Profit 360 on NDTV Profit, and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets, but as well as national and international news. So let's dive right into it, shall we? The markets navigated intraday volatility to end higher, giving up gains from yesterday's session. The Sensex gained 309 points, while the Nifty rose by 108 points. Most sectors ended in the green, with the exceptions of auto and pharma, dragged by ongoing tariff tensions between the nations. My colleague Harsh now giving us a comprehensive market roundup. Harsh, over to you.
Well, we built on gains, in fact, and healthy gains that we've made in the last two trading sessions, Friday as well as Tuesday. It's been a good 3 days of gains for the index. We were up 0.5% on the Nifty 50. 23,400 is now what we're looking at, and therefore all positive where the benchmark is concerned. Stocks which did well, and let's pull some of those up. Something like an IndusInd Bank stood out in trade, up nearly 7+% in trade, and Axis Bank was up 4%. It was basically the private sector banks within the Nifty 50 which led gains for the Nifty. Those were the ones in focus, and it's also the Nifty banking index which was up 1.5%. The Nifty Bank and both private as well as PSU banks did well in trade. It was a day where SBI also closed a % plus higher. So financials in focus, and within that basket, the banks doing relatively better and outperforming. A little bit news based, but also a little bit based on building up of gains. So we saw 7% on IndusInd yesterday, as well as nearly 7% on IndusInd today, and therefore just building on those gains. Very similar trajectory for Axis as well, 4% and 4%. So that was one bucket of stocks. The other ones were the relatively underperforming ones, something like the auto sector, Maruti, Bajaj Auto. Some of those were languishing in trade and were under some bit of pressure on a day like this. You also had Pharma, which was slightly more muted, IT, which was slightly more muted in relative terms. Sectors which outperformed were something like a realty, marginally outperformed. Energy basket was the other set of stocks which outperformed in trade today. So broader baskets, that's how it played out. The advanced decline was sizable in the sense that the breadth of the market was positive. The bulls continue to lead the charge in that sense. There were certain pockets of the market which were in focus today, and IREDA lending to a Gensol and news of Gensol and results of IREDA. Some of those themes played out in the market as well. And we also had something like a JBM Auto and Electra Green in focus on the back of government spending on electric e-buses, and therefore some of those pockets also relatively outperformed within the BSE 500 basket. If you look at the top gainers, top losers, some of those also reflecting.
Thanks, Harsh, for that. But this time the US-China trade war isn't just bilateral. But let's just have a look at the impact of the tariffs before that on the Indian markets, because we saw the markets navigating intraday trade volatility to end higher. But we also spoke with JP Morgan's, we also had a discussion with JP Morgan's Rajiv Batra, where he said that India actually stood to hold steady thanks to its strong domestic demand. Let's listen into that.
Where I will try to give you a lens over here is that we all are trying to do the same kind of a mistake, saying that it is just US versus China, or we are trying to take leap out of book from trade war 1.0. Where the difference compared to the last time trade war over here is that tariffs are not just on China. We still have 10% universal tariff across the board. We also have sectoral tariff in place. So in the previous trade war, entire emerging market benefited because of a supply chain shift, FDI coming, and when exports getting rerouted, or you can say coming from EM side. This time around, we have barrage, or you can say menu of tariff across, not just on China, but other countries also, which means it is easier said and done to say any particular emerging market will benefit, or any particular big developed market will benefit over here, because everyone somehow come into that tariff bucket. So taking that into account, there will be only relative winners, countries which have very less exposure to trade, or countries which have very low exposure to US demand. And that's where India sits well, along with some other domestic economies of EM or of the world, who will tend to relatively do well in an environment because of a huge domestic demand and constructive domestic factors.
And the Adani Group of companies have received a vote of confidence as GQG Partners and LIC collectively increased their stakes since the last quarter. Now, this move signals renewed investor interest and heightened scrutiny and recovery efforts following the challenges faced earlier in the year.
So clearly you have GQG, which is doubled down in terms of Adani group of companies. They've gone ahead and raised stake in nearly 5 Adani group companies. If you see the kind of numbers that we're seeing, Adani Enterprises, the stake has gone up from 3.67% to a 3.84%. It's only Adani Ports where there has been a marginal downtick that has come in. Again, an increase that has come in terms of Adani Green as well, from a 4.21 to a 4.49. So that's the first set. If you talk about the second set of companies as well, in terms of energy, the stake has gone up. A marginal increase has happened in terms of Adani Power as well. And if you talk about Ambuja Cements, that's where you've seen a marginal downtick. And this is mainly if you talk about the legal shadows that have begun to recede, as well as if you talk about the global sentiment as well. That is also seeing some bit of stability that has come in. And you have one of the most loyal backers of Adani that is back on the buying table and big time. Now, you talk about aggressive accumulation that is happening in the month of March quarter comes, and this is at a time when there has been turbulence with regards to Trump's tariff blitz, and that has rattled emerging markets again in 2025. Now, let's also look at what LIC has done with regards to the group companies. Enterprises, there has been an uptick that has come in from an LIC. They've gone ahead and increased stake in Adani Ports as well. Their stake in terms of Adani Green has remained absolutely stable. And if you see the other set of companies with regards to LIC, Adani Energy again has remained stable, whereas it's gone up in terms of Adani Power as well as Ambuja Cement. So clearly, I think it's 4 companies in terms of LIC where they have gone ahead and increased stake. So clearly, it's the Indian mutual fund industry which is also increasing stake in terms of Adani names such as Ports, Green Energy, Energy Solutions, and even LIC, as we already mentioned, has gone ahead and increased stake. In fact, Ventura Securities and Jefferies are the ones who have started to have a positive outlook in terms of Adani Power as well as Adani Ports as well.
And let's take a look at what's happening with Gensol Engineering. A storm brewing as SEBI last night barred its promoters Anmol Singh Jaggi and Puneet Singh Jaggi over allegations of fund diversion and falsified records. Now, accused of using company funds for ultra-luxury real estate, misleading key stakeholders, the promoters face restrictions from the securities market and are prohibited from holding top roles in listed companies. Adding to the chaos, Blue Smart rides linked to the group are showing unavailability across Delhi, Bengaluru and Mumbai, leaving services disrupted. This cocktail of scandals has driven Gensol stock, as we saw today, to plummet to very, very low, almost the lowest in the year. And let me quickly bring in my colleague Mihika to dissect the factors behind this staggering downfall. Mihika, over to you.
So we've seen Gensol be in focus in 2025, especially. The stock is down 85%, and in terms of their market cap erosion, it's seen a market cap erosion of around 6,890 crores. The peak market cap was around 7,300 odd crores in Q2 FY24, and the latest stock split that was announced in the 1:10 ratio has also been now put on hold by SEBI. Now, what alerted the markets majorly was CareEdge and ICRA downgrading the ratings of the companies early in March. The ratings downgrade was on account of ongoing delays in servicing the term loan obligations, and the no default statements that were shared with ICRA on the debt servicing track record were apparently falsified as per the rating agencies, and there were then concerns in corporate governance practices, including its liquidity position. Now, just to give you a quick debt to liquidity picture, the total debt of the company stood around 1,146 crores versus the last 12-month EBITDA of around just 330 crores. Leverage was at 3.5 times, and the company had stated that it had liquidity of 250 crores in its Q3 FY25 con call, but we don't know why the debt repayments were not coming through if it had this said liquidity. Even in terms of their divestment scheme, which was aiming to raise around over 650 crores, is now not on track. Claim 1 was to sell 2,997 EVs to Reflex for around 300 crores, but the update is that Reflex, after doing its due diligence, has decided to not go with this transaction. So this entire transaction will not be coming into place. And the second claim is the company is going to sell its US subsidiary for a total of 350 crores. The transaction is expected to come by March 2026, subject to approvals, and we wait for an update for the same. And lastly, when you talk about the fund infusion, the company has received 25% of its warrant subscription, which was issued in the first half of FY25, which has been paid back, but is yet to raise 404 crores from promoters and investors. 100 crores of this is from promoters, the balance from around over 100 investors. But the promoter did infuse 30 crores of the 100 crores needed in March when he sold 2.37% stake coming in. Lastly, we also have Irida in focus on the back of this because it has a total exposure of 600 crores to Gensol, debt of 280 crores and a working capital loan of 320 crores, and this is 0.8% of Irida's loan book.
And IRIDA had actually funded Gensol Engineering's EV-related projects, but these allegations of fund diversion have now understandably sparked concerns over the financial accountability of this lending. Pradeep Kumar Das, the CMD of IRIDA, shared insights on how the organization now plans to account for this in its books. Let's listen in.
As of now, our account with them has not become NPA. Number one. And number two, whatever overdues as of 31st March is around 80 crore. Against that, if you see, we have around 60 odd crores in the form of DESRA and FDs. Okay, so roughly this 80 crore to recover, around 60 crore we can recover even overnight. But that is not the way to handle. You see, now we have not stopped lending any additional financing to them for quite a long time, because if any of our developer is growing and growing very fast in the private space, we also have a review monitoring mechanism. Our team is doing, and since we are under RBI, as per the RBI policy, we have a investigation policy. So our team investigation committee is doing that. Parallelly, it is going on, and yesterday we are very fortunate. We have published the result, and then we have seen the service report in their website about their findings and all. So our team also now working on it.
Now let's shift gears and take a look at what's happening globally. The United States has escalated its trade war with China, imposing tariffs of up to 245% on Chinese imports, a sharp increase from the earlier 145 duty. Now, in response, China had previously levied 125 tariffs on American goods and have now come out and responded, refusing to back down. What's behind this aggressive trade strategy? Let's hear from my colleague Vishal Vivek on deeper insights for the motives and implications of this evolving clash.
So interesting statement from both the sides. US on the other hand has said that it has responded to China's inaction. It is saying that 75 countries are ready to make a deal with the US, but China keeps on retaliating to US tariffs. So that is why they have increased it from 145% to 245%. So that will be the levies on the Chinese goods coming into the US market. So that is an unprecedented scale of US-China trade war, and China has seen has been saying that it's due to the actions of the US that the world economy could be faltering, and China has said that exerting pressure will not result in anything good for anyone, and it needs to come onto the negotiation table. It needs to have a practical approach to the whole story. So that is what is happening right now.
Thanks, Vishal, for that. And my colleague Himakshi now joining me in the newsroom. Himakshi, it's clear that this is no longer just about trade. It's clearly about control over critical resources, global tech supply chains, and geopolitical posturing. So with these tariffs now hitting 245%, both sides digging in their heels, the US-China clash has now entered a far more aggressive phase. Give us a detailed explainer on this trade war, and more importantly, a timeline of how it all began.
Absolutely, Sanjana. Now, tariff war intensifies to another level as US has slapped 245% tariffs on China. Now, this move is a direct response to China's retaliatory actions, which included imposing a 125% duty on American goods and restricting exports vital to US aerospace and defense sectors. Now, until now, a tit-for-tat tariff exchanges had been seen. Let me just take you through the timeline there. Now, first on April 1, Trump had, levied tariffs, and then on the T-Day, that is on April 2nd, Trump came up with its, more tariffs, and now Trump has come up with a statement saying that the ball is in China's court, urging Beijing to make actually the first move towards negotiation to which China has agreed to hold talks, and it will be interesting to see how things are going to unfold in this massive trade war between the US and China, Sanjana.
Absolutely, Himangshi, because we've also seen China coming out and responding to this, saying that while they are not up for any kind of confrontation, they are clearly digging in their heels and refusing to actually blink. So like you rightly said, interesting to see how this actually plays out, not just out of the markets, but even otherwise, as we have been reporting that China now slowly but steadily actually taking action against the US, whether it is with their factories, whether it is with Boeing. Thank you so much for those insights. And moving on now to a different kind of clash, this time within the beauty industry as summer hits. The clash over SPF 50 has now reached the Delhi High Court, with Honasa Consumer, the parent company of Mama Earth, filing a lawsuit against Hindustan Unilever, alleging that HUL's Lakme Sun Expert advertisement unfairly targets products from Honasa's The Derma Co. Now, at the core of this dispute is Unilever's campaign, which accuses some sunscreens of falsely claiming SPF 50 protection. Let me quickly go back to my colleague Himakshi to give us more insights. But before that, I'm going to bring in my colleague Sesa, who has been tracking the story very closely, with details of what happened in court today.
After a public spat on social media, skincare brand Honasa Consumer, known for its brands Mama Earth and Derma Co, has now filed a lawsuit against Hindustan Unilever in the Delhi High Court. The company has sought removal or a modification of HUL's Lakme sunscreen ad campaign, alleging that their ad disparages products from Derma Company. Now, appearing for Honasa, advocate Amit Sibbal described HUL's campaign as a classic hit and run, suggesting that rival sunscreens fail to offer adequate SPF protection, arguing that such practices undermine fair competition in the skincare market. After a preliminary hearing, the Delhi High Court noted that the Lakme ad appeared to be disparaging on the face of it, but it has sought a response from HUL before taking any actions. The matter is expected to be heard next on April 17th, when both the parties will present their arguments.
Thanks, Esa, for that. And let me quickly go across to my colleague Himangshi, who's back with me in the newsroom. Himangshi, we've seen this fiery legal clash between Honasa Consumer and Unilever over sunscreen claims. But what I'd like to understand from you is that what started out as a social media spat has now reached the courts. So just give us the breakdown of what actually led to this showdown.
Yes, absolutely, Sanjana. Now, let me just take you through the whole story. So, it all started with Lakme's recent SPF lie detector test campaign, in which the advertisement claims that some digital-first brand misrepresent their SPF 50 products and delivering protection as low as SPF 20. Now, Lakme highlights this use of in vivo testing, which actually is a global standard involving human trials to validate its SPF claims. Now, Honasa has alleged that Lakme has unfairly targeted competing sunscreens, including a product resembling the Derma Co's product appearing for Honasa. Advocate Amit Sibbal, called HUL's campaign a classic hit and run and urged the court to either pull down or tweak the ad. Now, the Delhi High Court hasn't passed any order yet, but has asked HUL to present its side of the story on April 17th. Back to you, Sanjana.
Thanks so much for that, Himangshi. We'll continue tracking the story and give you all of the updates as they happen. That's all the time we had on this edition for Profit 360. Stay tuned to NDTV Profit for more news and updates.
all packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea?
Yeah, I was a super fat, obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
This is reflected in the strong growth in top accounts and also large deal bookings in financial year 25. We have continued to invest in our people, skilling them for the new AI wave. Our execution rigor with speed definitely has been acknowledged by our clients, and that's reflected in the clear improvement in our client satisfaction scores. And we have done all of this while strengthening our margins. It's a meaningful achievement in the context of such ongoing change. The global industry environment remained uncertain for most of the year. And of course, the recent tariff announcements have only added to that. Before coming to Bangalore, I've been speaking to clients across sectors and across markets to understand how things are playing out on the ground. Even though the underlying demand for the tech reinvention remains strong, our clients are approaching it more cautiously. They are focused on cost, speed, and of course, AI-led efficiency. And that's exactly where we are leaning in. And we see this as an opportunity to move with purpose, make smart bets, and stay committed to our 5 strategic priorities. I want to say this: driving consistent, profitable growth remains a clear priority for us, and we are focused on making that happen. With that, let's look at our Q4 and FY 2024-25 performance. All the growth numbers I share will be in constant currency. Our IT services revenue for Q4 was $2.6 billion, reflecting a sequential decline of 0.8% and 1.2% on a year-on-year basis. The order book for Q4 was at $4 billion, which is a growth of 13.4% sequentially and 10.5% on year-on-year basis. Our operating margins came in at 17.5%, which is flat sequentially and 110 basis point expansion on a year-on-year basis. And for the full year, IT services revenues were $10.51 billion, reflecting year-on-year degrowth of 2.3%. Our operating margin was at 17.1%, an expansion of almost 1% as compared to FY24. Now let me talk about our strategic market unit performance. Americas 1 grew 0.2% sequentially and 6% on a year-on-year basis. Americas 2 degrew 1% sequentially and 1.8% on a year-on-year basis. Europe degrew 2.5% sequentially and 6.9% on a year-on-year basis. APMEA grew 1.0% sequentially and degrew 4.9% on a year-on-year basis. Now moving on to our industry sector performance. BFSI degrew 0.5% sequentially and grew 0.8% year-on-year. Healthcare degrew 3.1% sequentially and grew 0.1% year-on-year. Consumer degrew 1.3% sequentially and was flat year-on-year. Technology and communication degrew 0.9% sequentially and 1.1% year-on-year basis. Energy, manufacturing and resources grew 1.1% sequentially and degrew 7% year-on-year. Finally, Capco continues to perform well, growing 6.5% sequentially